This video is not for beginners because I'm going to give you an advanced training course that you will not find anywhere else on YouTube, and I'm going to condense 5 years of trading into however long this video is. And if you can understand everything that I go through in this video, congratulations, you will become a profitable trader. It's only a matter of time.
Okay, so what even is daily bias? Daily bias, in its most simplest form, is just a higher time frame direction. It literally is, where is price going to go on the higher time frame? That's it. It's that simple. Now, why do we care about the higher time frame? The higher time frame move the market. Those who have billions, those smart money, big banks, hedge funds, insurance companies, they only trade on the daily and the 4-hour chart, right? But this is the key chart that all of smart money, everyone with billions are looking at. But we want to ride, essentially, we want to follow the trend that smart money, these big institutions are doing, right? That's what we want to do. So
there's only 3 time frames that you actually need for daily bias, and those are the weekly, the daily, and the 4-hour chart. Now you need to use it in that order, right? So you have to start with the weekly, go on to the daily, and then the 4-hour chart, right? So you've got to use all 3 of them. Now, what we're going to do is we're going to start off on the weekly chart. Now this example right here on dollar yen is the hardest example that I can give you, right? It's the hardest example. I went through all my watch lists, right? I scrolled through each and every single pair, and USDJPY by far is the hardest example. So if you can understand this, you will understand literally any pair, any asset, anything that you trade. So we're on the weekly chart, and the first thing you want to do on the weekly chart is you want to look at the most recent price action, right? We want to look at the most recent price action over here. Right? We don't care about, this order block all the way down here. We don't care about this. We care about, what's actually relevant to us. And this is the current weekly chart candlestick, right? So this is today's price action right here. So we care about this recent price action here. That's the only thing that we care about. And the first thing that I see, and for those who don't know, I always do my analysis live. So what I mean by that is I haven't gone below the daily or 4-hour chart on this, right? So this, I'm literally telling you exactly what I would do when I get on the chart. So the first thing I'm seeing here, I don't know if you guys see it, but if you've watched my channel for a long time, you'll know, right? And I'm sure most people know, at this low here, there's lots of liquidity. So let's mark out this low here, right? And this is what you always want to do, right? You always want to look at liquidity first, right? Liquidity is king. So we always look for liquidity first when determining daily bias, right? We want to look at old highs and old lows. So old lows here and old highs here. Now at this low here, there's lots of liquidity, lots and lots of stop loss orders at this low right here. And you see this wick, how we come down, we wick out this low and instantly reverse. That right there is a liquidity sweep, right? Very, very important. And if you don't understand liquidity sweeps, don't worry, there's a full, completely free 2-hour trading course where I go into stupid detail about liquidity sweeps. But if you understand liquidity sweeps, you'll know exactly what I'm talking about here, right? Because what price really does, or what price really did, is you see how we were dead bullish, right? Price came all the way down, it took out liquidity here. Remember, this is the weekly chart, right? This isn't the 5-minute or 1-minute chart. This is a major time frame that all the banks, all the hedge funds, all of smart money, everyone's looking at this chart. Everyone's looking at this chart, and only smart money move the weekly chart, right? Then, retail can move the 1-minute chart, but smart money are moving the weekly chart. And at this low here, lots of liquidity. Price comes down, it wicks out this low, instantly starts reversing. That right there is a very bullish sign. Very, very, very bullish sign. So that's the first thing that I noticed. So let me just mark this out. Let's actually write this down here. This is what you always do, right? So when you get onto your charts, the first thing you want to look for is liquidity. Now that liquidity has been swept at this low here, the next thing we do is we study this high here, right? Has the liquidity been taken here? No, right? And this is really, really important. Really, really important right here. Here is a fair value gap, right? This is a bearish fair value gap. And let's mark this out like this. This is our bearish fair value gap. Now, can you see how price literally comes all the way up, taps it, and then instantly reverses off in the opposite direction, right? You see how price, we have our liquidity sweep, like this. Price comes all the way up, it taps this fair value gap, and then starts to retrace, right? That right there is bearish, right? That's bearish. Now, you might get confused, and this is why I said this is a very difficult example. You might be like, oh, Atif, we had a liquidity sweep, and if we just zoom out a bit, like this, the overall direction is bullish, right? What's actually going on here? What's actually going on here? And for those who don't know, right, on Twitter or X, I called this live, right? When we were all the way down here, I called this that we're going to hit this fair value gap. So there's me bragging a bit, but but if you if you follow me on X, you'll know what I'm talking about. But what's really going on here, and it's just so important that you understand this, right? We are in, if we zoom out, we are in an overall bullish trend, right? Pretty obvious. If you ask anyone, what trend is this, right? What trend is this on the weekly chart? Oh, this is a bullish trend. What's actually going on here right, is price is at all-time highs on yen. This is all-time highs. Now, obviously at all-time highs, there's no liquidity, right? No one's shorting at all-time highs, right? No one's gonna, imagine if this was the highest candlestick and none of these down close candlesticks were here. No one's gonna start putting their stop loss orders at all-time highs, right? Only now, when price starts to come all the way down, to allow people to start shorting, and by people I mean major banks start putting their stop loss orders here. Right? They're shorting on the weekly chart because they see price comes down. Now price is actually going down to take out stop loss orders here. Right? It comes down, it takes out stop loss orders here, and it instantly and aggressively reverses in the opposite direction. Now you might be wondering, okay, what's happening here, T? Like, what's actually going on here? Why have we hit this bearish fair value gap and started to retrace? The reason we've done that, this is so important, it's something for your notes, right? Is price doesn't move in straight lines, right? It doesn't move in straight lines. Now, smart money traders who are going to target this high, so let's mark this out, right? Let's mark this out all the way like this. This right here is, it's a bit of a weird line, but let me just do it like that. Right, this right here is liquidity, right? This is our major liquidity, and what's really important about this is all-time highs. I'm just going to mark this out as ATH. Liquidity, this is all-time highs. This is the highest that yen has ever been. And some people, for whatever reason, are obsessed with picking all-time highs, right? You see this on, the S&P and NASDAQ. People are just obsessed with picking all-time highs, trying to capture some major gamble where, it drops 10, 20%. You don't need to do that. But some people, for whatever reason, they're shorting here and they're putting their stop loss orders at this high here, right? There is liquidity here overall. And if you zoom out, the overall direction of this market is bullish, like we said. Now, towards the end of this video, and for those who still watch, I'm going to give you something very, very advanced that will probably change your trading forever. But that's a little golden nugget, and it will make a lot more sense on why price is actually bullish overall and why we're taking out this liquidity. But you can see what's going on in this price action alone, right? Because I don't want to make it too complicated for you. What's really going on here is we've had our liquidity sweep. The overall direction is bullish. Is we are looking to target this high. Now, price doesn't go in straight lines. So what I mean by that is price is really, remember this is our liquidity sweep, right? Price is coming down to allow smart money traders to start buying at this fair value gap, this order block, optimal trade entry, to do that, right? The exact same thing, remember, this is the exact same thing we see on the 1 minute, 5 minute, 4 hour chart, 15-minute chart. The exact same thing where we have liquidity sweep, obvious liquidity, retracement, up. The exact same thing happens on all time frames, right? And you might hear ICT or other people say price is fractal. What they mean by that is this, right? The exact same thing that happens on the 1 minute chart happens on the weekly chart. Now, what that means for us as traders, we're not trading the weekly chart, is it means for us overall direction is bullish, right? The overall direction is bullish because if we just look at this fair value gap here, this bullish fair value gap, right? Mark this out. Okay? Price comes out. Look at this, right? See how we wick into the fair value gap and then we instantly start moving off in the opposite direction on the weekly chart. That right there is very, very bullish. And another thing that's really important is if we get the Fibonacci from this low to this high, right? Anything below the 50%, this light green line here is the 50%. Anything below the 50% level is a good buy, right? Smart money traders will not buy until price gets into the lower 50% level, right, of a price swing. They will not buy until price gets into this lower 50%, right? Very, very important. They're not going to buy up here. They're only going to buy when it's in the lower 50%, right? And remember, you might be thinking, oh, well, who's trading the weekly chart? Smart money traders are literally buying the weekly chart. They're buying this fair value gap with their stop loss order here, targeting all-time highs. And they'll hold on for months, as long as it takes, right? Because they have the money to do so. Now, we're not doing that, but by studying what they're doing, we can almost get on their pigtails, right? We can almost copy what they're doing, right? And pick up some crumbs that they leave behind. But those crumbs are worth, thousands, millions. So for them, you've got to remember, they're trading billions, right? So, a few million, it doesn't mean anything to them, right? So they're doing all their orders, all their analysis on the weekly chart. And if we see, below the 50%, just look at this, right? Look at this. So you see how price starts gapping down, right? Strong, aggressive candles down. Look what happens when we hit the 50% level, right? Look at what happens when we hit the 50% level. This body here almost respects it perfectly. We have a bit of bullish movement here. Okay, we have this candle here, this bearish candle, but where did it go? Look at this candle, where does it go? It wicks straight into the fair value gap. And then this candle here almost fills the fair value gap entirely, and then we start to shoot off. And now we're above the 50% level, right? Very, very important. Okay, so once you've got your liquidity, right, so we've looked at liquidity here and here, and then you've looked at your fair value gaps here and here, the next thing you want to do is you want to start looking at order blocks, right? Now, on the weekly chart, we don't even hit this order block. We don't hit it. Let me just make this very clear. We zoom all the way out like this, right? All the way out like this. We just miss out on it, right? This is the fair value gap. We just miss out on the order block. That right there is incredibly bullish. Right? A lot of people get confused by that. That's incredibly bullish. The fact that price, let's zoom out. The fact that price couldn't come all the way down and touch the order block here is very, very bullish, right? Normally I say I want price to hit it and aggressively shoot off. If price doesn't even hit it and start shooting off, that's even more, I guess, supports the argument that we're bullish, right? Because price is so bullish it couldn't even get to that point. So that right there is what I normally do on the weekly chart. I look for liquidity overall. I want to see, is price sweeping highs and lows? Where's the overall direction? Then I look at fair value gaps, which sides are being respected, and then I look at order blocks too, just in case. But liquidity and fair value gaps are like my bread and butter. Those are the two things that I really look for. And this is so important now. We've done the analysis on the weekly chart. We know overall that we're bullish, right? We've swept liquidity here. We've got all-time highs here. We zoom out like this. We said this. The overall trend for years. Remember, this is the weekly chart, right? So if I got this is 2021, right? It's 2020. This is 4 years of price action here. Remember, this is the weekly chart. The overall trend for years is bullish, right? So I've got the overall weekly trend, macro trend. We've got liquidity. Fair value gaps are being respected. I want to get on the daily chart, and I want to see the daily chart showing me similar things. I don't want the daily chart to be bearish. I don't want the 4-hour chart to be bearish, and then the 1-hour chart to be bullish. I don't want any of that. I want everything in agreement. I don't know about you. I'm a swing trader. I hold for at most 2 weeks. If you're a day trader, you don't even care about this. What we care about is the most recent price action. So we're only going to look at the last 3 or 4 candlesticks just to give us an idea of what the market's doing overall, right? So for me, and I'm doing this live, by the way, I haven't really looked below the weekly chart for gold or silver, but I'm going to do it live in this video in front of you, just so you know what it's like for a profitable trader to think and analyze these markets, because it's very, very important that you understand that. Right? There's no script. I'm just going to tell you live in price action what I see. And the first thing I see here, right, is you see this big bullish fair value gap. Let's just mark this out. This big bullish fair value gap here. Like that. Look at this. You see how price wicks into it and instantly shoots off on the weekly chart, right? These big bullish candles instantly shoots off once we hit this fair value gap, right? And if you look very carefully, I know the body slightly closes into the fair value gap, but it's mainly just a wick, right? It's mainly just a wick like this. Price comes in and then quickly and aggressively shoots off, right? What that's called is respect of a fair value gap, right? You might hear this all the time in trading. Price has respected this CB, this fair value gap, this order block, this breaker block. What respect means is that price has tapped it and it's quickly moved off in the opposite direction, right? That's all respect means. Now, in this case, the reason we actually care about this is this tells us that we're very, very bullish, right? The fact that price wicked into the fair value gap, massively, aggressively moved off in the opposite direction. That tells us that we're super bullish on gold, right? Because if price did something like this, if it went into the fair value gap like this, and then it just started consolidating for ages, that is not bullish at all, right? And if it started to break this fair value gap and go down, that's bearish. But the fact that price, let's just remove this, the fact that price tapped the fair value gap like this and instantly shot off aggressively and left another bullish fair value gap here, that tells us that we're very, very bullish, right? So we're going to operate with that lens on the weekly chart that we're bullish. Now, what I mean by that is when we get on the daily 4-hour chart, we're going to assume the overall direction is bullish, right? We're not going to look for a market structure shift on the 1-hour chart. We're just going to look for the overall direction of the market. So now that we've got the direction on the weekly chart, we want to get onto the daily chart and see what we can see. Here we are on the daily chart, and like we said on the weekly chart, overall we are bullish. Now, I know lots of smart money traders are going to be like, oh, look, Atif, market structure shift. Yeah, look, you can take trades here, but look at these candlesticks. Like, look at this, right? Look at these strong bullish candlesticks. There's one down close candle here. Right, look at this, from this low to this, guess this bit here, or this high here, right? Or this high here, this liquidity pool here. Look at all these strong, aggressive, green up close candles. You have one little down close candle. And then look at the way down. Look at all these choppy, large wicks. For every red candle, there's a green candle, right? Very choppy, very lethargic. We slowly, look at all these dojis here. We slowly take it out. That right there is telling us that we're bullish overall, but price is slowly coming down just to allow smart money traders to buy the dip, right? Buy cheap. And we talked about that on the weekly chart, because what's really happening here is overall we're bullish. Look at how strong the bullish candles are compared to the bearish candles. What's really going on is it's just allowing smart money to buy at the below the 50% level, right? That's what's really going on here. So all of this right here is accumulation. Look at all these dojis here. This is smart money buying, 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 and telling their friends to buy. That's what this is. Smart money buying, buying, buying. They're accumulating all their orders here. And then what they're going to do is they're going to ride price all the way up to this, right? Ride price all the way up like this. All the way up like that. Now, we don't care about, we don't have to trade the daily chart, but we can trade in this direction using the exact same logic they're doing. So that's the reason why price comes down. Lots of traders are going to get chopped up, shorting dollar yen, and then they're going to lose a lot of money. Who wants to be in this mess here? Like, who wants to be shorting dollar yen in it? Yeah, okay, you get a few good moves here, but who wants to be shorting these large weights? Because what's going to happen here, and you're going to see this all the time, you're going to short, right? You're going to have a liquidity sweep, and you're going to do what I tell you, right? You're going to put your stop loss at this liquidity sweep, and it's going to get swept again, and then it will come down, and it will just chop around, it will take out lows, take out highs, and it will just be the awful price action that will just confuse you, blow your prop firm account, and break you. Because trust me, I've done this for a long time. You just want to avoid this price action. But what we want to do now that we know that, now that we understand the overall direction is bullish, is we want to start studying fair value gaps and order blocks now, right? So let me just make this very clear. Right here is an order block. So let me just mark this out. This is an order block, and it'll be clear on the 4-hour chart, but I just want to show you on the daily chart. Right here is an order block. Price wicks in, instantly shoots off in the opposite direction. Very, very, very nice, right? We always like to see that. But this price action here, we have a fair value gap. So let's mark this out. Fair value gap here. And again, price does not touch it. It comes down, comes close to it, but now we're starting to move off in the opposite direction. Now, I want to get onto the 4-hour chart because this is getting a bit messy now, but just remember the overall logic that we had on the daily and 4-hour chart, right? Sorry, the daily and the weekly chart. Weekly, we're bullish overall, liquidity sweep, all-time highs of liquidity. Daily chart is just retracing to allow smart money traders to buy in this fair value gap, in these order blocks, just allowing smart money to buy before we ride price all the way up to all-time high. So we're going to get on the 4-hour chart and we're going to look through that lens, right? I'm not going to look on the 4-hour chart and think, oh, how can I short this? I'm not going to do any of that. I'm only going to look for longs, and more importantly, I'm going to look for targets on the 4-hour chart. Okay, so here we are on the daily chart, and now when I'm on the daily chart, I just want to see confirmation of the weekly chart, right? On the weekly chart, we're bullish, and I just want to see the daily chart show us that we're also bullish, right? I'm just looking for confirmation because this is something for your notes. The higher time frame is king. Now, what I mean by that is the higher time frame direction is what the overall market direction is. So if the weekly's bullish and the daily's bearish or the daily's neutral, I'm still going to go with the weekly direction because it's a higher time frame, right? Same thing if the daily is very bullish, but the 4 hours consolidating, I'm still going to go with the overall direction of the daily chart, right? So all else being equal, the higher time frame is the most important, right? So if the higher time frame is bullish, we're going to trade in that direction. So the weekly chart, like we said, was bullish, and I just want to see the same thing on the daily chart. So what does that actually look like? I want to see order blocks and fair value gaps get respected. So let's just suppose, let's do it like this actually. Let's suppose this is like a fair value gap, right? So use your imagination. Let's imagine this is a fair value gap here, and it's a bullish fair value gap. I want to see price touch this fair value gap with like a wick and then quickly shoot off, right? Because that would show me that we're bullish, right? I do not want to see, let's just remove this. I don't want to see price consolidate, right? I don't want to see it hit a fair value gap, consolidate, and I definitely don't want to see it start to break all the way down, unless it's like, a liquidity sweep and we quickly reverse, right? So that's just my thinking process. Every time I get onto the charts, that's my thinking process when I do my analysis. And here we are on the daily chart. And the first thing I'm looking at is this wick here. Can you see this fair value gap? Let me just round this out. Right, now don't worry, this is going quite fast because with experience, you're going to get better. So I'm going to give you a high level overview. And, there's only so much I can teach you in a YouTube video. And obviously I don't want this to be 2 hours long, but I'm just giving you my thought process. And can you see how we had, let me mark this out. You see how we had this fair value gap here? Right, and you see how price wicks into it and then aggressively shoots off. I know we get a bit of consolidation here. The reason we get that, by the way, for those who are wondering, is price is essentially generating liquidity. Now, I can get very, very complicated with this. So $3,000 was our higher time frame target for gold, right? This was all-time high. So what What was really going on here is the market makers or smart money was trying to get people to short gold, right? Because no one wanted to short gold at all-time highs. But when price started to drop, lots of people felt confident putting their stop loss orders here, and then price shoots off and smashes those orders, right? Very advanced that, you don't need to know that. But what we do need to know is, first of all, this. You see this fair value gap here? You see how price wicks into it, instantly shoots off. That tells us that we're bullish. But the next thing that's really important, and this is some of your notes, you see this fair value gap here, right? There's part of the fair value gap that's remaining. And you see that there's part of this fair value gap that's remaining. This bit here has been filled by this wick, but there's part of the fair value gap that's remaining. This wick here, so let's just zoom out. This wick here comes all the way down, taps that remaining fair value gap, instantly shoots off. That is very, very, very bullish. Now, why is that really bullish? Because there's two things that's happened. Prices come down to fill out this fair value gap, even more of it. And more importantly, this is actually a liquidity sweep, right? Because you're gonna remember, this is the daily chart. This is the daily chart. So this is the previous day's low. Price comes down, takes out liquidity at this low, instantly reverses off in the opposite direction. I mean, just look at this wick here, right? Look at this wick, right? Price comes down just enough to take out anyone who had their stop loss orders at this previous day's low, and it hits the fair value gap and then massively shoots off, right? I mean, I literally have to zoom out of the chart just to see how fast price zoomed off, right? Very, very, very bullish, right? Very bullish, because what price has done, it's taken liquidity and it's hit a fair value gap, right? Very, very, very strong price action. And this is telling me that gold is super bullish, right? And I've not even looked at any of these candlesticks here, but just by studying this, I already know my direction of the market, right? And I'm still bullish. And I'm not getting confused by any sort of bearish fair value gap here, any bearish order block. I'm not trying to short on the lower time frames. I'm just following the overall direction. Now, the second thing I'm looking for, there's no fair value gap here, which is pretty interesting. This right here is your order block. And if you remember, it was actually also a liquidity sweep of this low, right? But this is your order block here, right? And for those who don't know, order block is just the last down close candle before the up move, right? That's what a bullish order block is. So realistically, this whole thing is an order block, right? This whole thing's an order block, but this is something that's really, really important, right? So the body of the order block, that is the most important part of the order block. That's almost like, it's almost the meat of the move, right? Now, if you study like VWAP volume profile, and don't worry if you haven't, but if you have, you will remember, like, you know, on the side of the charts where it shows you that like normal curve, like that, right? That's what an order block is. That's what the body of the order block is. It's that little bell shape on the volume profile, right? Where there's lots of transactions occurred. That's what the body of the order block is. Now, if you don't know what that means, that's absolutely fine. But I paid a lot of money for a course on that, and I know a few other people have. If you understand that, you'll understand that that's what the volume profile actually is. It's just the body of the order block. It's just where all the transactions were. But if you don't know anything about the volume profile, don't worry. All you need to know is the bodies it's essentially what smart money trading is, right? Smart money, they're the ones who are moving price, right? The wicks are retail, and the bodies is smart money, right? The body is smart money's movement, their footprint into the market, right? That's what the bodies actually are. So the body of the order block is very, very important, very, very significant. And the fact that we haven't touched the body of the order block, that tells me that we're very bullish, because, and this is some of your notes, right? This is ICT chart stuff here. So if you've got a bullish order block, right, like this, and price doesn't even touch the body, but it touches the upper part of the wick, that is incredibly bullish. So what I mean by that is this whole candlestick is an order block, right? This whole candlestick here is an order block. You see this wick here? This is still part of the order block, but you see how price wicks into it, instantly shoots off. That tells us that we're so bullish that we couldn't even tap the body of the order block, right? We couldn't even tap the body of the order block, right? We could only tap the upper part of the wick of the order block, and then we had to quickly and aggressively reverse in the opposite direction. That tells me we are incredibly bullish. So for me, like, just from the weekly and daily, I would already be looking for longs. But of course, top-down analysis video, I want to give you, I guess, the full analysis. And let's see what else we have here. Okay, so first thing I'm looking at is, you see this fair value gap up here. Smart this out all the way up. This right here is our fair value gap. Now, price wicks a bit below bit below the fair value gap here. Now, I wanted to know on the 4-hour chart why that is, because it's a bit hard to see in the daily chart what's actually here, right? We've got a doji candle, and we've just got a bullish candle here, right? We've got no fair value gaps. At this point here, I'm going to get on the 4-hour chart. Now, remember, when we get on the 4-hour chart, we're looking for longs. I want to see bullish price action. I don't want to see, you know, let me show you. I don't want to see like a 4-hour bearish market structure shift. Oh, you know, technically price has gone below an old low, so I have to start shorting. I don't want to see any of that. I'm only looking for longs, and ideally, I'm really looking for liquidity sweeps, because what I want to see is an entry like this, right, where this is a liquidity, this is your liquidity sweep, right? Let's say equal highs, high probability retracement here, right price up, right? That's what a swing trader would look for on the 4-hour chart, and you do the exact same thing on the 5-minute, 1-minute, and 15-minute chart. But don't worry about that. We'll talk about entries in, you know, there's plenty of videos where we talk about entries. Let's get onto the 4-hour chart and see what we can see. Like I said, I've not seen the 4-hour chart, so I just want to show you what my thoughts are. So the first thing I want to see is I just want to see order blocks getting respected. And if we look at this down close candle here, let me mark it out, right? This candle right here. Look at how price respects it beautifully. Look at that. Let me just mark the body out. Right, we just look at that. Look at the wicks. We just tap the order block's body twice, and then we shoot off aggressively and massively in the opposite direction. Let's just zoom all the way out. We shoot off aggressively in the opposite direction. What this means is the order flow, and the order flow just means the overall direction is bullish, right? So don't get confused by the terminology with order flow, liquidity sweeps. Liquidity sweep is just a stop run. Liquidity is just stop loss orders. Order flow is just a direction on whatever time frame they're talking about. And don't get, a lot of people want to sound smart. A lot of people want to sound smart, but you know, it's very, very simple when you start to understand what's actually going on. So this order block's being respected. And this order block here, and again, this is what I always like to see. So let's mark this out. Here's a bullish order block that price doesn't touch. Does not touch it. Very, very nice to see that, right? Because like I said, you know, usually you want to see price hit it, quickly and aggressively move off in the opposite direction. If price does not even touch it, because it's so bullish, that's an even stronger sign. That's an even stronger sign that price is bullish, right? So now that we've studied our price action, we've done all the hard work on the higher time frames. Now I want to look for targets. Where's the most obvious liquidity target? And if we zoom out to the left-hand side of the chart, where is the most obvious liquidity target? And I'm literally telling you guys before I've even spoke about it. This is our obvious liquidity. Now why? Let's just suppose this was bearish, right? So let's just suppose this was a bearish order block. Does that look like price has respected the order block, the bearish order block? No, not at all. Look how deep we've retraced, right? We've almost retraced 75% into the order block, right? That is not bearish at all. If price was bearish, it would tap the order block, almost like it did here. It would tap the order block and then quickly move off like that, right? We don't have that at all. In fact, we've got price respecting bullish order blocks, completely disrespecting bearish order blocks. That's exactly what we want to see. And at this point here, we're just looking for our targets. So at this high here is our liquidity. And for those who are wondering, oh, you know, see, why is there not liquidity at this low or this low here? This is why. This is how we actually know that price is going to go through liquidity, by doing the higher time frame analysis, daily buys, all the boring but profitable stuff. That's how you actually know, and that this liquidity pool is going to get taken, right? That I'm not looking at this low, you know, when price retraces. I'm not going to think, oh, you know, there's liquidity here, price is going to take it. I'm only looking at this high because we've done all the analysis on the higher time frame. So let's just mark this out. So right here is liquidity. And for those who always get confused about what liquidity actually is, it's just stop loss orders, right? It's where the money is, because these large banks, hedge funds can only get into their positions and out of their positions where there's billions and billions of dollars. And on dollar yen, on the 4-hour chart, there are billions of dollars at this high here, right? And at this low here, right? Very, very important. That's a price is going to go and target these highs here. Now, what does that mean? What does this really mean? All of this, you know, analysis that I've told you on the higher time frame that we have all-time highs. What does it actually mean for us as traders? So this is where things get a bit, not difficult, but it's different for every single trader depending on what your trading model actually is. For me, as a 4-hour chart trader, right, as a swing trader, I'm just looking for longs, right? So this would be an example of my entry. Like this, right? Fibonacci, I enter at the 0.705 level. There's no magic in this number. There's no, you know, secret Fibonacci. It's just an easy way of entering it. And I learned from ICT, and this is what he used, so I just stuck with it. This is my entry, my very sophisticated advanced entry. Just in the Fibonacci retracement, and I target a 3-to-1 in a direction. Notice how I don't target the actual liquidity pool itself, because you don't really need to, right? Price could retrace. So for me, I'm happy, and I strongly recommend you either just aim for a 2 or 3 risk to reward ratio in the liquidity direction. You don't have to target liquidity. You don't have to do anything fancy, especially as a day trader. I get people telling me, you know, as a day trader, let's just imagine this is the 1 minute chart, right? All the way over here, and the stop loss is like this, right? This is the 1 minute chart, and they're like, oh, Atif, do I have to target this liquidity pool on the day? No, no, you don't. We just have to trade in the direction. So let's just remove this. And that's what a swing trader would do. You just ride price up. If you're a day trader, scalper, any of that sort of stuff, you're going to get onto your entry time frame, and you're just going to take every single long entry you see. You're not going to take any bearish entry. You're not going to try and short down to this fair value gap. You're just going to take any bullish entry to this liquidity pool here. Okay, here we are on the 4 hour chart, and right here, I mean, I guess the first thing that comes to my mind is you see this order block here. Let's mark this out. Right, this candle here, candlestick here is your order block. This also could be order block. Doesn't really matter. I guess you could have this one too. But for me, I either see this one here, where the first bullish move was, or this one here, right? Doesn't really matter. You can choose any. And let's just suppose you chose this as your order block, right? This would be your order block. And do you remember what I said last time, right? If price can't even touch the body of the order block here, if it can't even touch the body of the order block, and it just shoots off before even touching it, right? So if it just shoots off by touching the wicks, that right there is incredibly bullish. It's incredibly bullish because it's telling us price wasn't even weak enough to touch the body of the order block, right? It could only touch top part of the wick, and it quickly and aggressively shot. That's what we always want to see. Again, on the 4 hour chart, we're even more bullish. Let's just make this super clear, right? So this is the upper part of the order block, right? This is the wick here. Look how we look at this, right? Look how we wick into it, instantly and aggressively move off in the opposite direction. That right there is exactly what respect of an order block, respect of a fair value gap, respect of a breaker block, whatever you want to call them. That is what respect of a PD array is, right? When price comes down, it touches the key level and it quickly moves off in the opposite direction. That's exactly what we want to see. And that there is even more confirmation that we're bullish, right? Even more confirmation that we're bullish Now, this bit of price, I'm just looking at this, I guess live, right? This bit of price action's a bit messy. It's a bit choppy. We took what did we take? $3,000 all the way down here. And then we just consolidated for a bit. A little bit of a retracement. Again, so many people are going to fall for this. They're going to think this 4 hour candlestick closed below this low and this low. So it's a bearish market structure shift. A complete load of crap, honestly. Complete load of crap. Look at all the analysis we've done. Are you really going to start shorting gold all the way up here because of a 4 hour market structure shift? Right? Complete load of BS. I get angry at market structure because so many students message me and they would be profitable, but it's just market structure that holds them back. They get everything right, bias, liquidity sweep, entry, but for whatever reason, they're just obsessed with market structure, and it's not needed. Honestly, it's not needed. The moment I ditched it was the moment I became a profitable trader. Anyway, I'm ranting. What we want to do now is, we know we're bullish on the 4 hour chart too, is we really want to start looking for our entries. Now, for me as a swing trader, what I would look for, ideally, is for price to come up a bit more, make it very clear that we're going to take out all-time highs here, make it very obvious that we're going to take out these highs here, and then just enter on the retracement, right? That's what a swing trader would do. That's what I would do. And because I swing trade now because I'm too busy to day trade, that's what I would look for. And you don't go below the 4 hour chart. I see a lot of people, who go on the 1 hour chart and they make the mistake of looking at the 1 hour chart trying to predict daily buys. You only need the weekly, daily, and the 4 hour chart. And again, you don't need the monthly chart. Like, you really don't. You can everything you need is on the weekly, daily, and 4 hour charts. The 1 hour chart and below, we're not doing any sort of higher time frame analysis. We're just looking for entries. We're looking for entries and targets, right? Very, very important, because so many people say to me, oh, hey Atif, this bullish order block didn't get respect in the 1 hour chart. We don't care about that. We're only looking for entries, right? We did the hard work was done on the higher time frames. We used the higher time frames for our direction, and we used the lower time frames for our entries. So here we are on the 1 hour chart. We've got this giant, probably a news candle. I think this is not. I'm not even sure what this was. We've got a giant bearish candle here. Again, a lot of people think this is a market structure shift. I mean, it's kind of hard to tell on the 1 hour chart because we've got this massive fair value gap here. Just mark it out all the way up here. Huge fair value gap. What I like just from looking at it is I like these order blocks up here. Right, now, price is not likely to respect. Let me just mark all these order blocks here. This whole area here is essentially order blocks. Now, price isn't likely to respect this order block at all. But what it is likely to do it's likely to trade up to it, right? So that gives us just a general target of where price is likely to go. But again, the 1 hour chart, it's not the best, right? It's not the best currently, because for me, this price action is not ideal, right? I want to see clearer, obvious liquidity or fair value gap, something that I can target. So at this point, I get onto the 15-minute chart, right? Like this. Let's just zoom out a bit again, right? So instantly my eyes are gravitating towards this fair value gap here, right? Because price does not like to leave fair value gaps up for long. So let me just make this a bit more clearer. Actually, if you are very eagle-eyed, you'll see a little gap between these two candles here. Now, I don't know if I might have mentioned this months ago, right, in one of my earliest videos, because this is very advanced. This little, let me just mark up this little gap here between this candle and this candle here, this little tiny gap. This is something called a volume imbalance. Now, there's a few people ask me like weird terms that they use to describe it. I call it a volume imbalance because I learned from ICT. If you call it something else, that's fine. I call it a volume imbalance personally. And what it is, it's just a gap between these two candles, and it acts as like a very strong version of a fair value gap. So, you know, I'm sure we all know this is the fair. Let me just mark this out again. Right? I'm not going to actually close this. So this is the fair value gap. Let me just do it. From here to here, this is a typical bearish fair value gap, right? Most people are aware of that, right? A fair value gap, you see it quite a lot in price action. You don't see this volume imbalance much, but this volume imbalance here is a very strong magnet for price action. It's almost like a very strong version of a fair value gap, right? Like a super fair value gap, if that makes sense. So price is extremely likely to at least touch this area. And what I mean by that is price is extremely likely to do something like this, right? So this could be a very good target. And remember, this is the 15-minute chart, right? So, you know, a little scalp or day trade up to this level and up to this fair value gap, that can get you, you know, a 3-to-1, 3K in a day. Like, you don't have to target liquidity all the way up here. You just need a 2 or 3-to-1, 2 or 3 risk reward ratio in the overall direction of the market. That is all you need to be a profitable trader, right? So many people message me saying, hey, Atif, do I need to target all-time highs? No, you don't need to target all-time highs. You just need 2 or 3 risk reward ratio in the overall direction and a 50% win rate. That's all you need to be a profitable trader. That's all you need. And ignore anyone saying you need 80% win rate or anything like that, right? You just need consistency. That's all you need to be a profitable trader, is just consistency. So, right, and obviously, you know, at this point, you would use, you know, your liquidity sweep or whatever entry pattern you use. I'm not going to talk about entries in this video because there's so many videos on channel where I give you entries. So make sure you go check them out if you're unsure about entries. But I just want to give you the overall direction of the market. And at this point, like, we've done the analysis, we know we're bullish, and we're just looking for targets. And for me, this is a clear intraday target. Let's just get on the 5-minute chart and look very quickly, see if we can see anything. Again, you know, you can look at this fair value. I don't want to talk too much about this, but again, always nice to see, right? A little tap of the fair value gap here. I guess, did we tap any order block here? We didn't tap this order block, but we did hit this fair value gap here. But again, you're really looking for your entries here, so you could enter on the fair value gap. You would just miss out on an order block here. You could enter on a fair value gap here. Doesn't really matter. Like I said, the entry pattern is the least important thing. I think price would probably hit this fair value gap too, just by looking at it. But again, at this point, you're just looking for your entries. You can get on the 1-minute chart, whatever time frame you want. This is your target, and this right here. Let me just move the other way. This is your obvious target. Price is likely to hit this too. Is it likely to take out these highs? Is it likely to take out these highs on the same day? Who knows? But the overall direction, the highest probability entries are going long. And at this point, you're just looking for your simple entry pattern. I want to show you something called like SMT diverge. I don't want to make it too complicated, but I want to show you how you can pick the best setups, right? Because if you're trading, let's say 2 pairs, you want to be trading the best setup on the day, right? So what you need for this is you need a very similar market. So gold and silver are very, very similar markets, right? And it's pretty self-explanatory. They're both very precious metals, very, very similar markets. We can compare these two markets. Same thing for, let me just get my watch list up. Same thing for the S&P and NASDAQ, right? Very, very, very similar markets. You can do the exact same thing I'm about to show you on, you know, these 2 pairs. You can also do it on Euro and GBP USD, right? You can do it on the exact same thing, but the markets have to be very, very similar. You can't use, you know, you can't do CAD JPY and the S&P 500, right? You can't use it on that because they're not related in any way, shape or form. But for gold, its sister pair is silver. And I want to show you why silver is not the best trade. So it's still bullish overall, but let's just talk about it. So this is the weekly chart for silver. This is the weekly chart for gold. So just pause the video, look at this weekly chart here. Right, just look at this weekly chart, study it, and then study this, right? You can probably tell gold is by far the most bullish, but why is that the case? Why is gold the most bullish? And what does this price action even mean here? So run the weekly chart. Let's just get back here. Silver right away, it's consolidating, which we never ever like to see. Gold is at all-time highs. Very, very strong, minimal retracements, right? So see this huge bullish move. This is our little retracement. This was your retracement here. This little down close candle like that. Whereas silver, let's just study this bit here. Whereas for silver, where's the path tool? Silver, this is your move here, right? And we still haven't even taken out these highs here. We still have not taken out these highs here. That is not good at all. That's not what you want to see at all. And that tells us that we're nowhere near as bullish on silver as we are on gold. And this is something called SNT divergence, which means, it essentially means that this high here, price had taken this high, right? It had gone up and it had taken this high here. Whereas this high here, the equivalent high, had not been taken, which tells us that we're very, very, we're nowhere near as bullish right now. We still are bullish overall. And this is what a lot of people get confused with. This right here is your bullish order block. The price taps into it. I think it just about touches the body, shoots off, right? But do you notice how when we shoot off, we get loads of these doji candles, long wicks, small bodies, down close candles, not good at all, right? Very, very choppy. And you can just imagine if you were scalping this, just lots of, a little liquidity sweep, another liquidity sweep, slowly moves up, like just slowly grinding up, lots, very difficult to trade, taking out your stop loss, double liquidity sweeps, not good at all, eventually gets your take profit. If you are in a trade, it probably take you like 2-3 hours just to hit take profit. It's not good at all to trade. And you can just tell by looking at the weekly chart, with all these large doji candles, the fact that we've not taken out this high, that silver, is not ideal to trade. So we're just going to daily chart. And again, I'm doing this live, so I have no idea what price is actually looking like here. Again, so my eyes instantly see this candle here, the last up close candle before the down move, that's your bearish order block. Like that, right? You see how price, it's almost respecting it, isn't it? Right, we have these little doji candles in there, and now we're starting to, I guess, not reverse, but retrace. And what you really don't want to see, and I always say this to my students, this is like, you really don't want to see this in trading. We haven't touched this order block, we have touched this fair value gap. What that means is price is almost respecting both sides. And this is like the analysis of death. If you see this, you want to avoid this pair, or whatever pair this is, at all costs. And what that is price has respected the bearish order block, and it's respecting these bullish fair value gaps, these bullish order blocks. So it's respecting both sides. And you never, ever want to see that in price action, because if price is respecting both sides, what you're going to get is you're going to get this. You're going to get consolidation. It's going to respect some order block here. It's going to respect some bullish one here, a bearish fair value gap here. Just going to consolidate for ages. You're going to get a double liquidity sweep where it sweeps both sides, consolidates, does nothing for ages, comes out, comes up. You think it's going to go up, and it goes right back down. And it's just awful to trade. You do not want to trade that at all, right? So that is something that will save you so much money right there. If you see price respecting bullish fair value gaps and bearish fair value gaps on the daily, weekly, or 4-hour chart, avoid that pair. Just avoid the pair, find another currency, and your win rate will skyrocket massively, and you will avoid so many unnecessary losers, so many break-even trades, so many choppy trades, and yeah. Anyway, I'm rambling on for quite a bit here. Let's just get quickly on the 4-hour chart. Let's just clean these charts up and get on the 4-hour chart and just see what we can see, right? Because I'm not going to get below the 4-hour chart for silver because it's not really needed. Again, my eyes instantly see this. This almost looks like a liquidity sweep to me. Just mark this out. See this? See these almost triple lows here. Remember, this is the 4-hour chart, so this is very, very significant. Right? This isn't the 1-minute chart. This is a very significant time frame. See how price wicks down? It's not instantly reversed. It's not instantly reversed, which, again, that's what you'd expect for a choppy pair. Hasn't touched the order block either. Again, not ideal. It's not even touched this bullish fair value gap. Not ideal at all. These wicks here, let me just show you. See these almost, what the fuck is this? See there's like 4 triple highs here are respecting this order block here, this bearish order block here, right? Look at that. Look at that. Beautiful, isn't it? Look at that. Tap, 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 tap. Moves down. This bearish fair value gap. Look at this. Also being respected. Almost like a liquidity sweep. price is like respecting all these order blocks, we're just going to consolidate in between, right? We're just going to consolidate in between, right? Like this. Just consolidate where you hit this again, we'll come back down. Liquidity sweeps here, come all the way back up. Just messing around, and you do not want to trade that all. And what that really means, let's just zoom all the way out. What that really means for you as a trader, just clear all this. It means you want to avoid silver, don't trade it, don't look for shorts, because overall on the higher time frame, it is bullish, but it's slowly going to move up, right? It's going to slowly move up very lethargically like this, very lethargically and slow. You want to avoid silver, don't look for shorts, don't look for longs, just don't trade it. And what that really means is look for gold, look to trade gold, and only look for longs, because gold is in a bull market. It's easy. I mean, look at all these candlesticks here, how strong and aggressive it is. It's one-sided. You've got everything on your side, higher time frame, liquidity sweeps, everything you could ever need. And you only want to be trading gold. And if you do the equivalent analysis on GBP USD and EURUSD, you'll see the exact same thing. I think off the top of my head, I think NASDAQ is essentially the equivalent of silver in this case, and gold is like the S&P 500, where NASDAQ has been very terrible and the S&P is very clean. So yeah, but you'd have to double check that, right? And that'll be a good like homework assignment, right? Go through the S&P 500, go through the NASDAQ, and just see what you think, right? But for top-down analysis, what you want to do, start off on the weekly, go to the daily, go to the 4-hour chart. Those 3 time frames, this is very important, those 3 time frames give you your higher time frame direction, right? You've got your bias, your higher time frame bias on the weekly, daily, and 4-hour chart. You do not get your bias on the 1-hour chart, or 15-minute chart, or 5-minute chart. You only get it on the higher time frames. Once you've got your direction on the higher time frames, you get onto the lower time frames, right? The 1 hour, 15-minute, 5-minute, 1 minute, or even the 4-hour chart if you want to be a swing trader, and you look for your entries. Now, the entry I always say, and don't worry if you don't understand this, it's just a liquidity sweep. So let's say you're bullish, which we are on gold, and let's just suppose this is let's say the 5-minute chart, right? You want to see price come, take out an old low, quickly shoot off, leave some sort of fair value gap here for you to enter, put your stop loss here, and then target a 2 or 3 risk reward ratio. And if you do that, and you get a 50% win rate, you will be a profitable trader. You will be a consistently profitable trader, right? All you need is a 2-to-1 and a 50% win rate to be a millionaire. And for those who don't know, if you're not following me on Twitter, you should do. But if you are, you'll remember, I met this trader and he had a 45% win rate and he made 117K in a month, right? And I think his win rate was 2-to-1, that's 2.4 risk reward ratio. And he made 117 grand in a single month. And at that moment there, I was like, oh shit, I need to sort my life out, because I was obsessing over win rate. It's not needed. A 50% win rate and a 2 risk reward ratio can make you a millionaire. Congratulations if you got this far, because that was a very difficult pair to determine daily bias on. But if you understand that, congratulations. Now, I'm going to give you a bonus tip, like I said, which I normally give to my paid students. And yeah, this is a golden nugget, and it's the little things like this that make you profitable. People always ask me, like, hey, what's the difference between YouTube and your paid program? It's the little, I mean, you probably understood it in this video, right? The little things that I mentioned, that's probably what clicks in your mind, right? It's probably not the liquidity sweep, fair value gap. It's probably the little analysis that, when a price comes very close to an order block, but then shoots off, that's even more bullish, right? Little things like that is what makes you profitable. But anyway, I'm rambling on. What you can do, right, is let's suppose you're on the weekly chart and you're like, oh, okay, look, it's taking out liquidity here, it's respected the bearish fair value gap. I'm not really sure where price wants to go. What you can do is you can get the futures contract up, and we can look at the dollar index. So if we click the dollar index, remember, we're trading USDJPY. What does that really mean? It means the US dollar against the Japanese yen. Now you might think, well, where am I going with this? We are trading one currency against another. So there's a few things that can happen. If the dollar is bullish and the Japanese yen is bearish, price is going to go up. If Japanese yen is bullish and dollar's bearish, USDJPY is going to go down, right? And if one is bullish, let's say dollar is very bullish and Japanese yen consolidates, dollar yen will go up. And similarly, if the dollar consolidates and JPY is very bullish, USDJPY will go down, right? Hope that makes sense. That's what it really means. If we zoom out here, the overall trend is bullish. Now, if we look at the dollar index, this is the US dollar on the weekly chart. The overall trend on the dollar is bullish. Now, again, you might be confused, like, okay, how do I really know if it's bullish, right? Because because of this, order block. Price isn't really close to any liquidity pool. It's retracing quite a bit. It almost took out this low. How do I really know? This is the golden nugget here, right? Right here, if you type in US30Y on TradingView, you'll get something called the United States 30-year government bond yield. Now, it sounds complicated. All you need to know is this is the interest rate for the US government's debt, right? So, like bonds and stuff. This is the US government's interest rate. And this is something for your notes. The higher the interest rate, the more valuable the currency, right? So the higher the interest rate, the more valuable the currency is. And it makes sense, right? If you can get 4.673% investing in the US dollar compared to, let's just suppose, 2% in the UK. I know that's not actually true, but let's just imagine that was. If you're an investor, obviously you're going to invest in the US dollar, right? Now you might be wondering who's investing in dollars or currencies. Big banks, big hedge funds, pension companies, those who have money. Not us, but those who actually have, a shit ton of money, they're investing in currencies, right? And the only thing they're looking for is interest rates. So with a dollar, you've got a very, very good interest rate. And I don't want to get too much into macros, but if you probably understand that the Japanese, interest rates, even negative, are like zero, right? So it's not valuable at all. You don't need to know that. All we need to do is look at the price action. And if you look at this price action, I hope it's pretty obvious where price wants to go, right? Here's your here's liquidity. Here's your liquidity sweep there. Here's your respect of the order block. Let's mark this out. Here's respect of your order block there. Here's your liquidity pool up here. Right? Well, that's pretty obvious, right? Look, listen, it might not be obvious at first, but if you watch that full 2-hour trading course and you binge watch a lot of videos on my channel, this will become second nature, and I recommend that you do that. Just get it over and over and over again into your head, because or your subconscious mind, for those who know. Those who know what I'm talking about will understand that. But here we go. So price comes, takes out liquidity here, comes up, little retracement, nothing major, not towards these order blocks. Again, comes up, makes it very clear that we're going to go for this high here, right? No order blocks being respected here, no bearish order block. Very clear that price wants to come to this high. Here's your retracement into an order block. What's price likely to do? Go up. What does that mean? What does this really mean as traders, right? Let's just remove this. If the US interest rate is going to go up, right? If it's likely to go bullish and it's going to take out this high, what does that mean? Interest rates are going up. What did I tell you? That means the dollar is likely to go up, right? Because it's higher interest rate, it's more valuable, right? Overall perspective for the dollar is bullish, right? We are bullish overall. So this right here is just a retracement before we continue up. Now you might be wondering, okay, that's cool, interesting. Why do I care about this? This is why we care about this. This is the dollar. This is what this index actually is. This is the US dollar against all the major currencies, right? So GBP, USD, yen, all that sort of stuff. This is the dollar against all the major currencies. If we scroll down, I mean, you don't have to scroll down. If you type in 6J on your charts, right? If you type in 6J into your trading view charts, you'll get the Japanese yen futures. That is the exact same thing, but for the dollar, right? So this is all the currencies against the Japanese yen. Essentially, it's how valuable is the Japanese yen, right? Whereas this is how valuable is the dollar. This is the dollar against all the major currencies. This is the yen against all the major currencies. Now, you remember from school, spot the difference. If we look at the dollar index, right, just pause the video, take a screenshot, just study this price action here. Right, let's just zoom out. Study this price action here. Study this price action here. What direction is this going in? Clearly bearish, right? What direction is this going in? Bullish, or at worst, consolidation. And do you remember what I said to you? If the dollar consolidates and the Japanese yen is bearish, what does that mean for USDJPY? It's going to go up. Right, remember what I said to you. So, at worst, this is going to consolidate, but we know by looking at the bonds that this is actually going to go up, that we're actually bullish. So if we get Japanese yen, and we just study the price action, I mean, for years and years, this drop was around 2021. We've been bearish, 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 and if we look at the price action, right here is your liquidity sweep. I mean, this stuff works, right? I'm not making this up. This stuff actually works. This is gold dust right here, which I'm giving you. This right here, this works. Liquidity sweep here, price comes all the way down, barely respects the order block. I know we do respect an order block all the way down here, but come on, guys, is that really respect? What's actually going on? Like we said, this is just a retracement here. Again, look at that. It's almost like I work for the central bank. Look at this. Here's the 50% level. Look at price. It hits it, wicks down, and now it's starting to reverse. This is just allowing smart money traders to start selling, right? Selling. So what does this really mean? Japanese yen is likely to do this. Continue downwards, take out this low, like that, continue downwards. And dollar is likely to go up, like we said, because of the bond yields. Dollar's likely to go up and eventually take out this high. What does that mean for USDJPY? Right, what does that really mean? Let's get all the way down here. What does that really mean? It means we're likely to just we've really done our retracement already. It means we're likely to just do that, right? You guys understand that? And if you zoom out, you can see from the previous price action that I've shown you, that's exactly what happens, right? Remember, the yen was very bearish, the dollar was bullish or consolidating. What happened? USDJPY shot up. And again, this is around 2022, 2021 is when we start getting that big bullish movement on USDJPY. The exact same time when the yen starts to drop. So quick and easy. Oh no, I say quick and easy for a minute. It's a hard way, but once you get used to it, you can just mix and match currencies left and right. Because what you really want to do, and we're getting very advanced here, what you really want to do is you want to match strong currencies with weak currencies, right? So in this case, the Japanese yen is weak, dollar is bullish, right? So you've got strong currency against a weak currency, which is an easy trade. And let me give you another example, just a quick and easy trade. This is what I do over and over and over again. So if we get onto 6N, so this is the New Zealand dollar futures, right? This is, again, the New Zealand dollar against all the currencies. Right, here's liquidity, here's your liquidity sweep, here's the obvious low that we're going for. Completely, if you understand liquidity, you know we're definitely going for this low. And again, there's another low right here. No order book's being respected. We're choppy, we're consolidating. Remember this price action, right? Just close your eyes and make sure it's in your head. Now remember this, right? You see the difference. You see the complete difference between this. This is a lot more. This is pound futures, by the way. 6p. See how GBP, I shouldn't say GBP actually. See how the British pound futures are a lot more bullish than the New Zealand dollar futures, right? What does that mean? If we've got bearish and we've got bullish, what does that mean? It means GBP NZD is going to be bullish. So we get onto GBP NZD. Look at that. And you can see like my looking for an entry. Let's just remove this, right? Look at that. Almost like clockwork, isn't it? Almost like clockwork. Just by looking at the futures contract, you can play matchmaker, and we zoom out. There's liquidity on like the daily and stuff. I don't want to bore you guys, but this is what I do, and you can see literally what I do every single day. And as a day trader, you don't want to be trading any of these like exotic currencies and stuff. But if you're a swing trader, this is a gold mine. This is an absolute gold mine because you can just get into easy trades, right? I mean, it's obviously not the best here, but even here, you could probably take this trade, and by this trade, I mean, you could probably take this trade and become have a winner more often than not, right? And this is a poor trade, like in terms of price action, because I don't want to get too much in depth, but GBP AUD is actually the better setup here, right? So this is the better setup. But anyway, I'm rambling on. That right there was a very golden nugget right there that I gave you. So if you didn't understand that, don't worry. All I'm really trying to tell you to do is if you're struggling with the if you're struggling with the bias, using the currency futures can help you break the deadlock, so to speak, right? So very important. And
okay, so what is liquidity actually, right? We hear about this all the time. Liquidity. What actually is it? It's simply highs and lows, right? Highs and lows. Most importantly, on the higher time frames, so the daily and the 4 hour, key highs and key lows will have lots of orders there. Now, what do we mean by orders? We mean stop loss orders. Now, why is that important? Stop loss orders will have billions of dollars, right? Remember, we're on the daily chart for gold. There will be billions of dollars at this low and this high, right? People shorting will have their stop losses here, and people going long will have their stop losses here. And by people, I'm talking about smart money. Now, smart money are large banks, large institutions, hedge funds, all that sort of stuff who have billions of dollars, and they move the market. We don't move the market. Day traders don't move the market. Scalpers don't. It's them with billions of dollars. They move the market. And in order for them to actually get their orders filled, and what that means is for them to actually get into a trade, is they have to do business at key highs or key lows, right? That's it. That's what liquidity really is. So these markets will only move for higher time frame liquidity. And this is so important because so many people understand, key highs and key lows, but then they look at, the 1 hour key high and they think that's the most important thing, when they don't realize there's a key low on the daily chart that price is going for. And right, so we're on gold, we're on the daily chart, and we're going to look for the most obvious high or low that price is going to go for. And I hope it's pretty clear. Maybe it's a bit bigger. We're going to go for this low here. Now, why are we going to go for this low? Let's mark it out. there's lots of liquidity at this low. We know it's a key low. We know that gold's been in the bull market, right? So people have trailed up their stop losses here, here, and here, right? Some people might have had it here, but here there's so much liquidity. There's so many orders here for smart money to target. And another thing you can do whenever you're unsure whether price is going to go for this low is just look at the order block, right? So we're going to look at this order block here. So I'm going to mark out the order block, which is just the last down close candle before the up move, like that, right? You see how price like aggressively comes into it and wicks deep within it. That right there isn't really respect of an order block, right? Because what you would expect if it was a valid order block and we were still bullish, you'd expect price just to tap it with a wick and then quickly move off, right? But we don't have that. We have a massive aggressive down close candle. And when you see candles like this and you see the candle closing into the order block and wicking deeply, that shows you there's complete disrespect of the order block. Right, we're not bullish in any way, sense, or form, right? Complete disrespect of this order block, and we've got key liquidity here. Now you might hear this be called a liquidity pool, right, or whatever. The terminology is not important, but what we know is that for gold, currently, we're going to go for this key low. This key low, there's been no respect of the order block, and we've got this obvious key low. Now, what does this mean? Because so many people get this wrong. This right here is your daily bias, right? So we've already figured out daily bias just by using liquidity. We've used liquidity and we know our daily bias. Now that means when we get on the lower time frames, we're only going to look for shorts on gold. We're only going to look for shorts, right? So many people, they do this and then they start looking for longs on the lower time frames because it looks bullish. You don't do that. You only look for shorts. But, and this is so important, when we get in the lower time frames, we're going to look for liquidity sweeps. Right? We're going to look for liquidity sweeps. Now I'm going to explain more about that when we get onto the lower time frame.
Okay, so liquidity is simply stop loss orders, and you'll find liquidity at major highs and major lows on any time frame that you trade. But the higher the time frame, the more important the liquidity is. Now, this is what's super important about liquidity. Liquidity is only there to give you the direction of the market. That's the only reason we care about liquidity. It's not an entry pattern. It's not a technique. It's just a tool, right? A concept to help you predict where price is going to go. Because let me tell you this, after 5 years of trading, once you got the direction right, you are 90% of the way there. All you need is a simple entry pattern. So liquidity gives you the direction of the market. Once you got the liquidity right, you will know 9 times out of 10 where price wants to go. So you will find liquidity at major highs and major lows. And what happens with liquidity, especially on the higher time frames, either the 4-hour, daily or weekly chart, is this will act as like a magnet for price action, literally pulling price towards it. So what that looks like is this will literally magnetize price towards it, right? On the lower time frames, just pulling price towards it. And there are so many entries that you can get, right? There's so many easy entries that you can get on the 5-minute, 1-minute, 15-minute, even the 1-hour chart, riding price up to key liquidity pools, right? And if you're ever unsure about what liquidity, price wants to go for on the overall time frame, this is the technique, this is the tool. So make sure you pay close attention to this. You get onto the 4-hour chart like you are now, and let's just imagine you get on the chart and this is what you see, right? This is live trading right here for you. You've got to just ask yourself, which high or low are we likely to go for, right? And it's pretty obvious in this case, but it's not always going to be obvious to you, right? So make sure you do pay attention here, right? You're going to come on the charts and you're like, are we more likely to go for this low all the way down here, this major low here with stop loss orders, or are we more likely to do this? Are we more likely to come up and take out this high here, right? Hopefully, pretty obvious, at least in this case, that we're likely to take out this high, right? But that is your technique for finding the liquidity, finding the daily bias. It's to just get on the 4-hour chart and ask yourself which major high or low is price likely to go for, and that right there will give you daily bias, weekly expansion, weekly bias, whatever you want to call it. That is how you determine daily bias. You don't need to mess around with multiple time frames, the monthly chart. Just get on the 4-hour chart and ask yourself which high or low is price likely to go for. But now that we've got our liquidity, we know that this is our target, right? So when we get onto the lower time frames, we are only going to trade in this direction. We are only going to look for longs to ride price up to this target here, because that is the highest probability entry.
Now, for those who struggle, there are multiple different terminologies, for saying liquidity. So liquidity, the exact same thing that liquidity is stop loss orders, right? That is all that liquidity is. It's just resting stop loss orders. And, the way that we know that stop loss orders are going to be there is because there are traders who still trade support and resistance, right? There are still traders who trade support and resistance. Now, at this level here, and we're on gold, we're on a daily chart, right? At this level here, this key daily high, and in fact, this is all-time highs. Lots of people are shorting gold, right? They think this is this is you know, an all-time high. They're going to put their stop loss orders here, and they think that when the price comes all the way up, it's going to bounce off this level and continue down, right? That's what support and resistance traders think, right? Now, if you've been trading for any length of time, you know that's a complete load of BS. It does not work. It does not work. And, you know, I spent years trying to trade that way. It does not work at all. Now, what we do know, though, is there's going to be lots of liquidity, right? Lots of stop loss orders at these key highs and key lows. And now what we want to do as liquidity traders is we just want to target that, right? We just want to target stop loss orders, or we just want to target liquidity, right? It's that simple. That's all we need to do. So all we need, right, in terms of liquidity, is we just need to see on a higher time frame, so in this case, the daily chart, where price actually wants to go. Now, this is something you'll note. Price will move for where the money is, right? They'll move for where the money is. Now, the money is essentially where people's stop loss orders are, because smart money who move the markets, who have billions of dollars, they can't just trade on the 5-minute chart or the 1-minute chart. They can only get in and out of their positions at key highs like here and key lows like here, right? Where there's going to be lots of stop loss orders. That's the only way smart money, so like Goldman Sachs, JP Morgan, and hedge funds, pension funds, the only way they can get in and out of market is at key highs and key lows when there's lots of liquidity, right? Lots of stop loss orders. So price will move to these highs and to these lows. Now, why does that matter for us as traders, right? The only reason it matters is it gives us the direction of the market. Right? It's so important. The only reason we look at liquidity on the higher time frames is it gives us the direction of the market. That's all we need, is a direction. If we've got a direction, you're 90% of the way there. Right? That's going to be so long, and most of your time in trading shouldn't be spent on finessing some sort of entry. It should be spent on getting the direction right. Because if you can get the direction right, you know, you're literally 90% of the way there. All you need is a simple entry model. Because look at this, right? Look at this. All you needed was a few like good longs here, right? Getting, let's say, a free risk to reward ratio. You would have made a lot of money. A lot of money. This is the overall direction of the market. Can you imagine you trying to short in this, right? Imagine shorting it against all these up close daily candles, right? Low probability, but trading with the trend, trading where price wants to go to liquidity, is the highest probability in all trading. So right now, we know that price is bullish. We know that price wants to move for stop loss orders on the higher time frame, because that's the only way that smart money can get in, right? That is why, you know, price isn't bullish because, let me show you, it's not bullish because there's been some sort of market structure shift, right? Because the body here has closed above this high. That is not the reason why the market is bullish, right? You got to think, is Goldman Sachs really, right? Or, you know, is any big bank, big investment bank, are they really going to buy and sell based on a market structure shift? Oh, you know, we've had a market structure shift on the 4-hour chart. We've got to sell now. No, that's not what it is. It's all for liquidity, right? It's all for liquidity. So here we are on the daily chart. We know there's lots of stop loss orders here, and price is going to move for those stop loss orders. So all we need now is to go on the 5-minute chart or any lower time frame and just trade in that direction.
You're going to use the 15-minute chart, right? And you're going to zoom out and you're going to look for the most obvious highs or lows. Now, I hope it's pretty obvious, and I've marked it out for you. I hope it's pretty obvious. We've got liquidity here, here, here. We've got almost triple highs on gold, right? There's lots of liquidity. There's lots of stop loss orders at this high here, right? So we just mark this out. Lots of liquidity, which is just another way of saying stop loss orders. So don't get confused by the terminology, right? That's all liquidity is. It's just stop loss orders, right? Right here, there's so many people shorting gold, hoping, you know, this is all-time highs, right? And they're trying to ride gold down, and they see a bit of bearish movement here, so they're even more confident. As price comes up, more and more people are shorting, hoping, right? They're hoping that price is going to come all the way up and bounce back down. Now, if you've been trading for any length of time, you'll know that price does not bounce at random support and resistance levels. What will happen is, if we are bearish, price will come up, it will take out these stop loss orders here, and then it will start to reverse. Or what could happen is, if we're bullish, right, if we are bullish, price will just smash right through these levels, right? If you notice, in both scenarios, both bullish and bearish scenarios, price is going to move up towards this key high, right? Now, what we do at that level, whether we reverse or continue, doesn't matter. All we need to know is that price is going to move towards this key level here, right? Because there's lots of stop loss orders. That's all we need to know. Now, you might be asking, why do we need to know that? Because that gives us the overall direction of the market, right? That's the only reason we use liquidity. Very, very important you understand that. We don't use liquidity for anything else apart from giving us the direction of the market, right? Liquidity is not for your entries. Liquidity sweeps, which we'll talk about later on, that is what you use for your entries. So right here is our liquidity. That tells us that we're bullish and that we're going to take out these highs, or at least we're going to trade in that direction. So what that means is, when we get on the 1 minute or 5 minutes to look for our entries, we're only going to look for longs, right? Very, very important that you understand that. Lots of people, they don't understand why we actually use or care about liquidity. The reason we care about liquidity is because it gives us the direction of the market. That's it. That's the only thing we care about is a direction. Because if you don't have a direction when you're trading, you're gambling. You need to have a direction. You need to have at least, some logic or confidence of why price is going to go in that direction. So we know lots of stop loss orders here, lots of liquidity, very, very likely that we're going to trade in that direction.
Okay, so what is liquidity? We hear all this talk about liquidity. What actually is it? It's simply, where are the stop loss orders, right? That is it. That's all liquidity is. You've got to ask yourself, where are the stop loss orders? Because these markets will only move for where the money is, right? Very, very important. Make sure you write it down that these markets will only move for where the money is on the higher time frames, because these markets, I'm sure everyone knows, are moved by big banks, big insurance companies, hedge funds. They're the ones who move markets, right? If you want to move euro dollar, the S&P, any major market, even crypto, you need billions and billions of dollars. And the only way these institutions with billions of dollars can get in and out of their positions are at key highs and key lows on the higher time frame. That's where all the money's going to be. That's where all the stop loss orders are going to be. And the reason there are stop loss orders, and we all know this, is because of support and resistance, right? We all heard, that price at this level here is key resistance because we've got a high here and high here, high here, high here. So what they think, or what traders think, that price is going to come up like it's done here, and it's going to bounce off, right? It's going to bounce off this level and go down. Now, if you've been trading for more than 3 months, that's a complete load of BS. It does not happen. What actually happens is that price smashes through these levels, right? The only reason we have equal highs here is just to generate liquidity, right? Just to get people to start shorting the euro dollar so we can smash right through it. That's the only reason these highs are impact, right? So that is what liquidity is. That is literally all liquidity is. And the only reason these markets are going to move are for these higher time frame stop loss orders, right? Because there are hedge funds that have their stop loss orders here, right? And you might not believe it. You might think, oh, doesn't everyone know about liquidity? Trust me, there are so many hedge funds. There's essentially 2 ways of looking at it. First, there are hedge funds that have literally a 10% win rate or below, and then they aim for massive trends. They're going to hold for years. As day traders or swing traders, we don't want to hold for years. And they're looking to capture, massive trends over years, and they're happy to get, lose 9 times out of 10, and in the one trade that they do win, they hold on for years, and they make like a 20 risk reward ratio. That's one type of hedge funds. The other type of hedge funds, and you've probably heard this stat where it's like 90% of hedge funds underperform the S&P 500, and they make the majority of their money from churning. Now, what that means is the hedge fund makes their money from getting in and out of positions, right? They make all their money from commission, not from actually making a return for the investors. Now, I'm not going to talk too much about that, but trust me, I worked at a big bank, and these big banks will literally rob investors of their money. They make all their money from commissions. They don't care whether their investors lose or win. They don't give a shit. They make all their money from. But anyway, all you need to know for trading is that at these highs here, there is so much liquidity, there's so much stop loss orders, and that the market is going to move for this, right? That's all we need for liquidity, right? All liquidity does is it gives us the direction of the market. So hopefully, clearly, we're bullish and we're looking to target these highs. So we're going to look for longs on euro dollar until we take out this high, right? And then we'll see what price does, right? If price just smashes right through, then okay, we'll look for the next liquidity over here. But if we get some consolidation like this, we'll just wait a few days and then see what price it does. Because they want to go up, or is it going to start reverse, right? That is all we need for liquidity. Liquidity gives us our direction. Now, most people, maybe if you look at liquidity, you might understand that. You probably understand that. Now, hopefully that makes sense, right? Markets will only move for higher time frame stop loss orders. It's the only way big banks and big, insurance companies, hedge funds can get in and out of their position. What liquidity does is it gives you the direction of the market. We know the direction, we know we're bullish, but that alone is not enough to make money, because for years I could get the direction right, but I couldn't make money. And the reason why is because I didn't wait for the liquidity sweep. So I'm going to get a lower time frames. I'm going to show you what a liquidity sweep is and how you can enter on the highest probability trades possible.
Okay, so the first thing you need for liquidity is you need to use a higher time frame, right? So you've got to use either the 4-hour or the daily chart, because this gives us the direction of the market, right? The first thing we need to do before you get onto the charts, or as soon as you get on the charts, is you need to have a direction. You need to figure out where is price most likely to go. Is it likely to be bullish, right? Is it likely to do something like this, enter on a retracement and take out some sort of high? Or is it likely to do this, right? Is it likely to be bearish like this? Or third of all, which not many people talk about, is it likely to just consolidate? Because if it's likely to consolidate, don't trade, right? That takes some discipline not to trade. But for the direction of the market, the only thing you need to use is liquidity, right? You don't need to use breaker blocks, order blocks, fair value gaps. You don't need any of that. You don't need volume profile. You just need good old liquidity. Now, liquidity, for those who don't know, it's essentially where would people put their stop loss orders, right? We're on the higher time frame, we're on gold,
And like, this is a major market. It's probably one of the biggest markets in the world, right? Apart from like the S&P 500 and euro dollar, gold is probably one of the biggest markets in the world, right? There are billions and billions of dollars. There's huge institutions all looking at the 4-hour chart and the daily chart, and at this key high here, right? There are people shorting gold because they think it's at, you know, at all-time highs, and then there are people who want to buy gold. Now, for those who are going to ask me, and I personally think we're going to hit 3,000 on gold. That's just what I think. But nevertheless, what we need to use for the buyers or for the direction of the market is we just need to look for where is the most obvious stop loss orders, right? Now, I hope it's pretty clear, right? It's pretty clear. We're in a bull market. Let me just zoom all the way out, actually. We're in a bull market on gold, right? You never ever short these things. It's pretty obvious that price wants to go to this high here, right? It wants to go to this high here because there's lots of people shorting. There's lots of people who use support and resistance, right? Who think that price is going to come up to this level and then bounce off like that, right? Now, if you've been trading for any amount of time, probably about more than 3 months, you'll know that is a complete load of BS, right? If price was to reverse, what it would actually do is it would do that, right? It would go up slightly. It would take out anyone who had their stop loss orders here, which is the liquidity sweep, and then it would reverse, right? And you probably had this all the time when, let's say, you're using support and resistance and you thought price was going to go down. It does, but it takes out your stop loss and then goes, right? Because these markets only move for stop loss orders, and they're highly, highly manipulated. And me and you as retail traders, we're not supposed to be profitable. This is not for us. This is for the big boys. So these markets are highly, highly manipulated, and they run purely based on liquidity. But we've got the direction of the market, right? We know where the higher time frame liquidity is. We know where the, you know, where the market actually wants to go. We're going to expect, you know, price to move up like that, and then we want to enter any sort of retracement on the lower time frames, right? We expect price to come up and then break through this level. So now that we've got the direction of the market, right, all we're going to do is we're going to get in the lower time frames and we're going to look for our entries. That right there is so important. I'm not on the 5-minute chart trying to predict where price is going to go. I'm on the 4-hour chart and daily chart looking for the higher time frame liquidity, the bigger picture. I've got my direction now, so I don't care what the 5-minute or 1-minute chart's doing. I'm only going to look for long. So very, very important that. Very, very important. You don't need to use lower time frames for your bias. Use the higher time frames for your direction, and then use the lower time frames for your entries. Now, where there's lots of money, that's what we call liquidity, right? Liquidity means how easy it is to get in and out of a position, right? And it's easy to get in and out of a position because there's lots of stop loss orders. There's lots of money there. So right here, we've got triple highs for gold. We've got one high here, and we've got a third high here, right? Lots of people are going to think, right, like price did here. They're going to think, right, that price, because price came down, and when it comes up again, it's going to come down. They think this is really good resistance, right? They think this is really good resistance, support and resistance. We all try this as beginner traders, and we weren't profitable with it because it does not work, right? It does not work. That's not why the markets move. The markets only move for liquidity. And if you'll notice, you might be saying, oh, well, it worked here, right? It worked here. Price came up and it bounced off and went down. The only reason price did that was to get more and more people shorting gold, right? If you just zoom out on the daily chart, we're a massive bull market in gold, right? So the only reason price did that was to get lots of people to start shorting gold, right? So we know at these levels here, there is so much liquidity. Let's just move this down. There is so much liquidity, right? There's so many stop loss orders. There's so much money, right? There's billions and billions and billions of dollars worth of stop loss orders, all at these highs here. So what smart money are going to do? Smart money, this entity that actually moves price, what they're going to do is they're going to force price up to these highs. And then once price is in these highs, they can start buying and selling. Whatever they want to do, they can get into that position because there's billions of dollars there. They cannot get on the 1-minute chart and just press, you know, buy and sell like we do, right? They don't have the luxury of doing that. They can't just buy randomly. They can only buy at certain areas because they put so much money to move into the market. So the only thing we use for liquidity, right? This is all we need to do for liquidity is we just need to target it, right? We get on the higher time frame, we find the obvious, like the next obvious liquidity pool, and we just target it. We use it to give us our direction for the market. That's it. It's that simple. We don't need to do anything crazy about liquidity. So right here, we know, right? We know that price is going to come up and it's going to come and take out these highs here, right? Price is going to come all the way up, like it's on here, all the way up, take out all these stop loss orders, and then we don't know what price will do next. It could continue up like this, right? Continue up and then go to all-time highs, or what it could do, right? What it could do is price could come up, take out these highs here. Smart money can get into their position, and then it could consolidate. It could reverse a bit and go down. Like, who knows what can happen? But what we do know is that at key highs and key lows, smart money will move price there so they can get into that position, right? That's what we know, right? So that's the only reason why these markets move. So we've done our liquidity analysis on the daily chart. We know that price is bullish. We know that price is going to come all the way up and it's going to take out these highs. All we need to do now is get on the lower time frames and look for a simple entry pattern, right? And then we combine the entry pattern with a liquidity sweep to give us the highest probability trade possible. Okay, so what is a liquidity sweep? A liquidity sweep in its most basic form it's a fake move, right? It's a stop run in the opposite direction of the higher time frame, right? So let me say that again. A liquidity sweep is a fake move and it's in the opposite direction of the higher time frame, right? The move is designed only to take out stop loss orders. So what that means is when you're in a bullish market, like we are for gold, and this works on all markets, by the way, but for gold, we're bullish. And to determine if we're bullish or not, you need to use liquidity on the higher time frame. Now, in this video, I'm not going to discuss that because I have so many videos on the channel discussing that. So make sure you check them out. But assuming you're bullish and you've got the higher time frame direction, the higher time frame bias, whatever you want to call it, what we want to look for is suppose price comes up, price moves down, retraces down. Lots of people are going to put their stop loss orders here, thinking it's safe, and then they're going to buy any sort of dip. Right, price comes down, it just takes out their stop loss orders here, and it quickly moves off like that, right, in the opposite direction, and then it retraces, allowing smart money traders, those in the know, start entering around here, right, at a fair value gap, order block, and optimal trade entry. Anywhere around here is where all those traders in the know who are waiting for this liquidity sweep, for this fake stop run, they're all entering around here. They're buying, and then price massively moves off. Great to take profit, right? That is what a liquidity sweep is when you're bullish, right? And this must have happened to you so many times. It happened to me all the time. I forget the direction of the market, right? But I just couldn't make money. And I couldn't make money because I'd have my stop loss here, price would come down, it would take out my stop loss and then quickly go to my fake profit. And if you've been trading for a while, that must have happened to you so many times. And it's the most frustrating and annoyingest thing in trading. And the reason it is because you haven't waited for a liquidity sweep, right? So we have to wait for a liquidity sweep. And if we don't wait for a liquidity sweep, you're going to be the one getting swept. Because that's what a sweep of liquidity really is, right? Stop loss orders here got swept and then price quickly moved on. Now, on gold, run the 1 minute chart. And let me just say this, because I have to say this every video because you will keep asking me this. First of all, it works on every single market. So gold, Forex, indices, futures, crypto, stocks, penny stocks, any financial market that has candlesticks, this liquidity and liquidity sweep will work, right? It's rooted on deep logic and that actually moves the market. And second of all, it works on all time frames. But what I will say, this is so important, the lower the time frame, the more significant, or at least the more often you'll get liquidity sweeps. So the more entries you'll get, right? That's what I'm really saying. So run the 1 minute chart for gold, and what we're gonna do is I'm gonna make this a bit more bigger. You see this move here, right? You see, like, we're bullish on gold. You see this move here? Let me make this so clear. You see this fake move here? Price quickly moves down just to take out these stop loss orders here, right? Anyone who trailed up their stop loss from here to here, any stop loss orders that were here got taken, right? Price just came down. It quickly, aggressively moves off in the opposite direction. That right there is our liquidity sweep. And then any retracement after the liquidity sweep is high probability. And then we just ride price up, right? We just ride price up. That is essentially what a liquidity sweep is in its most basic form, right? And that's what we see in price action again and again and again. You see that over and over again. And you don't, like, listen, I'm an ICT charter student. I've been through literally all of his videos. You don't need anything apart from this, like liquidity sweep and then any entry after retracement. You don't need a market maker model. You don't need inversion fair value gaps. You don't need any of that. You don't need any of that. You need simple trading that you can trust. So this is all we need, right? This is all we need. This is our fake stop run. So let me just make this clear. This is our liquidity sweep right here. Right here is our liquidity sweep. So let me write this out inside so it's super clear. So liquidity sweep, and we always wait for this before we enter, right? Liquidity sweep. You can call this a stop run as well, right? So that makes it easier for you. Let me just make this very clear, because some people are just gonna be like, and they just don't like the term liquidity, right? You can call this a stop run. Just make this so it comes down like that, right? You can call it a stop run, whatever you want to call it. Liquidity sweep, stop run, and what it is just a fake move in the opposite direction, purely designed to grab stop loss orders, right? So it could be a liquidity sweep or a stop run. The exact same thing, as long as you understand what it actually is. And the reason why this works is for smart money, this entity that has billions of dollars to get into the market. And there's two things they need to do. They get the majority of their orders on the higher time frame, right? On the 4 hour, daily, weekly. That's why we look at the higher time frames for liquidity, because that's what smart money does. The second thing they do is they don't, like, the humans don't trade the lower time frames. Their algorithms, their bots trade the lower time frames. This is why some of you might be thinking, okay, how many stop loss orders are there realistically at this low, right? Like, who's going to put their stop loss orders in? Me and you probably won't, but algorithms are coded to put their stop loss at highs and lows, right? Like, at lows here, highs here. They're coded just to do that, right? So there are algorithms that literally, they have a 51% win rate and a 1 risk reward ratio, but over like 1 million trades. That's a lot of money, right? But these are algorithms that just, they're coded to fire trade. So smart money, their algorithms are designed just to take out stop loss orders, and then buy, right? So what that means is, let me just move that there. What this means is we've had our liquidity sweep, we've had price quickly move off in the opposite direction. And this is so important. People ask me like, oh, is it a liquidity sweep around here? What if it keeps going down? No. It's only a liquidity sweep when price massively moves off in the opposite direction. That is when it's a liquidity sweep. I don't know, like when price comes down here, I don't know if price wants to come all the way down here. Only when price massively moves off in the opposite direction do I know it's a liquidity sweep, right? Hope that makes sense. Only then do I know it's a liquidity sweep. And then I'm just looking for any entry. Any entry afterwards will do, right? And this is so important, is we wait for a liquidity sweep. Right, we wait for a liquidity sweep. And this is so important because so many people, they don't understand what a liquidity sweep actually is, right? We're bearish, we zoomed out, we saw the higher time frame trend like this, right? We know the trend is bearish. We just want to follow the trend like this. So we're looking for a bearish liquidity sweep, right? Now, a bearish liquidity sweep would look like this. It would look like this, right? Suppose we've got some high here, right? We know there's going to be lots of stop loss orders here because people are going to go short. Our price comes up, it takes out this high here where stop loss orders would be, and it quickly moves down like that, right? And then we want to enter on a retracement. That right there is the highest probability of short entry you'll get in all trading, right? And then you just reverse it when you're bullish and stuff. You've got your stop loss there, price comes up, takes out the stop loss orders, quickly moves in the opposite direction, and then we enter on a retracement, right? That's what we need. And if you get that on the 15-minute chart, that is such a money maker. It's honestly such a money maker. And I don't know if you can see, but right here, we have that exact same thing. So here we've got essentially London tie, right? Textbook, London tie, loss of liquidity at this high, price moves down, and then during New York, price comes up and takes out this stop loss orders here. So let's mark this out, right? Like this, price comes up, it takes out this high here, London's high, where we know lots of stop loss orders are going to be, and then it starts to move down, right? Starts to move down like that, right? So the first thing we look for is our liquidity sweep. Right, so let's mark this out. We look for our liquidity sweep like this, nice and easy. So we're just going to mark this out. Liquidity sweep, right? And here's the thing. Any entry after a liquidity sweep is so high probability, and it's probably the highest probability you'll get in all of trading. Right?
Okay, but there's also another part of liquidity that most people get completely wrong, and that is liquidity sweeps, right? Liquidity sweeps are so important because for years I understood liquidity, right? I could get the direction of the market. I knew that price would come and take out these highs or these lows where there would be lots of stop loss orders, but I couldn't make money with it. I could not make money with it, and it was all because of one simple thing, liquidity sweep. So what is a liquidity sweep? A liquidity sweep simply is a stop run, right? So think, where would people have their stop loss orders? Right? And I'm just going to show you this on the daily chart, but it's not that important. It's just, I just want to give you an example, right, before we get in the lower time frames, because it's so important on the lower time frames. Because if you don't enter, if you don't wait for a liquidity sweep before you enter, you're going to get your stop loss hit. So can you see, remember this is the daily chart, can you see this low here, right? This low here is going to have lots of stop loss orders at it because it's a previous day's low, right? People are buying gold, and we're in the bull market, people are buying gold, they're going to move their stop loss orders up to each of these lows on the daily chart. And then what does price do, right? Let's study this. What does price actually do? It comes all the way down, it wicks all the way down, just enough to take anyone who had their stop loss orders here, and then shoots up aggressively in the opposite direction. Like I literally have to zoom out of the chart because we've moved all the way up. It shoots all the way up, and where's it going towards? This liquidity pool here, right? That means that smart money, they force price down just to take out stop loss orders before quickly shooting off in the opposite direction. When you see that in price action on any time frame, right, when you've got liquidity and you've got a liquidity sweep and price shoots off in the opposite direction towards that liquidity, that is one of the strongest signs in price action. That is one of, by far, the strongest sign you can get in price action, at least that I've discovered in 5 years. And this is my exact trading model, because once you've got liquidity and you've got your liquidity sweep, all you really need is your retracement. Enter on any entry pattern you like around here and ride price up.
Okay, so run the lower time frames now, and I'm on the 1 minute chart. You can use this, the liquidity sweeps will be on literally every time frame, but the lower the time frame, the more liquidity sweeps are. That's why I'm on the 1 minute chart, because let's say you're on the 5 minute chart, you can't see liquidity sweep. Go to lower time frames and wait for one. Now, what liquidity sweep is we know the higher time frame direction. Like we know, we looked at liquidity is all the way up here, right? So we just want to trade in this direction. Right? We just want to look literally any sort of opportunity to get long, right? We want to buy the dip essentially. But that alone isn't enough, because how many times has this happened? Like how many times have you tried to buy the dip, like on a fair value gap, order block, VWAP, and EMA, and the price comes down, it takes out your stop loss here, this is where your stop loss is, and it goes straight to your take profit. Like that used to happen to me all the time, and it's so annoying. Now the reason why that happens, and this held me back for 4 years, this is the reason why I couldn't make money, because I had no idea at liquidity sweep. The reason why is we need to wait for something called a liquidity sweep. So what a liquidity sweep is, I'm just going to show you for this blue line here. So let me just show you here, right? Let's imagine this is where people would put their stop loss orders. What you're going to do is you're going to wait for this stop loss here to get hit, and then you're going to wait for price to show you that it's bullish, and then we're going to enter on a high probability retracement here, right? Because if price came, take out this stop loss, very, very unlikely that price can come all the way down and take out this stop loss again and then go that way. And I'm going to show you what that looks like in the candlestick charts. But let's just remove this, and then what we're going to do is we're going to the 1 minute chart here. So if you can see, if you remember what I just showed you up there, right now we know we're bullish, right? So this is the most important part. We've got the direction. We're not even looking for shorts. We're not looking for any opportunity to get short. We're just looking to get long, right? And we're waiting for a liquidity sweep, right? Almost like a snagger. We're literally waiting for it. We know what we're looking for, and we're waiting for it. Lots of people, and if you don't know what a fair value gap is, that's fine. Lots of people are going to start selling when price gets this fair value gap because they have no idea about liquidity on the higher time frames. But you guys, you watched the video, you know exactly what liquidity is. So we know we're bullish, and what's actually happening is at this low here, lots of people, as euro goes up, they're going to be buying, and they're going to put their stop loss right here because that's what everyone says. Say stop loss, put it at the old low. So at this low here, lots of liquidity, and what we see is price has gone off all the way like that. It comes down. Look at these wicks here, right? Look at the wicks here. And I'll make it a bit more obvious. It just wicks below this low here, taking out anyone who had their stop loss orders at this level. Anyone who had their stop loss around this level here, right? If price wicks down, takes out their stop loss, and then quickly and aggressively moves on, right? Literally so aggressive. I have to zoom out of the chart, right? It goes all the way up there in the opposite direction, right? That right there is what we call a liquidity sweep, right? That is what a liquidity sweep is. Now I'm going to show. Let me just get this really obvious, right? See this wick here? This wick here is your liquidity sweep. At this low, people have their stop loss orders, right? Because price went all the way up. This wick literally pokes down, takes out anyone's stop loss orders who are here, and then massively and aggressively moves in the opposite direction. Now, the reason that happens is because smart money, right? Big banks, big hedge funds, their algos, so an algorithm, right? Trading bot is coded to enter at these stop loss, right? So at key highs and key lows, as soon as price comes, but I think it's like, I don't want to get too much into that, but it's something to do about the standard deviation or like Fibonacci or whatever. But as soon as price takes out these old lows or old highs, they're buying. They're buying because they know people are going to have their stop loss at this low, at these highs. The price comes down, takes out their stop loss. This is where my stop loss used to be, where your stop loss used to be. People will think, oh, there's an order block here. I can enter on this order block. Price comes, takes out your stop loss, and then goes in the opposite direction. Now, what we want to do, if you remember what I showed you on, with the blue line, so what we want to do is we've got our liquidity sweep, we've got the higher time frame liquidity all the way up here. All we want to do now is we want to enter on some sort of retracement. So we've had our liquidity sweep. This was the liquidity sweep. Price has clearly shown us that it's still bullish, right? It's not just consolidated for ages around here. It's not gone like this. It's shown us clearly and aggressively that price is bullish. At this point here, we want to start to enter on our trade, right? We want to look for some sort of retracement anywhere, at this point here. Okay, so we're in the lower time frames, and most people understand what I just said in the higher time frames. They know we're bearish, but they always go wrong in the lower time frames. Now, why did they go wrong? Because they're not waiting for a liquidity sweep. Now, what is a liquidity sweep? And a liquidity sweep is, a liquidity run, liquidity graph, whatever you want to call it. It's the exact same thing. What it is we know we're bearish on the higher time frames. We've done the hard work, which is always on the higher time frames. We know the actual direction of the market, and we're looking for any reason to get short. Now, we're waiting for some sort of key high to be taken out because we're bearish. Now, why are we waiting for that? We know, right, and you've probably had this loads of times where you might have shorted here, right? You might have shorted at this order block, let's say. So this order block, the last up close candle for the down move, you might have put your entry right at this body here. You would have had your stop loss maybe up here, and you would have targeted maybe this wick's low, like a 3-to-1 or something, right? How many times have you had the bias right, the direction right, but price literally will come down, go straight through to your stop loss, take out your stop loss right here, and then quickly reverse? Like, how many times does that happen? Because that used to happen to me all the time for years. Like, I would get the bias right, I knew exactly where it was going to go. Price would come, it would literally wick up, take out my stop loss, instantly reverse. The reason why that happens is because you're not waiting for a liquidity sweep. Now, what is a liquidity sweep? We know at this high here, there's lots of stop loss orders here. Lots of people have gone short on gold. They know from the higher time frames that we're bearish. So they've got the stop loss orders here. And I'm going to mark this out, right? Because this is so important. When price comes all the way like that, right? See this wick here? See this wick? So let me make this more obvious. See this wick? You see how it points up? Literally comes out, takes out this high. Let me make this a bit more clearer. Right, comes up, takes out this high, instantly reverses. Look how aggressively we reverse. That right there is your liquidity sweep. right? It pokes up, takes out the high, quickly reverses. That is your liquidity sweep. And this is really important. We don't know it's a liquidity sweep until around down here, right? Because once the wick comes and takes out the high, it is possible that price could have had a little retracement and continued up, right? But when we see a wick that just points up, just takes out that high, and then quickly reverses sharply, that right there tells you you've got a liquidity sweep, right? And what we really want to do is we want to enter on that retracement after the liquidity sweep. So I'm just going to mark out the liquidity sweep here, because you always, and this is so important. If you're a day trader, scalper, or even a swing trader like I am, you want to wait for a liquidity sweep before you enter, because if you don't wait for a liquidity sweep, you're going to get swept. So I'm going to mark this out, liquidity sweep, right? And this is probably the second most important thing. Once you've got the bias, you need to wait for a liquidity sweep. Otherwise, you're going to be getting your stop loss taken. You're going to be right with the bias, and then you're going to lose, and then you're going to get angry, you're going to revenge trade, and you're going to keep losing and blow your account. All these things happen to all traders, and I don't want you to go through that. So we wait for the liquidity sweep, wait for the wick to take out the high, and then we're just looking to get short, right? And this isn't a video about entries. We've got loads of entry videos on the channel and stuff. But now the second part of liquidity, and this took me another year, right? I understood liquidity like fairly well. You know what I just did in the higher time frame. And lots of people do understand that, and they can get the direction right, but they always botch the entry. Now, when I say botch the entry, what I mean is they know we're long and they're looking for any sort of retracement, but price will come down, take out their stop loss orders, and then quickly move to that take profit, right? Like, how annoying is that? That used to happen to me all the time. All the time, I'd get the direction right, price would hit my stop loss, and then quickly go to my take profit. And it all happened because of one reason. I did not wait for a liquidity sweep. Now, a liquidity sweep is the most important thing in trading for your entry, right? If you have an entry pattern, you need a liquidity sweep, because without a liquidity sweep, it's very hard to make money. Very hard to make money consistently, because you'll just keep getting stopped out and it'll be so frustrating for you. But what a liquidity sweep really is, it's a fake stop run. So right here, got a lows here. You see these wicks? I mean, it's very clear. Right here, let me just move this down. Right here, there are going to be stop loss orders. Lots of people are trying to buy gold, right? It's at all-time highs, or it's going towards all-time highs. People are going to be buying, trailing their stop loss orders here, and then here, and they keep pricing, keep going up and up and up, right? So right here, there are stop loss orders, right? Now, it might not be like billions worth of stop loss orders because we're on the 5-minute chart, but there are enough stop loss orders for smart money to target them. Now, do you notice, right? Do you notice how price moves off, right? So with bullish, price comes down, it just about, look at the wick, right? Look how it just wicks below it, picks out anyone who has their stop loss orders here, picks out any stop loss order, and then quickly shoots off. That right there is a liquidity sweep, and that is the highest probability entry in trading, right? And once you've got your liquidity sweep, like we have here, any sort of retracement afterwards is so high probability. I mean, you ride price up in the higher time frame and liquidity direction. That is the highest probability trading model in all of trading. And it doesn't matter on the retracement what you enter on. You could enter on a fair value gap, order block, optimal trade entry, or even an indicator, right? It really does not matter. As long as you've got this entry pattern where you've got a fake stop run, right here, it's a liquidity sweep. Now, liquidity sweeps are so important because so many people misunderstand it. A liquidity sweep, let me just write it, it's a fake, the fake move, right? That's what it really is. It's a fake move and it's a stop run like that, right? That's what a liquidity sweep really is. Let's just make this a bit smaller. The thing is with a liquidity sweep is it only matters when we know where price wants to move on the higher time frame. That's why we did all the work on the daily chart, right? Because if I never looked at the daily chart, I'd have no idea if this was a liquidity sweep or if this bit here was a liquidity sweep. I'd have no idea. I'd have no idea because I'd be trading completely blind. But because we did the work on the higher time frames, and this is why I say we always need one higher time frame and one lower time frame. I think the daily chart and the 5-minute are so easy. If you just combine those two, it's so easy. Or if you really want to be more active, you can have the 4-hour and 5-minute, or the 4-hour and 15-minute, or even the daily and 15-minute. But you've got to have a higher time frame for liquidity and a lower time frame for your liquidity sweep and then trade.
Okay, so now for the fun part, we've got our direction. We know that liquidity is all the way up here on the higher time frames, right? That's where our direction is. That's where price is most likely to move. So I'm now on the 1-minute chart, and you can use it. Someone's asking me, hey, why are you on the 1-minute chart? You can use any time frame for your entries, right? So as long as you've got the liquidity, you've got the overall direction. It doesn't matter whether you use the 1-minute, 5-minute, 15-minute chart, or even the 4-hour chart, right? When I swing trade, I use the 4-hour chart using the exact same logic. So it doesn't really matter what time frame you use. The only thing that matters is that you've got the overall liquidity, you've got the overall direction, and then that you wait for a liquidity sweep, which I'm about to talk about now. So what a liquidity sweep is let's say we've got the overall direction, which we have, right? We know we're bullish, right? We know that price is going to go towards these highs here, right? We know the direction. Now, most people most people, most traders, they can understand, at least they can identify where the obvious liquidity is, right? They can understand, okay, we're bullish, you know, there's key highs that price is likely to go towards. But what they get wrong, and what I got wrong for about 2 or 3 years, is I didn't know where to put my stop loss. Because what would happen to me is price would move up towards these highs here. On the retracement, there'd be, let's say, a fair value gap or an order block. I would buy around here, put my stop loss here, thinking I was nice and safe. Price would come down, it would take out my stop loss, and it'd go straight to my take profit. Or even worse, it would give an even better entry right here, and then go straight to my take profit, right? That happened to me consistently for years and years and years. And I could get the liquidity right, I just couldn't get my entry right, and I never made any money, and I lost so much money, and I went through so much pain. So I want to save you, I guess, the pain of going through that. And the way you solve this issue, and what I figured out, is you need to wait for something called a liquidity sweep. Now, a liquidity sweep is just a fake move designed to take out stop loss orders. So in this scenario here, we're bullish, right? We're bullish and we're targeting this liquidity ball here. This liquidity, these stop loss orders here. This move here, you see how price comes down, it takes out stop loss orders here, and then quickly moves off in the opposite direction. That right there is a stop run. Now, the reason we know it's a stop run is because, first of all, we know the overall direction of the market is bullish, right? That's the first thing you need to know. You need to know the overall direction, right? So we're only going to look for longs, right? We're forgetting any, opportunity to go short. We're only going to look for longs, right? So price coming down, price being bearish, first of all, we're going to think, hang on a minute, price is actually bullish on the higher time frames. Why is price coming down? Is it to either give us an entry or is it a liquidity sweep? So price comes down, takes out the stop loss orders here. Now, I don't know at this point here, I don't know if price is going to reverse or not. So I'm not buying here. Now, some people, they will buy as price is taking out these stop loss orders here. That is called a turtle soup. So you might hear people saying, oh, turtle soup and stuff. Trust me, do not look at that at all, because that is very, very advanced, right? If you're buying stop loss orders, you need to have a lot of experience. Even I, with like 4 or 5 years of trading, it's very, very difficult, because you're going to have some big balls to start buying stop loss orders, hoping that price reverses, because if it doesn't, you will lose money very, very quickly. So I always say to my students, wait for liquidity sweep, wait for the price to move off in the opposite direction, in the overall direction, telling you that you are right. Right? That's how we know it's a liquidity sweep. I don't know it's a liquidity sweep here. I only know it's a liquidity sweep as price starts to move off in the opposite direction, and ideally starts leaving fair value gaps. So I'm going to show you what that looks like on the 1 minute chart. Okay, so now that we've got our liquidity on the 4 hour chart, we get onto our entry time frame. Now, whatever time frame you trade doesn't matter. And for me, I'm just going to show you an example on the 1 minute chart, but it's not enough, and this is super important. It's not enough just to buy the dip, right? We can't just buy a random retracement like this, hoping that price will respect some sort of fair value gap, order block, and continue upwards to liquidity, because that is not how these markets move. That is not how these markets move. I don't know if anyone's actually told you how these markets move, but when we're bullish, what price actually does is it will come up, it will come down, it will take out some old low where there's lots of stop loss orders, right, taking out all of retail traders. Then it will move in the other direction, and then and only then will it give all of smart money traders, those in the know, high probability retracements to enter on right here, and then it will shoot right off, right, to take profit, right, just like this. So there will always be, super important, there will always be a stop run. There will always be a stop run before you can enter, and that is referred to as a liquidity sweep, which you might have heard. But what most retail traders do is they'll buy, and this was me for years, they'll buy the dip, right, they'll buy as price comes down, they'll put their stop loss at this low, and they'll target all the way up here, only to see price come down and take out their stop loss, right? That is not what you want to do, right? Because you'll see that all the time in price action. Instead, what you want to do is you want to enter after some old low has been taken, right? So you want to enter here, put your stop loss at the old low, that was a liquidity sweep, and then target your 2 or 3 risk to reward ratio.
Because it's not enough to get the direction right. I had the direction in the market. Probably within a year in trading, I had it nailed down. I could always, 90% of the time I get the direction right, but I made no money because I didn't know where to put my stop loss. Right? I had no idea where I was going to put my stop loss orders, and it always got hit. So what we're going to do is we're going to wait for something called a liquidity sweep. Now, it'd be easier for me to show you on this little blue, line chart, what liquidity sweep is. So we know we're bullish, and let's suppose you're bullish, right? Typically, you want to buy the dip, right? You want to buy any sort of retracement here, whether it's a fair value gap, order block, VWAP, any sort of indicator, anything telling you to buy. You want to buy the dip, right? You want to buy price when it's cheap. Now, what probably happens, and this probably happens to you all the time, is that price has come down, it takes out your stop loss right here, and it quickly moves straight to your take profit, or it gives you another entry and goes straight to your take profit, right? The reason it does that is because you didn't wait for something called a liquidity sweep or a stop run, right? That is what a liquidity sweep is. It's a fake move designed to take out your stop loss orders and, whoever else has their stop loss orders there, and then quickly and aggressively move off in the opposite direction. So that is what we wait for, because once you wait for a liquidity sweep, any entry after that is so high probability, it's insane. And right here, and this is so important, this is probably the most misunderstood thing in all trading. Right here, we have something called a liquidity sweep, right? Now, a liquidity sweep is essentially, now we know that we're bullish, we did the work on the higher time frames. Essentially, let's say we have some bullish price move up, right? Price comes down, it just wicks down, takes out your stop loss, and then instantly moves up in the opposite direction. That right there is a liquidity sweep, right? It was a fake move. This move here was a fake move designed just to take out stop loss orders. And then any retracement after a liquidity sweep, right, is super high probability. So we want to enter any point around here, right? Very safe place to put your stop loss here because it's already taken out stop loss orders. Then you want to ride price up. That is what liquidity is as like a basic overview. And it's literally the best entry in all trading, right? I've traded for years, 4 years. I'm an ICT chart student. That is the best entry in all trading. It took me at least 2 years to figure this entry out. And then it took me years to actually master it. But nevertheless, here we are, right? So right here is a liquidity sweep. You see, let me just make this clear. Right? You see how price comes down, it takes out an old low, quickly and aggressively moves off in the opposite direction, right? That is our liquidity sweep. And then any retracement after that is high probability. Now, you might be asking, let's remove this. You might be thinking, oh, well, there's probably not much, not many people are going to have their stop loss orders at this amount. Now, you gotta be right. There might not be many people who have their stop loss orders here, but there are so many algos that are coded to put their stop loss at key high, or not at key highs, at any high, any swing low, right? They're coded just to keep buying, keep buying, selling out, highs and lows. That's, 70% of the volume of these markets are all algorithmic, right? So there are algos that are literally 51% profitable. Their win rate's 51% and they get a 1 risk to reward ratio, but they make like 1 million trades in a day. So, over the long run, or over 1 million trades, they are like quite profitable. But anyway, at highs and lows on any major financial market, like gold is one of the most highly traded markets. There are spots are at every high and every low. So there is liquidity here, right? Now, it's not as much as like the 4-hour or daily chart. There is enough liquidity here for it to be a liquidity sweep. So right here is our fake move, right? Fake move. Look at this wick. This wick only comes down to take out this low, and it instantly and aggressively moves off. It's literally gapping, right? We've got a gap here. Price is literally gapping up just to move off, right? That is our liquidity sweep. That is the best thing we want to see in trading, especially when we're bullish. So we've got our liquidity sweep. Put that down there. We've got our liquidity sweep. Price quickly and aggressively moves off in the opposite direction. Now, I don't look at marking structure, but if you do, here's your marking structure shift. All right, let me just mark this out. I don't look at market structure because I think it's a bit of a distraction, because liquidity is all you need. The moment this body essentially, or this body really, once it closes above these highs, that's your market structure shift. I don't look at it personally, but if you want to, there's another thing that will add to the probability. And all you need is any sort of retracement afterwards. Once you've got this whole framework of liquidity on the higher time frame, that gives you your direction. Liquidity sweep on the lower time frame, price has moved in the higher time frame direction. Any entry pattern after that, any entry pattern on the retracement will do. So I'll give you literally 3 entry patterns here. So we've got a fair value gap. It's just the gap between this candle here and candle there, right? The gap between this candle and this candle. That's a fair value gap. You could enter on that fair value gap, right? That could be your entry. You could, look at this, right? Look how it's all beautiful, isn't it? Look at how the bodies are like holding in the fair value gap, right? Look at that. And then the wicks are like poking out, right? This look for your nose. The wicks do the damage and the bodies tell the story. The body is smart money. The wick are retail, right? These are retail traders randomly buying and selling for no reason because they only look at the 1 minute chart. Smart money are the bodies, right? The body is smart money. So yeah, it's pretty interesting how like the price was just holding in that fair value gap. Like it wicks out, but the bodies are in the fair value gap. But anyway, doesn't matter, right? Another entry pattern can be this little gap here. Now, for those who know, this is called a volume imbalance, or at least I call it a volume imbalance. Now, this has so many different names. Someone on Twitter was asking me about this. I had no idea what he was talking about, but he was actually talking about this. Does not really matter. You very rarely get this, right? You very rarely get this entry pattern here. So, I would personally say not to have that as your entry. But what I would say is this right here, this volume imbalance, where it's just, see these 2 wicks and there's no bodies overlapping. I'm going to try not to put my cursor right because it does that thing, but you get what I mean, right? You get what I mean? See these 2 wicks overlapping because because there's only wicks overlapping and there's not like a body that there is for fair value gap. That means that volume imbalance is a stronger draw than a fair value gap. Now, what that means is that price is more likely, it's more likely to come to this volume imbalance than it is to a fair value gap, right? A volume imbalance is a lot stronger than a fair value gap. It's a lot more important. So that's what I think. It's a bit interesting, but it's not really that important. The last entry, and I think this is probably the best entry, just by looking at the price action, if I was on the chart, is you see this order block here. The last down close candle, the full up move is your order block. Now, there's two ways of entering on the order block. The first is the wick, right? So people could, let me just mark this out, right? People could say this entire thing is the order block, right? And then they could enter right at the wick high and put their stop loss. You'd have to put your stop loss at liquidity sweep low, but they would say that's an order block. That's true. You can enter on that. Me personally, I always like the bodies of an order block, especially when it's quite a big body. The only time I'll ever use the entire order block candle is, let's say it's a doji. Let me try and draw a doji out, right? Let's say you've got like this can be awful in it, but let's just imagine like this was like the body, right? The body was like here, a tiny little body, and it had like, it's got huge wicks. Like if it's a huge doji sort of candle, then okay, by all means, use the whole thing. But right here, the body is the most important part. So for me, I'm just going to enter like this, right? On the order block body. Now, for your stop loss, it's so important. The stop loss always has to be at liquidity sweep low. Always has to be there. Because I always say this, but I'm going to keep saying it so everyone watching this is profitable. Very, very unlikely, right? At price, because price came down, just take out stop loss orders and then moved up. Very unlikely price is going to come down, take out stop loss orders again, where it's already done that. The whole point of price coming down here was just take out stop loss orders. It's very, very unlikely that price is going to come all the way down, take out your stop loss, and then move all the way up, right? That is the power of waiting for a liquidity sweep. Because how many times, this used to happen to me for years, let's say you were bullish on the higher time frame, you kind of understood liquidity, right? You kind of understood, okay, I just target highs and lows on the higher time frame. It's pretty easy. You get the direction, right? Then you'd buy as price comes against you. Price would take out your stop loss and then instantly go to take profit. The reason that happens, and it's so annoying, is because you don't wait for a liquidity sweep. So once you wait for a liquidity sweep, you're good to go. So any entry pattern will do. Stop loss always at liquidity sweep low. And then the take profit. For me, I always say this, I just aim for a 3-to-1. I never aim for more than it. You can, if you're on the 1 minute chart, I guess you can, right? And if I was on the 1 minute chart, just looking at this price action, I would aim for this high here. Right? I'd aim for this high here, right? Lots of liquidity at that high. And let's just aim for this high. What do we get? We get about almost a 5 risk to reward ratio. Now, I'm not advocating like to always, aim for like a 5-to-1. But, if you were doing like a prop run challenge or passing a week, not the worst idea in the world, especially when you've got all this framework behind it. Higher time frame bias, lower time frame liquidity sweep, and obvious strong liquidity. You can do it. And this is so important, right? The only thing I'll say, right, is do not aim, let me just remove this. Do not aim for the key daily target, unless it's really like, if it's likely for the day. Do not aim on the 1 minute chart to try and target this, right? Because it's insane. You don't need to do that. The only reason we use the daily chart or the 4-hour chart for liquidity is to give us a direction, right? That's it. Now, if price was all the way up here, then yeah, by all means, just target around the 1 minute chart. But price is all the way down here. Don't hold for like, weeks trying to get to this position. You don't need to do that. You just need a free risk to reward ratio. And for me, because I think that's like the golden zone, but with this strategy here, you can get an insane win rate, absolutely insane win rate. And the good thing is, if you're on the 1 minute chart, I mean, you can almost find a setup every day. Now, I'm not saying to trade every day, obviously, but you could find a setup almost every day. And you don't have to. And so many people get this wrong. They try and finesse the entry. They ask, hey, what breaker block do you use? Do you use inversion fair value gap? ICT's released this new PD rate. You don't need any of that. All you need is a liquidity sweep and a simple entry. And I'm going to show you, and I guess I'm just going to show you a few entries actually, just because. And there's 3 entries that I always vouch for. If you watch this channel and for a while, there's 3 entries which I love. I call them the 3 golden entries, and they are the optimal trade entry, the order block, and the fair value gap. Now, I'm literally going to give you each one an example of each one on this bit of price action here, right? If that makes sense, because any entry pattern will do. But for me personally, I just take a Fibonacci retracement or an optimal trade entry, which is I put my Fibonacci, and to get the Fibonacci, right, all you need to do is come to the top left here, right, and then on your indicators, just look for Fibonacci retracement, not this one, Fibonacci retracement like that. And if you press start on TradingView, you can get it here, right? Same thing with the risk to reward tools here. So for those who are asking, some people still do ask me this. You want a long position, you come on the projection part, long position, short position, press the star, right, the star here, and then you'll get it here, right, like that. So nice and easy. Anyway, so what you do, right, is you enter like this, right? You enter like this, right, like that. That's your entry. You put your stop loss at the low, and then you target a free risk to reward ratio like this, right? You guys get the point. Now, some people are going to be asking me, they're going to be asking me, oh, and I'm going to keep saying it, oh, you know, should I put my stop loss here? Should I put it here? Should I put it at this fair value gap here? At the, you know, the low of the order block? You always put it at the low where the liquidity sweep was, right? That's the whole point in waiting for a liquidity sweep. Like, why would we wait? Keep asking yourself this. Why would we wait for a liquidity sweep? Right? Why would we wait for a liquidity sweep if we're not going to put our stop loss low at the liquidity sweep? Like, what's the point in that? Like, why would we put our stop loss here? Right? The whole point of waiting for a liquidity sweep is that we can put our stop loss order, or at least our stop loss, in the safest place possible. Very safe, because very unlikely, if this was really a fake move designed to take out stop loss orders, that pricing would come all the way up here, come all the way down again, just to take out more stop loss orders, and then move on. Very, very unlikely that's going to happen, right? But that's why we always put our stop loss orders right at the low of the liquidity sweep, right here. We always put it there. We don't, you know, we don't try and get some crazy risk to reward ratio. We put it at this level. It's nice and safe. And then I'm a big believer in this. Just aim for a 3-to-1, right? You don't need a 4-to-1, and you can aim for a 2 risk to reward ratio. But for me, I just aim for a 3 risk to reward ratio. And let's just replay this, right? I know a lot of you are going to want to just see what it looks like in live price action. So imagine this is price action live, right? You're on the chart. This is what I'm looking for. Now, some people might be asking, oh, you know, there's another little swing low, swing high here. Look, listen, I can tell you from years of trading, just ditch market structure. Please just ditch market structure. I have so many students, right, who understand liquidity. They finally understand liquidity sweep, right? And they're like, they see price action like this, and oh yeah, you know, oh, I'm going to enter. And then they don't enter because there's some sort of market structure shift on the 1-minute chart, or this swing low was taken. Honestly, just completely forget about market structure. I know it might be hard and stuff. Just forget about it. It's a waste of time. It's a complete waste of time. Goldman Sachs aren't buying because there's a market structure shift on the 1-minute chart, right? They only buy because of liquidity on the higher time frame, and we just trade that direction. So ditch market structure. So it's so many people DM me. I'm not even joking. So many people DM me. They get this right. They would have made money, and they keep telling me, oh, I didn't take the trade because I was afraid to lose. I was afraid because of this market structure shift. Ditch market structure. All you're going to do at this point, set your limit orders here, right? So you set your limit order, you enter at the 0. Let me make this very clear. We enter at the 0.705 level. This level here, right? That's all we care about from Fibonacci. This level here, we're going to enter, and you can remove the 0.5 level. You can remove all these. All we care about is the 0.705 level. Then what you're going to do is you're going to put your entry here, stop loss here, take profit here, and you're just going to wait. If price, and people are going to ask me this, if price breaks this high, or it comes down here, right? So it breaks up this high. Then I'm going to put my Fibonacci at the new high, right? If that makes sense. So what I would do is I'd move the Fibonacci like that, right? Nice and easy, right? So it's not nothing crazy, but we're just going to wait for retracement. So let's just play price action like this, right? Like this. And this is real trading. I want to give you guys a real example. Not every trade is going to come like this, right? And go straight up, right? If these gurus are lying to you and they tell you that, let's just read right here. This is a real trade. You're on the 1-minute chart, right? You've got a bit of retracement. Lots of people are going to panic here. They're going to panic here. But I just let price do its thing, right? We hit take profit. Let price do its thing. It's the 1-minute chart as well, guys. So literally, this is like an hour, right? You're risking 1K, you're going to make 3K in an hour, right? Who's angry with that? So, this is real trading, guys. Real trading. You're going to have some consolidation. Price going to chop around for a bit before it hits your take profit. Key thing is, don't get emotional. Don't start taking partials. For those who ask, I don't use partials. I do move my stop to break even once price breaks this level here. So once price comes up to here, I move my stop to break even like that, right? Like that. But I still my free was toward take profit, but my stop loss goes to break even at this point because almost always it hits my take profit. Maybe like 1 in 20 times it will come back and hit, I guess, my stop loss. So yeah, that's the optimal trade entry. I'll give you the order block and fair value gap entries now. Okay, so for the next example, we're going to use an order block. Now I'm not going to do the replay and stuff. We don't need that, but this right here, let me just mark it out. The last down close candle before the up move is your order block, right? Last down close candle before the up move is your order block. Now, first of all, just look at this, right? Look at that. Look at the wicks respecting, look at the bodies respecting this order block, man. Like, how crazy is that? That's absolutely insane. The wicks tap in and they quickly move off. Now, people ask me this all the time, right? A high probability order block, price will do that. It will tap up, it will tap it and then quickly move off in the opposite direction. A low probability order block, price will do this. It will deeply retrace, start consolidating a bit and then slowly move out. That is a low probability order block. We don't want to do anything with that, right? That is a low probability order block that we want to avoid. Now, in terms of entry, this is literally the highest probability order block you can get in all trading. You have a liquidity sweep and you've got a fair value gap attached to it. It does not get cleaner than that. So what we're going to do is we're just going to enter like this, like this. I'll stop loss at the low. And then for take profit, I would say obviously at least a 3 risk to reward ratio. And look, listen, if you want to like pass a prop room challenge and you're willing to take the risk, aim for this high here, right? Aim for this high here, right? You know, we're on the 1 minute chart. It's quite likely if we're bullish that we're going to hit this high here. So, you know, if I wanted to pass a prop firm, and I'm not advocating to do this every single day or every single time, but if I really want to pass a prop firm, I want to make a lot of money and I was willing to take the risk, you know, by all means, go risk 1% on this trade here, and you probably get it, I'd say 9 times out of 10, with all disclaimer, right? With the higher time frame bias and liquidity sweep. Yeah, and then for fair value gaps and fair value gap entry, what we're going to do is you're going to enter this fair value gap here. Now, let me just make this clear. No, see, price doesn't even touch it here, so we are good. If price did touch it here, so let's say if price touched it like around here, what we would do is the bit that's remaining would be our fair value gap. But we're okay in this case. This is our this is our fair value gap, right? This is our fair value gap. Now look, right? Price wicks below the fair value gap because it's quite narrow, but it's wicking into the order block. So we are okay with it. But anyway, you wouldn't know that in hindsight, right? You're not going to know that price is going to do that. You're just going to buy as it comes down here. And this is why I'm a big believer in not having such a tight stop loss. Because so many people are like, oh, I put my stop loss at the fair value gap. Like, why? What? The whole point of waiting for this liquidity sweep is to put our stop loss in a safe place where we know it's very unlikely the price is going to go to. And then for take profit, what we're going to do is, I mean, I wouldn't aim higher than this here. So here we go, 4.3 risk to reward ratio. And if you want an easy take profit, 3 risk to reward ratio, like that. I mean, look at this, right? You entered at 4:21 a.m. and then 4:29 a.m. I mean, what? It's like 8 minutes. 8 minutes, you can make 3K. Yeah, pretty good life, boys. Pretty good life. And by the way, people are going to ask me this all the time. This is in New York Eastern time because this is how the markets operate. So this right here would be a London strategy, but it works in literally any session. So London, New York, and Asia. It works in any session. It works on all markets. It works on Bitcoin because I know a lot of people, but there's a few people are really interested in crypto. It works on crypto. This exact same thing. Forget gold, right? Forget this. Just put like a a market over this, and like a black market over this and this, and this concept would work. This concept works on any time frame, and it works on any market. But don't overcomplicate it, guys. Don't ask, I've only seen examples on gold, but does it work on USDJPY? Yeah, it works on all markets. So yeah, liquidity sweeps may be profitable instantly, and they will make you profitable. It's honestly the highest probability thing I've ever seen in trading, and I've taught so many students this, and they've made money right away. But the next thing we need to do is we've had our liquidity sweep. We know we're bearish on the higher time frame, or at least on the 15-minute chart, right? Which is all we need for this model. The next thing we do, and the last thing we do, is we just wait for a bearish fair value gap, right? We want a fair value gap that forms in the trend direction, right? That easy, that simple. So right here, right, this is our fair value gap. This is our fair value gap. We've got our liquidity sweep. We've got our fair value gap, like that, right? That right there is the highest probability entry you can get in trading. Liquidity sweep, we've got the trend, and then we've got a fair value gap that forms in the trend direction. Okay, so now that we've got the fair value gap that forms, all we need to do is enter on that fair value gap, right? So all we're going to do is, let's just go here. So we're going to enter on the fair value gap. Now, for our stop loss, this is so important. People are asking me this on X, right, on Twitter. They're asking me, do I put my stop loss here? Do I put it here? Do I put it at the fair value gap high? You always put it at the liquidity sweep high, right? The whole point in us waiting for a liquidity sweep is so we have somewhere safe to put our stop loss orders. Because how many times does this happen when you're bearish, and let's say you put your stop loss right here, right, thinking it's nice and safe, price comes up, takes out your stop loss, and then instantly goes to take profit. The reason that happens is because you haven't waited for a liquidity sweep, right? The whole point of a liquidity sweep is supposed to find a safe place where we can put our stop loss orders, right? Where we can put our stop loss and not have to worry about it. And right here, we put our stop loss at this high here, right? This liquidity sweep high is where we put our stop loss. Right? Nice, safe stop loss. And now you don't have to have, and I've learned this after years of trading, you don't need, a really tight stop loss. You really don't need a tight stop loss, right? The only people who have really tight stop losses are those who aren't confident and they have a really low win rate. With this model, you will get a high win rate, and we can get at least a 2 risk to reward ratio, ideally a 3 risk to reward ratio. So right here is your 2-to-1. Right? We're going to aim for a 2-to-1. Now let's just zoom out a bit, like this, right? Ideally, and I always encourage my students to aim for a 3 risk to reward ratio, like that, right? Nice, easy risk to reward ratio, like this, right? Nice, good risk to reward ratio. And all we're going to do, let's just move this up. All we're going to do is just play the price action. So your limit order, remember this is the 15-minute chart. So, and this is why I'm a big believer in 15-minute chart. Because first of all, you can see the trend quite nicely, right? So if you zoom out, you can see the trend quite nicely. All right, we can see that we're bearish. And then the second bit is it's not that fast, right? It's not that fast. So it's very easy to read. Very easy to read. I mean, this is so obvious. I mean, I hope it's so obvious, right? You got London tie, typical sweep in New York, fair value gap that formed in the direction of the trend. All we're going to do is enter on that trend, right? Enter on that fair value gap. So let's just play price action, zoom out and play price action, see what happens. Bam, down. And then we just let price do its thing. Like this, right? Let it do its thing and then bam. Just like that, right? Pick your take profit. Nice, easy trade. Let's see how long this took, right? You entered at 8:30 and you were done. Not even 10 so like 2 hours, right? 2 hours in a trade. Nice, easy, high probability day trading model. You can do the exact same thing in London and the exact same thing in Asia, right? This works on all markets, works on Forex, indices, any market, like literally any financial market, it will work on, right? Because there's two reasons. The first is the trend, right? The trend, you can't, like smart money can't hide where price is actually gonna go, right? They can't hide where price is actually gonna go. So 15-minute chart will give you the trend, the direction. Number two, liquidity, right? Liquidity is the lifeblood of the market. The only reason price moves is for liquidity. And we know that the trend is bearish, the price is moving for liquidity on the higher time frame somewhere. And then we've got our liquidity sweep. This ensures we get a high probability entry, right? This makes sure that, you know, price doesn't come, take out our stop loss and then go to take profit, right? So that gives us the highest probability entry. And then the fair value gap in the trend direction shows us we're on the right side of the market. Shows we're on the right side of the market, and then we just enter on that fair value gap. We always put a stop loss at the liquidity sweep high, and if you're bullish, you put it at the liquidity sweep. There's a fair value gap here, right? Easy fair value gap entry that you can take, right? So you put your entry right here. To make this a bit more obvious, put your stop loss at liquidity sweep high. Now, why do we do this? We talk about this all the time. Why do we do this? Because it's very unlikely if we're bearish and we've had this liquidity sweep, right? Because remember, price only came up here just to take out that high. That's the only reason it came up there, was just to take out that high. Very unlikely that price is going to come down all the way down here, come up, take out this wick again, and then go back down. Very unlikely. It is possible. It does. The lower the time frame you go, so if you're on the 1 minute, and especially on indices, you'll see that a lot. It's like a double liquidity sweep. But you know, for Forex, if you're on the 5 minute chart, very unlikely, right? Because price only came up here just to take out those stop loss orders. That's the only reason it went up there. It didn't go there for any other reason apart from just to wick up, take out those stop loss orders, so smart money can take the other side and ride price down. So it's super unlikely price going to come all the way up, take out your stop loss, and then reverse. So it's very safe to put your stop loss here. Very safe, right? Very unlikely that price is going to come up. And in terms of take profit, always target at least a 2-to-1. And for me, I say never more than a 3-to-1. Now, why do I say that? Because let's just at least target this low, right? Because lots of liquidity, and you ideally want to be targeting the opposing liquidity pool. Now, what does that mean? It means if you're bearish, you want to target the opposing low. And if you're bullish, I target some opposing high. Really doesn't matter, but for me, a 2 to 3-to-1 is absolutely fine. And if we target this low here, basically get a 3-to-1. Now, why do I say never to trade and never target more than a free risk reward for day trading and scalping, and even swing trading, really? Because look at this. Let's say you target a 4-to-1, right? You did everything right. You got the buyers right in the higher time frames. You wait for liquidity sweep here, right? You wait for liquidity sweep. Perfect entry. Price comes all the way down, right? So it comes like that. You enter right here. Perfect entry. 3% up in profit, and it just chops like that. And then this is the end of the week, right? So it gaps up, or it just reverses on you, right? Imagine that. Imagine how annoying that is. I'm telling you, all you need is a 2 to 3-to-1 consistently, right? I have a 50% win rate and a free risk reward ratio. I'm profitable. I can make all the money in the world. 10k a month, 100k a month, you know, $1 million a month maybe if I get enough capital. Like, I can make whatever amount I want, right? That's all you need. Most profitable traders have a 50% win rate and a 2 or 3 risk reward ratio. You know, all these guys saying you need, you know, a really tight stop loss, massive risk reward. You know, it's a load of crap. It's a load of crap. And that's because they have a tiny win rate. If you do this, you're going to get a good win rate. Right, we've got our stop run, our fake liquidity sweep. Now we're looking for our entry. Now, for me personally, this is my entry. Full transparency, I just take an optimal trade entry, which is literally a Fibonacci retracement, because I'm going to keep saying this. The entry pattern is the least important thing. If you've got liquidity, or if you've got liquidity on the higher time frames that we have here, and you've got your liquidity sweep, the entry pattern does not matter. Any sort of fair value gap, order block, indicator, even VWAP, you know, optimal trade entry, Fibonacci retracement, all of them are high probability. As long as you've got liquidity on the higher time frames, you're trading in that direction, and you've got your liquidity sweep. So we're going to enter 0.705 level, stop loss at the low, like this. And for me personally, I just target a free risk reward ratio, like that, right? Nice, easy trade. You guys got the point in your free risk reward ratio, nice and easy. I did this all the time when I was day trading, when I was scalping, and now I do it when I'm swing trading. It's This model right here is the moneymaker. It's the model that took me about 4 years to finally figure out. But yeah, this model is so good. Now, let's just let me just tell you a few things, right? Some people always ask me, they say, hey, you know, should I target all the way up here? No, that's not what we do. We do not target that liquidity unless you think within a day you can hit it. But we don't need to hold on for days and days and days unless you want to be a swing trader. But we don't need to do that for day trading. All we need is a little slice of the move, right? So free risk to reward ratio is more than enough. Now, let's just remove the Fibonacci. Let's say you wanted to enter on the order block, right? So let's just mark out the order block. This right here is your order block, right? What you would do, you'd enter like this, right? Stop loss at the low. Now, I always say this, I won't keep saying this because two reasons why I guess more people keep joining the channel, which is good. So I'll keep saying this until people understand this. Because this is a liquidity sweep, because price, let me make this very clear. Because price has come out and taken out these stop loss orders, right? This is a fake move. This is a fake move designed only to take out stop loss orders. Very, very unlikely price going to come down, take out this move here, which was just a fake move designed to take out stop loss orders. Very, very unlikely that price is going to do that and then quickly continue on with a direction. Right? If price does come down here, it's probably because we're wrong, right, with the direction, and there's going to be a retracement on the like higher time frames or something. But doesn't matter, right? Entry pattern doesn't matter. So let's just play price action. Let's just assume you want to enter on the order block, and then you're going to target, let's say free risk to reward ratio, right, like this, and then we're just going to enter the trade, right? Enter the trade, get tagged in, and then let price do its thing. Let price do its thing. Lots of people just like, they start taking partials, they start moving their stop to break even. Just let price do its thing, right? I actually closed the chart. I set my take profit and leave, right? There we go, we hit it. So this is a late London trade, and then you hold on into like early New York, and then you hit take profit. Right, key thing is, once you've got all this analysis, literally, and you're in the trade, just close the charts and move on with your life. No one gets paid to watch their P&L here, right? Because lots of new traders, especially, and this was me, see how price is like kind of chopping up and down. You might be up like 1K and then pricing goes back down to like $500. Like, you don't want to be doing that. You don't want to be doing that because it's kind of hard, especially here, right? Lots of people would panic. Let me see it. See here how we just about missed take profit. They go, oh no, what if it reverses like that, right? Like that. Like, you don't want to be that. I just settle my limit orders and I move on with my life. Like, there's very rarely, maybe like 1 in 20 trades, where price will come all the way up here and then reverse down like that, right? And then someone will go, oh, you could have put your stop to break even. Like, okay, fine, whatever, but really does not matter. Once you do this model and once you backtest it, you'll have so much confidence in yourself and in the model, you won't need to like babysit and stuff. But just sitting through this for like 2 hours, 3 hours, I don't know how long this is, maybe like 2 hours, right? Like 2 hours, there's no point in it. There's no point in it whatsoever. I've learned from trading, right? To set up your limit orders, get tagged in. As soon as you're tagged in, right, you've got your stop loss in there, your take profit in there, let it do its thing. Let it do its thing. And then there are people, some people will be hating on you like, oh, well, that shows you not got confidence. No, it shows you that you're smart, right? Go to the gym, go read a book, go do anything else apart from, looking at the trade, because you're just going to panic, right? I used to panic, and, I'm going to give up P&L and stuff. But yeah, that's just a little bit of, I guess big brother advice for like managing your trades and stuff. And for those who are asking, I don't move my stock. I don't take partials at like, a 1 risk to reward ratio or something. I don't take partials at all. I just let it hit my take profit. Now, once I'm up, this is something, I guess if you really, guys really do care. Once I'm up about 2 risk to reward ratio or 2%, I'll move my stock to break even. But this is really important. This is because I'm swing trading now, because I'm too busy to day trade. So this is on the 4-hour chart. So everything's very slow. If you're a day trader, just let it do its thing. Honestly, let it do its thing. If you really want to move your stop to break even at like, let's say when you're up 2%, see here, just set it like an order on like, an alert on like MT4 or whatever you trade, right? Just set up an alert, and then once it hits this level, you'll get like a notification on your phone, and then quickly move your stop to break even, right? That's what I would say. Close the charts and then set up, I guess like an alert or wherever you put your price to break even. But literally, that's all you guys need to be a profitable trader. As long as this is so important, as long as you guys have got higher time frame liquidity, right, on the daily or 4-hour chart, and then you combine it with a lower time frame liquidity sweep that we have here, right, like we have here. So here's our liquidity sweep, lower time frame liquidity sweep. Price moves up in the higher time frame direction, showing us that we are bullish. Then you enter any sort of retracement, ride price up. That is the highest probability trading model. It makes so much money. It's so easy. It works on all time frames, by the way. This will work on the 1-minute chart, and it works all the way on the 4-hour chart.
Okay, so here we are on the 1-minute chart. Now, once you've got your overall direction for liquidity, so if we just zoom out, once you've got your overall direction of where the higher time frame liquidity is, you can look on any entry time frame or any time frame and just ride price up to this key level here. So I'm going to show you it on the 1-minute chart, but this exact setup works on any time frame, right? I use this on the 4-hour chart when I'm swing trading. So if we just look at this price action here, and remember, we're bullish overall, right? We're bullish overall. There is some intraday liquidity here, right? Now, what do I actually mean by that? Can you see how we have highs here, and we also have highs here, right? We've got almost like relative equal highs, and there are lots of people who think that price is going to come down, it's come all the way up, it's going to bounce off these levels and drop, right? So this is our liquidity pool intraday, right? This makes a really good target if you're day trading and scalping, right? Because people ask me this all the time, like, hey, Atif, you know, if I get into a position, do I have to target all the way up at this major liquidity pool? No, you just need a 2 or 3 risk to reward ratio in that direction, right? So how do we actually make money from this, right? It's all well and good having the direction, right? And knowing that price wants to come and take out this high. How do we actually make money from this? So what we need is we need to wait for a liquidity sweep, right? And if you remember what we talked about on the daily chart, a liquidity sweep is just a stop run, right? It's just a stop run before price moves off in the opposite direction. So can we see that anywhere in price actually? Can we see a wick that comes down and takes off, let's say it takes some stop loss orders and then quickly moves off in the opposite direction? Can we see any of that, right? So if we just look, right? If we just look, you see this wick here. You see how this wick comes all the way down, takes out stop loss orders here, here, and at these equal lows here. And we also go into a fair value gap. And then what do? We quickly and aggressively reverse in the opposite direction. We reverse in the opposite direction, and then we just want to look for any retracement and ride price up, right? Now you might be wondering, oh, you know, Atif, there's no market structure shift, right? You know, don't we need to wait for price to come all the way up here, close above these highs, and then enter a retracement? I would always say, no, I think market structure is a distraction, right? I have so many students who are so close to profitability, but it's market structure that holds them back. And if you remember, we said we've got the overall direction all the way up here, right? We're only looking for longs. We're already super bullish. Like, I'm not on the 1 minute chart saying, oh, you know, I want to see the best price action. I don't care. I'm just looking for any reason to go long, right? You know, all the analysis was done on the daily chart, right? Or you could do it on the 4-hour chart. The hard part was determining where price wants to go, right? All we need now is a simple entry pattern. So people are obsessed with the entry pattern when it's the least important thing, right? And this is where so many people go wrong with liquidity. You know, they think it's the entry pattern. Oh, you know, see, if I want the best, you know, entry pattern, I want liquidity sweep, I want market structure shift, I want everything. You don't need it. You don't need it. We've got the direction. We know that the higher time frame liquidity is right here. Price, you know, wants to move quickly and aggressively. We're not going to wait for some sort of liquidity sweep and then a huge market structure shift and then, you know, for a price to come all the way down to a tiny little fair value gap and give you a 10 risk to reward ratio, right? We're not waiting for that. We're just looking for any reason to get long. So, bit of a rant there, but it's very important that we understand that. Now, I know a few people are going to be like, oh, hey, T, was this not a liquidity sweep here, right? Did we not just sweep out these lows here? Well, let's study this bit of price action, right? Price comes out, it takes out these lows, but it does not take out these lows, right? So we've almost got triple lows at these, you know, here, here, and here, right? So you've almost got equal lows here. Let's just remove this, right? There are stop loss orders at here, here, and this gets very close, but does not take out these lows here. So for me, that's just, I don't want to say the term inducement, right? Because people are going to get confused by that. This is just generating liquidity, right? It does not take out these stop loss orders here. Now, if you really wanted to, you could have. So you could have put your stop loss here, right? But it's very risky, right? You really want to put your stop loss where there's equal lows right next to it. For me, I would never do that. And if you look, there's a fair value gap right here too, right? So very, very risky. And this is something for you to know. So if you've got equal lows, like we have here, if you've got equal lows, like this, and almost another equal low, and you've got a fair value gap, price will, you'll see this all the time in price action. Price will, even, doesn't matter what the direction is, it will just take out this little bit of liquidity and it will go into the fair value gap and it will go in the opposite direction, right? And you might think I'm like full of BS, bro, look at this, man. What, I didn't even know, like, I just did this just based on, I guess, like my knowledge of trading, but look at that, man. It goes right to, fills in the fair value gap. Beautiful. Shoots off in the opposite direction. So for those who are wondering, hey, is this not a liquidity sweep? Very risky putting your stop loss near these double equal lows, and there's a fair value gap. So, you know, if you did it in this case, you would have lost, but very, 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 very risky. And this is why this is not for beginners. This is not for beginners. This is very advanced trading, right? This is what I use to make money consistently. So don't worry if this is like going over your head, because it's going to take a lot of practice before you actually understand this. But yeah, I'm giving you everything that I use, right? Everything I use in price action to make money. So let's just remove this. Let's just remove this. What's our entry pattern then? So we've had our liquidity sweep. Let's mark it out. We've got our stop run. or liquidity sweep, whatever you want to call it, right? This is our stop run. So let's just liquidity sweep and stop run, right? How do we actually enter? So let's just put liquidity sweep. How do we actually enter? We've got our liquidity sweep here. Price shoots off. Where do we want to enter? Now, for me, I always say this to my students, right? If you've got a liquidity sweep, so if you've got price that wicks out some old low and reverses in the opposite direction, wait for a fair value gap to form, right? Just wait for a fair value gap to form in the opposite direction of the liquidity sweep, right? That's just a hard and fast rule. If you just wait for a fair value gap to form in the opposite direction of the liquidity sweep, that will tell you that that was just a fake move designed to take out stop loss orders, right? Now, not 100% of the time, right? You're never going to have a 100% win rate, but more often than not, especially this is our key time of day, and we've got the higher time frame narrative that liquidity is right up here, and we've got double highs right here with more liquidity. Key time of day, we're on the 1 minute chart, it's gold, it's a major asset, you know, price is going to quickly shoot off. We just want to get into the move. So right here is a fair value gap. So let's mark out this fair value gap. Now, you can enter on the fair value gap itself, or the order block, or an optimal trade entry. Doesn't really matter. I just like to wait for a fair value gap, just because it tells me, essentially, that smart money quickly wants to shoot price away. Right? I don't know if anyone's actually explained what a fair value gap is. A fair value gap tells you that price is quickly moving away, right? That's like it's almost a visual way of seeing, you know, price quickly reversing. Just look at this price action, right? This is choppiness, and there's no fair value gaps. Here, price quickly drops, leaves lots of fair value gaps. Price quickly drops, leaves lots of fair value gaps. Price quickly reverses, leaves fair value gaps. Price quickly reverses, leaves lots of fair value gaps, right? So a fair value gap tells you, it's almost like a clue that price is going to quickly move, right? So that's why we're keen to just get into any sort of entry. And people might be asking, oh, you know, are these wicks not respecting these order blocks? Like, look, this is the 1 minute chart, right? I don't care about any bearish order block. I don't care about any bearish fair value gap. I've got my direction all the way up here, right? So important. People get on the 5 minute chart and like, oh, you know, this 5 minute, you know, bearish order block got respected. I think there's going to be a shift on the daily chart now, right? Doesn't work like that. Does not work like that. This is all just trickery. Right, you got to come onto the lens. When you get onto the chart, you got to go, you know, look through the lens. This is all just an illusion, right? This is all an illusion, right? They're just, smart money are just thinking, how can we actually get price to this level? Right? How can we get price to this level all the way up here and fuck as many people as possible? That's the reality of it, right? How many stop loss orders can we take? How many people can we get out of their positions so we can take their side of the market and ride price up? That's what smart money is thinking. Like, how many people can we just, like, you know, mess with just to get into our positions and then ride price up, right? So you need to operate under that narrative. Don't look for shorts, only look for longs. And for your entry, you can enter on the fair value gap. So what that would look like, you should enter like this. Right, now people are going to ask me, where do you put your stop loss orders? I'm going to keep on saying this. You have to put it at the liquidity sweep low, right? You have to put it there. There's no point waiting for a liquidity sweep, right? There's absolutely no point waiting for it. Liquidity sweep if you're just going to put your stop loss like here at this, you know, fair value gap low or this order block, because price can easily wick down here and then go up and take you out, right? You do not want that. You have to wait for a liquidity sweep. The whole point of waiting for a stop run or a liquidity sweep was so you can put your stop loss orders in a safe place, right? In a safe place where it's very unlikely that price will, you know, hit it and tag you out, because so many traders get this right. They think they understand liquidity. Right, they think they understand liquidity, but this happens to them. Right, the bullish price comes out, takes out their stop loss, and then comes up, gives everyone else another retracement, and hits take profit. Right, hits the major liquidity pool, and that used to happen to me for years, all because I didn't wait for a liquidity sweep and I didn't put my stop loss at the liquidity sweep low. So, for your take profit, you can target 2 to 1 or a 3 to 1, right, and let price just do its thing. You do not need a massive risk to reward ratio. Let me tell you, I know so many profitable traders, they all have between a 1 or 3 risk to reward ratio, right? They don't have a 10 risk to reward ratio. And these guys on Instagram are just, they're lying to you, right? You don't need a tiny stop loss. You just need consistency, right? You don't need perfection, because the reality is there is no perfection in these markets. So let's just play price action and let it do its thing, right? So you would have easily got your 2 risk to reward ratio, for those who are wondering. 3 risk to reward ratio, this is what I aim for. I will aim for a 3 risk to reward ratio in the overall direction, right? The overall bullish direction. If you really wanted to, you know, you can aim for this. If you really wanted to, right? If you're one of those traders, you can, but just be prepared that price can do this very easily. It can do this. and then start to reverse, consolidate, you know, through Asia, and then have a liquidity sweep, let's say, in London, come close to it, and then New York, and then in New York, you might hit it, right? So you might have to hold like a day, which is not good, right? It's not good if you want to be a scalper, but let's let price do its thing. Let it do its thing. Don't worry about any retracements. Trust the logic, and let price do its thing, right? Let it do its thing. Let it do its thing. And like that, right? Nice, peaceful trade. Price hits your take profit, and easy trades, easy trades. Now, at first, this might seem like super complicated because it can be complicated, but you need to operate under the lens that, first of all, you get on the higher time frames. You don't even look at the 1 minute chart or the 5 minute or even the 4 hour chart. You get on the higher time frames, you look for the overall direction, you look for the liquidity, you ask yourself, where is the money? Where is smart money moving this market to? Right, where's the major high or low with stop loss orders that smart money are moving the market to? Right, that is your number one goal as a trader. You got to have a fee, you got to have a direction where you think the price is likely to go. Right, if you don't have a direction and you're looking for an entry pattern, you're just gambling. But that's just gambling. You have no idea what's going to happen. There are fair value gaps here. There are bearish fair value gaps. There are bullish fair value gaps. If you're just buying and selling randomly these fair value gaps, you're not going to make any money. And I see these people asking me, hey, Atif, you know, is it all right if I use this trading view fair value gap indicator? It's like, it's going to mark every single fair value gap out, and it's pointless. You don't need any of these fair value gaps. You need the logic first, and then everything falls into place, right? Super important. So once you've got your bias, right, once you've got your overall liquidity direction, then and only then do you want to get onto your entry time frame, right? So if we've got the direction and the bias on the daily and 4 hour chart, we're not going to get onto the 1 hour chart, 15-minute chart, and 5-minute chart if you're a 1 minute trader. Right, we don't care about that. We only care about, you know, our entry time frame and the higher time frames, and that's something that I got confused with quite a lot, right? Because the 4 hour chart, daily chart, weekly chart would be bullish, but then the 1 hour chart would be bearish, and I'd be like, what's going on? Do not go below the 4 hour chart to determine your higher time frame liquidity. Right, super important. Do not look at the 1 hour chart. Do not go below the 4 hour chart. You need the daily, weekly, or 4 hour chart, right? Super important. But once you've got that, you get on your entry time frame and you look for a liquidity sweep, right? You're looking for a stop run in the opposite direction, right? Any sort of, you want to see some sort of large wick, ideally, take out some stop loss orders, quickly move off in the opposite direction, leave a fair value gap for you to enter on that fair value gap, ride price up for a 2 or 3, risk to reward ratio in the overall direction. Now, if you're lucky, let's say this is 1 day, right? You hit your take profit of a 3 risk to reward ratio. Price can consolidate, and then it can give you the same entry, a liquidity sweep here, comes up, another fair value gap, and takes it out, right? And of course, you know, if price is all the way down here, let's say, you will get many days, even a few weeks of the exact same setup occurring every single day. And if you trade, let's say, London and New York, you can get maybe 10 trades if price is all the way down here, riding price up to these highs, right? And that is how you day trade and scalp profitably, and that's how you swing trade too, right? This is the exact same setup. We just remove this. It's the exact same setup that I use on the 4 hour chart, right? So forget the time frame, focus on the logic, right? Higher time frame liquidity gives you your direction. Liquidity sweep gives you the high probability entry, right? Liquidity is the direction. Liquidity sweep is your edge, right? Super important that you need both, because if you don't have them, you're not going to make money. And to be honest, there's a third one that no one talks about, which is psychology. Because if you don't have the psychology right, you're like it's almost like having a gun with no ammo. Doesn't matter, you know, you can have the best weapon in the world. If you've got no ammunition, you're not gonna do any damage with it. So you need to have the right mindset. You can't be, you know, in a point where you have, you know, 1 loss, 2 losses in a row, 3 losses in a row, and you start freaking out, right? I mean, I don't know if you follow me on X or no. This week, right, I had 5 trades, I had 2 winners and 3 losses, right? So I had a 40% win rate for this week, but I still ended the week 3% up, right? Because I aimed for a 3 risk reward ratio. You know, if I was in the point where I had 3 losers, because at first I had 3 losses, right, you know, back to back to back. If I was at the point where I'm like, oh, you know, I can't do it, liquidity sweeps don't work, I'd be in a never-ending cycle, and I was in that cycle for 4 years. Okay, so for this strategy, we only need 2 things. We need a liquidity sweep, and we need a fair value gap. Now, we're going to do this on the 1 minute chart, because for scalping, we only need the 1 minute chart. We don't need daily bias, because the reality is, you know, on the 1 minute chart, daily bias doesn't really matter that much. So here we are. So what a liquidity sweep really is can you see this major low here, right? This major low here, where there's lots of liquidity, lots of stop loss orders, whatever you want to call it, at this low here, right? Because price, let me just zoom out here. See how price shoots all the way off, go all the way up here. Lots of people are going to put their stop loss orders here, thinking it's nice and safe, right? Nice and safe. So if you've been trading for any length of time, you know that's complete BS, right? What the markets actually do is they target stop loss orders. It's the only reason these markets move. And I'm not going to prove it to you in this video. And all you need to know is that that's the reason why these markets move. So what a liquidity sweep really is it's a fake move, right? It's a stop run, which takes out an old low and then shoots off in the opposite direction. And trust me, after 5 years of trading, and if you don't trust me, go look at the comments, right? You will see liquidity sweeps time and time and time again. And in fact, if there's any major move in the market, it will be because, first of all, there's a liquidity sweep, and then it will shoot off. So how do we actually make money with liquidity sweeps, right? This is the most important part, of liquidity sweeps. So let's just move this all the way over here. So you guys understand the logic by this point. So here's our liquidity sweep, right? Can you see, this is super important, right? Pay attention. This is probably the most important part of the video. Can you see this? Right, let me mark this out for you. Can you see our price comes just below, look at these candles here, these little ones here, just below this old low, right? Just below this old low, just enough to take out people's stop loss orders, right? And then shoots off aggressively, quickly in the opposite direction, and then gives everyone else a nice fair value gap entry, or nice order block entry, whatever you want to call it, retracement, and then shoots off, right? You will see that time and time again, and that's how I've retired my entire family, right? Liquidity sweep, simple entry. That is all you need to become a profitable trader, right? Especially when you're scalping, right? We don't need daily buys, just because that's how scalping works. So you will always see this, liquidity sweep, fair value gap in the opposite direction. So to make a liquidity sweep high probability, we're going to wait for a fair value gap to form, right? So the moment this fair value gap here that I've marked out for you, the moment this forms, that right there is smart money screaming at you that this is a liquidity sweep. It's a fake move designed purely to take out stop loss orders. So once this fair value gap's formed, then and only then do we know this is a liquidity sweep. It's purely or simply just a fake move designed to take out stop loss orders. So once this fair value gap's formed on the 1 minute chart, then and only then am I going to look for my entry, right? And you can see price shoots off, which we always like to see. And I don't believe in market structure. I think it's a load of BS. That's just me personally. But, if you do believe in market structure, here's a high, price closes above it. There's your market structure shift, right? If you do believe in that. But all you're going to do at this point is simply enter on the fair value gap like this, put your stop always at the liquidity sweep low, right? The only reason we wait for liquidity sweep is to put our stop loss in the safest area possible. Now, for your take profit, you're going to aim for at least a 3-to-1, because personally, if you're scalping, there's no point aiming for a 2-to-1, because you can be a swing trader and get a really easy, reliable 2-to-1. So I'm going to aim for at least a 3-to-1, right? Which we just about get. And if not, you can aim for a lot higher, 4-to-1. This high right here, really obvious high to take. And if you really, really do want to, but again, at this point, if we aim really high, we're getting more into day trading sort of territory instead of scalping, right? So we zoom out, see, do we hit this? Yeah, eventually, right? But again, if you're scalping, you want to be in and out. So for me, as always, a free risk reward ratio is like the holy grail. Now you might be wondering, let's just make this all the way down here. You might be wondering, okay, Atif, why does this chop for a bit? Now the reason why this is choppy here is because this is the end of Asia, but it's not London yet, right? Asia is 8 p.m. till 12 a.m. Eastern, and London is all the way over here, right? All the way over here, 2 a.m. till 5 a.m. Eastern. So we've got a bit of dead time, but honestly, it does not matter, right? You can get an easy free risk reward ratio. And as a scalper, that's all we care about. Okay, so for this strategy, we only need 2 time frames, the 4-hour chart and then your entry time frame. Now, the reason we use the 4-hour chart is because this tells us where price actually wants to go, right? Because the big banks who move price, they're only looking at the higher time frame. So we need to use at least one higher time frame to give us high probability entries. But once we use the 4-hour chart, all we need after that is our entry time frame. So the only thing we need the 4-hour chart for is just to look for a fair value gap, right? That's the only thing we need the 4-hour chart for. So what I'm going to do is we're just going to mark out a fair value gap. And for those who don't know, a fair value gap is simply the gap between this candle here, this candle's high here, and this candle's low here. So what you're going to do is you're going to mark out that 4-hour fair value gap. And then literally all you're going to do now is get onto the lower time frame or your entry time frame and look for a new fair value gap to form in the same direction, right? So a new bullish fair value gap to form on the lower time frame. So let me show you what that looks like. Okay, so here we are on the 5-minute chart, right? And here's that 4-hour fair value gap, which we were talking about on the higher time frames, right? Now, can you see how price comes in, it chops around for a bit, and then boom, shoots off. That is exactly what we want to see, right? We want to see on the lower time frame or our entry time frame, we want to see price respecting the 4-hour fair value gap. And what respecting really means is for price to leave another fair value gap in the same direction as this 4-hour fair value gap. So what that actually looks like is, let's just mark this out. You see this fair value gap, see these big fair value gaps that form in the direction of the 4-hour fair value gap. That's telling us we're on the right side of the market. That's our confirmation that smart money, those who move price or who move the market, are telling us, they're screaming at us saying, hey, look, this is the right side of the market, right? Price is bullish, getting on a trade, right? Getting on a trade, on a fair value gap, on an order block, on an optimal trade entry, and ride price up, right? This is our confirmation, and this is what makes this strategy high probability, right? It's the fact that we've got our highest time frame fair value gap, and on the lower time frames we have our confirmation. And for those who are wondering, this strategy will work on any time frame less than the 4-hour chart, right? So 1 hour, 15 minute, 5 minute, 1 minute chart, and any time frame will do as long as it's less than the 4-hour chart. But you need to use the 4-hour chart as your higher time frame, right? Because smart money are looking at the higher time frame. But here we are. Here's the 4-hour fair value gap. Price hits it, aggressively shoots off, and then leaves another fair value gap, right? And you'll see this in the PDF, which you guys should have, right, in the pinned comment down below. But this fair value gap, or any fair value gap, right here, is smart money screaming at us, telling us that this is the right side of the market. So for this strategy, once price hits this 4-hour fair value gap, you want to wait for the next fair value gap that forms in the same direction as the 4-hour fair value gap. Now what that really means is, this is the bullish fair value gap, we want another bullish fair value gap to form on our entry time frame, right? So here we are. And for those who are wondering, oh, you know, Atif, why have you not used this fair value gap here, or even this one here, right? The reason why is, and this is for your notes, when you're bullish, you always take the lowest fair value gap, and when you're bearish, you always take the highest fair value gap. And that right there will save you so much money, it's actually insane, right? So what that actually looks like, because someone was getting confused, you know, in the comments, like, hey, what does that actually mean? Let's say you were bearish, this would be your highest fair value gap, and because we're bullish, this would be your lowest fair value gap. Like this, right? Like that. And beautiful respect here, bro. Look at this. Look at the bodies respecting it. Always nice to see that. So for this strategy, what you're going to do is you're going to enter on the new fair value gap that forms, right? The new fair value gap, not the big 4-hour fair value gap. The new one that forms like this. And then for your stop loss, I'm just going to put it at this low because it seems nice and logical, right? Nice and logical. And then for your take profit, you're going to target at least a 2-to-1, or you may as well target this high right here. But for me personally, I always target a 3-to-1, right? Because I think, to be honest, I think a 3-to-1 is the best risk to reward and win rate combined in all of trading. Because obviously, if you get a 5 or 10 risk to reward ratio, win rate goes down massively. And similarly, like, who wants a 1-to-1? Who wants to aim for a 1-to-1, right? Like, no one. So for me, this is my favorite here. Aim for 3-to-1. Nice, easy, simple trading. Okay, so here we are on the 15-minute chart. So let's imagine that you didn't want to trade a 5-minute chart and you wanted a simple day trading strategy. Here's how you use the exact strategy on the 15-minute chart. So if you just zoom out, this right here, you can almost see it. This is the 4-hour fair value gap that forms. So realistically, I should be moving it in like this. But this is the 4-hour fair value gap. Price hits it, and if you remember for the strategy, what we're looking for is we're looking for the first bullish fair value gap that forms, right? And the reason we're looking for a bullish fair value gap is because the 4-hour one was bullish, right? So we're on the 15-minute chart here. This right here is the first bullish fair value gap that forms, right? Like that. That's your first bullish fair value gap. So what you're going to do is you're going to enter on the fair value gap like this, put your stop at the low here, and then for your take profit, you're going to target at least a 2-to-1, minimum 2-to-1, or like I always do, nice, easy 3-to-1. Now, of course, you know, if you want to, you can target liquidity all the way up here, right? Nice, easy trade here. 4.5 risk to reward ratio, or you can target liquidity at this high here. Really does not matter, but as long as you've got this strategy, you've got the 4-hour fair value gap and the lower time frame fair value gap, you can make all the money in the world. It's insane. Okay, so for this model, and the model that I actually used, I made it as simple as possible because simplicity is what makes money in these markets, not some crazy indicator or invention. So what you're going to do is you're going to get on the 15-minute chart. Now, even if you don't trade the 15-minute chart, very useful if you're a day trader or scalper to at least look at the 15-minute chart. Now, what you're going to do is you're just going to eyeball the overall trend, right? You're just going to ask yourself, where is the market? Because we're at this point in the market. Where has the market been trending? Has it been going up or has it been going down, right? And literally, you know, there's no magic formula of, hey, look, you know, look back the last 3 days. Just eyeball it, right? And if you just get a trend line, now obviously, you know, I don't trade trend lines or anything, but if you just get a trend line and just put it through, right? it's pretty obvious that overall we've been bullish, right? Price has been going up. Obviously, there's lots of retracements. Let's go here. Lots of retracements and shit, but you know, price is bullish. We're moving up, right? We're moving up. We're bullish overall, right? So if we're bullish on the 15-minute chart and our trend is bullish, what that means, and this is a little trick, a little trading hack that I figured out, is literally 90% of the time, the daily bias will be in this direction, right? So we don't need to get on the 4-hour chart, you know, or the weekly chart or daily chart. This alone, right, this trend on the 15-minute chart is enough for us to have, you know, the bias right 9 times out of 10. So now that we've got the overall trend of the market, right, that we know we're bullish, key thing is we only want to look for longs, right? We only want to look to buy. And this right here makes our life so much more easier, right? We don't have to guess, you know, do we take a bearish fair value gap or a bullish fair value gap? So we know we're bullish on the 15-minute chart. What I also like to see is a liquidity sweep. So let me just zoom out a bit. Now, what a liquidity sweep is, it's literally just a stop run, right? So don't let the, you know, the fancy names or terminology confuse you. And someone in the comments was, you know, almost like having a go at me, right? They're like, oh, you know, what's the difference between this and a liquidity purge, a liquidity grab? They're all the exact same things, right? Some people will refer to it differently, but all it is a stop run, right? It's a fake move in the opposite direction of the overall bias. So if we know we're bullish, right, what a liquidity sweep really is can you see how price is shot up, it comes down, it just takes out this low, and if I zoom out, can you see this low here, right? This low here, where there would be stop loss orders. Price comes down, it takes out this low, and then shoots off, right? So let me make this a bit more clearer. Let's just zoom in on the charts like this, right? So remember, we're on the S&P here, and this will work on any markets. I'm just showing you on the S&P because Forex has been very choppy lately. So at this major low here, we have liquidity or stop loss orders, whatever you want to call it. Now, can you see how price wicks down like this, takes out this low here and this low here? Anyone who had their stop loss orders here had their stops taken, raided, purged, whatever you want to call it. Smart money, buying, and then they shoot price off, right? You'll see this over and over and over again. Once you've got the higher time frame direction or the overall direction of the market, you will always see a liquidity sweep before the major move. And if you don't believe me, you can do two things. You can either go through the charts, which you probably should do, or if you're a bit lazy, go look in the comment section, right? You will see this over and over and over again. Higher time frame trend or overall market trend, liquidity sweep on the lower time frames, and then an entry. That is all you need to make money, right? So now we have our liquidity sweep, right? Our fake move, and you can tell it's a fake move, right? And this is something for your notes here. Can you see this wick? See how this wick pokes down? It takes out anyone with their stop loss orders around this level, right, just below this low. It wicks down like this, and it instantly shoots off in the opposite direction, all the way up here, and then continues off, right? That right there is a liquidity sweep. So, you know, I did say to you at the beginning of the video that you don't have to trade the 15-minute chart, but you want to do the analysis if you're a day trader on the 15-minute chart. And similarly, you know, if you're a swing trader, you want to do the same thing on the 4-hour chart. But this is the strategy that I use, right? So I'd use the 15-minute chart for the trend, for a liquidity sweep, and then I'd get onto the 5-minute or even the 1-minute chart for my entry. But I'm just going to show you it on the 5-minute chart, right? So if we go on the 5-minute chart, this right here, this line, this blue line is on liquidity sweep. So let's just bring it all the way over here. Now, what I like to see, which makes it a bit clearer, what I like to see, and I always say this, because a lot of people ask me, like, hey, Atif, you know, how do I know it's actually a liquidity sweep? Like, how do I actually know it's a fake move, right? What I always say is to wait for a fair value gap to form in the overall direction of the market, right? Now, if you remember, you know, a stop run is going to be in the opposite direction of the overall market, and the 15-minute trend is bullish. So what that means is we're just going to look for a bullish fair value gap to form, right? And again, something for your notes, because we have a little fair value gap here, and we also have a big fair value gap here. You know, if you're ever asking, hey, which fair value gap do I take? Always take the lowest fair value gap when bullish. Always take the highest fair value gap when you're bearish, right? That right there will make you so much money. It's insane. It's insane. So this right here is the lowest fair value gap that you're going to mark out. Lowest fair value gap, like this. Look at that, right? Almost beautiful. I mean, that's almost perfect how it fills up, right? It's almost algorithmic. So that right there can be your high probability entry, right? On the fair value gap. Now, some people ask me, they say, hey, Atif, you know, I don't really like a fair value gap. Can I enter on a different entry pattern? Yes, you can. Like for me, I do a Fibonacci retracement just because it makes my life easier. But you know, if you're starting out with liquidity sweeps, the easiest way to trust it is to wait for a fair value gap and enter on that fair value gap. So what that would look like is simply entering here on the fair value gap. And this is where it gets really important, right? Stop loss always at the liquidity sweep low or high, right? So always at the stop run, because the whole reason we wait for a stop run is so we can put our stop loss in a safe place. There's no point putting your stop here or here. We always put it fixed at this low. And if you want a better entry, get onto the 1 minute chart and maybe you'll find an entry like this, right? But in this case, you don't, right? Do you? So this is what you're going to do. Stop loss always fixed here. And for take profit, this is where it gets exciting, right? So even if you have a wide stop loss, you can still get a good risk to reward ratio because you're with the overall trend and you've got liquidity sweep. And all of the most explosive moves in the markets always be after a liquidity sweep, right? And you'll see that time and time again in your charts, right? So let's zoom out. For our take profit, I mean, you can target 2 to 1, right? If you really want to, but for me, minimum, absolute minimum, I'm going to target a 3 to 1, right? And for those who don't know, I always target at least a fixed free risk to reward ratio. Now, I know some of you probably shouldn't do this, but you really want to pass a prop firm, or you want like large risk to reward ratios. What you can do, zoom out, look for obvious liquidity. So you've got liquidity here, right, at this high here, which probably be previous day's high, or the daily high, whatever you want to call it. That's an easy target, right? Look at that, 5.5 risk to reward ratio with a decent sized stop loss, right? Decent sized stop loss. So this is why I say to guys, like, look, listen, and girls too, right? You don't need to have a really tight stop loss. You just need to get the direction right and wait for liquidity sweep. Once you've got those two, you can make all the money in the world, right? Just look how explosive this move is, right? We chop for ages. We have our fake move. Let me just make this clear. We have our fake move, which is this. We have our second retracement. This lets all of smart money traders, those in the know, buy the S&P, and then price explodes off and takes out liquidity. So you can target this high here. You can target this high all the way up here, or you can target this high all the way up here. Right now, remember, the higher the risk to reward ratio, the lower the probability. Generally, the lower the probability, and also the longer you're gonna have to hold on. Right. So if you trade, let's say Apex or Top Step, so if you're a futures trader, you're gonna have to close your position. So you don't want to do this. But if you're like me, I used to trade CFDs and futures. Right. So if you are, you can hold on for as long as you want. Okay, so for this model, all we need is the 15-minute chart. Now, the first thing you're going to do when you get on the charts is you're going to zoom out and you're going to look for the overall trend on the 15-minute chart. Because I'll tell you what, if you do this, 9 times out of 10, you will get the daily bias, right? 9 times out of 10, you will get the daily bias. So what we're going to do is we're going to get on the 15-minute chart and look for the overall trend. Now, hopefully, it's really obvious, right, what price is doing. Really obvious what direction price wants to go in, right? Really obvious. Bearish. No, we want to sell the rallies and just ride price down, right? That right there gives us our trend, right? That gives us our trend. And what we want to do is we want to trade with the trend, right? We don't want to do anything fancy. And just by trading with the trend, your win rate will literally double instantly, right? Instantly. It's what happened to me. So here we go. So we've got our trend. We're only going to look for shorts because we're bearish overall on the 15-minute chart, right? And the good thing about the 15-minute chart is this is probably a few weeks of price action, right? Just zooming out. So here we are. We are only bearish and we only want to look for shorts. Now, before we can get into our position, we need to wait for something called a liquidity sweep, right? We need a high probability entry that we can trust and that we can rely on, right? So it's not good enough just to sell, any fair value gap like this, right? Because what will happen is price will come up, it'll hit your stop loss and then go straight to take profit. That happened to me all the time. So the way to counter this and what smart traders do and what smart money traders do is they wait for something called a liquidity sweep, which is simply just a stop run, right? That's all it is a stop run. And because we're bearish, we want to see a stop run, right? Against some sort of high, right? Because lots of people are shorting, they're trailing their stop loss, at this high, this high, this high, this high. All we need to see is some sort of old high taken out and then price to drop in the opposite direction. So what that looks like is we want to see this. We want to see price come down, price to come up, just enough to take out an old high where anyone would have their stop loss orders, then drop, give us our retracement here on a fair value gap, order block, optimal trade entry, whatever you like. And then we want to ride price down to either the next liquidity pool or just a 3 to 1 or whatever your take profit usually is. That's what we want to see. Now, can you see this little pattern, this little entry pattern, anywhere in price action around here, right? Now, I'm literally marking it out for you, but if you just look a bit carefully here, see this high here, you see this wick, this is so characteristic of a liquidity sweep, right? It's always like a little wick that just pokes through, takes out stop loss orders, and then drops massively in the opposite direction, right? So we've got some old high here. Lots of traders have their stop loss orders here because they're hoping that price is just going to drop and take out this low here and just drop down, right? What really happens is price comes up. Just look at this candlestick here. This wick pokes through, takes out anyone who was short here, then drops, gives us our high probability retracement. Now, I'll explain that in more detail about the actual retracement. And then dropped massively. I guarantee you, if you go through your charts and you look at any massive move in one direction or the other, there will always be a liquidity sweep, right? So now that we've got our liquidity sweep, which is this wick here, this wick that pokes up and takes out these stop loss orders, all we need now is a high probability entry. Now, what I say to my students is whenever there's a liquidity sweep, and if you're not sure, wait for a fair value gap to form, because fair value gaps, it's almost smart money literally screaming at you that this was a fake move, right? Look at this. This wick comes up, takes out this old high, and a massive aggressive fair value gap that's bearish with the overall trend, which we just discussed a few minutes ago. On the 15-minute chart, right? Not the 1-minute chart, the 15-minute chart, a major significant time frame. All day traders are looking at this time frame, right? All day traders. So what you're going to do is once you've got your liquidity sweep and you've got a bearish fair value gap that's in the trend direction, is you look for your entries. Now you can either, I'll show you a few entries right now. The entry at this point doesn't really matter. You can take a really easy, safe entry just by using the fair value gap itself. Now, I always say this, when you have a liquidity sweep, and this is so important, make sure you write this down. When you've got a liquidity sweep, you have to have your stop loss at the high or low that caused the liquidity sweep, right? There is no point waiting for a stop run, right? No point waiting for this high to take out this old high if you're going to put your stop here, right? There is no point in doing that. The only reason we wait for a liquidity sweep is so we can put our stop loss in a safe area, right? I hope you really understand that. That's the only reason we wait for it, is so we know, okay, if I put my stop loss here, right, at this high, very, very unlikely that price can come all the way up and take out my stop loss because it already did that, right? Very important that. So your stop loss is essentially fixed at this high here. Now, if you want to get onto the lower time frames and finesse your entry, by all means do it, but never, ever, ever move your stop loss tighter. Never, ever do that. Not when you've got a liquidity sweeps. Now, for take profit, me personally, I target a 3-to-1. So let me just mark this out, right? Like that, right? So this is my 3-to-1. This is what I target. If we zoom out, easy liquidity here, right? So it's just a bit extra, but you could just target this liquidity as simple as possible, right? Easy 2.5 risk to reward ratio with a big wide stop loss. Now I'm going to show you. Let's just remove this. Let's go and not finesse the entries, but let's go and refine the entries, because right now we're on the 15-minute chart. Now, as long as you've got the 15-minute, let's just zoom out, right? As long as you've got the 15-minute trend and you've got a 15-minute liquidity sweep, you can get on the lower time frames at that point and look for your entry, right? So here's our liquidity sweep. Let's get onto the lower time frames and look for an even better entry. Okay, so here we are on the 5-minute chart, and if you just look at price action, right? This was the old high. Here's the little wick on the 15-minute chart that pokes up, takes out the high, price drops, and this was our retracement, right? And we entered on a fair value gap that was really big and a really wide stop loss, and then price drops to take profit, right? So if you wanted to finesse your entry, and I keep saying finesse, but it's more about refining your entry. What you're going to do is you're going to look for a fair value gap on the lower time frame. Now there's multiple fair value gaps here. So there's a tiny one here, one here, one here. This is really important now, so make sure you write this down too. When you are bearish, you want to take the highest fair value gap that there is, right? So you want to take the highest one here. And when you're bullish, you want to take the lowest fair value gap. So you take this one here. Now, obviously, from what, all the technical analysis we've done, we are bearish and only looking for shorts, right? So if you're bearish and you're only looking for shorts, you are going to take the highest fair value gap, right? You're not going to take the lowest, you're going to take the highest fair value gap. So let's mark this out. It's a bit more clearer. You're going to take this one here because it's the highest fair value gap. That right there will make you so much more money. It's insane, right? So much more money. It's insane. So this is your entry. Stop at the high. Always remember, always fix at the liquidity sweep high, and then take profit. For me personally, I'm going to target at least a 3-to-1. Right? At least a 3-to-1. But if we zoom out, where's that old low? Sorry, here's the old low. Let me just mark this out for you. Old low. That's like literally beautiful, isn't it? Textbook, right? 4-to-1, easy 4-to-1, and you can refine this entry even further, right? So you can take this order block here, so the last up close candle before the down move. So what that would look like is you'd have your entry like that, and you just get tagged in for a beautiful and almost a 7-to-1, absolutely beautiful trade. But key thing is 15-minute trend, 15-minute liquidity sweep, and then high probability entry, because the reality is any entry after a liquidity sweep is super high probability. So, okay, so for this model, we only need 3 things. We need the trend, we need liquidity, and then we need a simple Fibonacci retracement or optimal trade entry, right, for our entry pattern. Now, we're only going to use the 4-hour chart for this model. We don't need to use the daily chart or the weekly chart, right? I'm keeping it as simple as possible, and this is what I do on a day-to-day basis, and literally with so many different setups. I think I've got at least 30 pairs on my watch list, and crypto too, so maybe like 40. And you'll see the setup over and over and over again. So what you want to do is, first of all, you want to zoom out on the 4-hour chart, and you want to ask yourself, what's the overall trend of this market, right? And there's 3 things for a trend. Most people don't understand this. There's 3 different types of trends. There's the first one, which is a simple bullish trend. There's the second one, like this, which is a simple bearish trend, right? And then there's the third one, which is just consolidation, right? Like this, consolidating, like that, right? Now, hopefully, it's pretty clear that we are bearish, right? Ever since this point, literally July 2024, we've been bearish. Now, we've had a bit of consolidation here, but we're not trading this. Again, consolidates a bit, but where is price actually going, right? It's dropping, it's giving us retracement, and what we want to do is we just want to ride price down to lows here, here, and here, and even this low here, where there's going to be lots of liquidity, which is simply just stop loss orders. So let's just clean these charts and let's zoom in. So the first thing we've got is our trend. We know we're bearish, right? So what that means is we're only going to look for shorts. We're not going to do anything fancy. And to be honest, if you're trading against the trend as a swing trader on the 4-hour chart, you're going to get punished. You're going to get punished, and you're going to lose a lot of trades. And I think it's almost impossible to become profitable if you're trading against the trend on the higher time frames, right? If you're scalping on the 1-minute chart, you can dance around on the lower time frames, but on the higher time frames, this is where the big boys trade, right? This is where the big banks are trading, and you can't fuck about on these time frames, right? So here we go. So we've got our trend. What we need to do now is we need to ask ourselves, where is price likely to go, right? And for those who don't know, price only moves for stop loss orders, or what we call liquidity, right? The same thing. It moves for where the money is in the market, because those who are moving billions, JP Morgan, Goldman Sachs, Barclays, HSBC, they can only get in and out of their positions at major highs and major lows on the 4-hour chart, the daily chart, the weekly chart, right? I.e., where would people have their stop loss orders? So think support and resistance, right? Where would people have their stop loss orders? And liquidity gives us our target, right? This is super important because not many people understand this. Liquidity isn't an entry pattern. It's not some sort of technique. It's just, it's the way the markets move. It's a concept, right? It's a theory in the markets, right? It gives you the direction of the market, right? Once you've got the direction and you've got your target, you're 90% of the way there. All you need is a simple entry pattern. I'll show you a simple entry pattern afterwards. But because we're bearish, right? Remember, we're bearish because of the trend. We're not going to look for this high here or even this high here, right? We're not going to say, oh, well, Atif, well, isn't there stop loss, orders at this high and this high? Yes, there is, but the trend, the 4-hour trend, is bearish, right? So what we've got to ask ourselves is, where is, at this point here, where's the next major lows that have liquidity at them, right? Not the highs, because we're bearish, right? We're bearish, so if we are bearish, what's price going to do? It's going to go down. It can go for this low. You might be thinking, oh, there's lots of liquidity at this low. Yeah, there can be, but this low here, I like a lot because it's been here for a while. And in general, this is a general rule of thumb. The longer a low's been intact, so the longer the low's been there, the more stop loss orders there are there, because people feel confident, right? They feel confident. This is you got to think, this only formed, relative to this bit of price action. This low here only formed maybe like 2 days ago. Where this has been here for a few weeks, right? So it's a lot more important, especially these lows here, right? So what that really means is, for our target, this price is likely to go for this low here, right? This low here where there's lots of liquidity, right? Liquidity, which is simply stop loss orders or money, right? Smart money can only get in and out of their positions at major highs and major lows. So this right here, and even this low and this low, is going to be our target. Now that we've got our trend, which is bearish, and we've got our target, all we need now is a simple entry pattern. Right? A simple entry pattern. And for me, the entry pattern that I like the most is a simple optimal trade entry, which is just a Fibonacci retracement, right? It's nothing fancy. Now, people are going to ask me like, hey, should I put it from this high or this high here? For me, whenever I'm in doubt, I always put my Fibonacci from the highest high to the lowest low, right? If you're ever unsure, right, because a lot of people can think, should I put it on this high here, like this, or should I put it on this high here? If you're ever unsure, put it at the highest high, right? Similarly, when you're bullish, put it at the lowest low. When in doubt, zoom out, right? When in doubt, don't put the Fibonacci super tight, right? Go out. So for me, I'm going to put the Fibonacci here. And if we just remove the Fibonacci, Another thing, and this is some of your notes right here. Can you see this fair value gap? Never, ever, ever put your stop loss right next to a fair value gap, right? Really important that you want to write that down. Never put your stop loss at, right next to a fair value gap, because let's just imagine you did this. Let's just imagine you went short at this order block like this, and you put your stop at this high and you were going to target this low, right? Let's say this is your entry. It's very likely that price is going to come up, take out your stop loss here, and then hit this fair value gap, even this order block, and then drop, right? So really important that, really important. Never put your stop loss when there's a fair value gap right next to it, because you'll see price hit it over and over and over again. So what you're going to do instead is you're going to clear this up. Is you're going to put the Fibonacci from the high to the low. So let's just zoom out a bit. Fibonacci from the high, this high here, to the low, like this. Now, me personally, I like to enter, let me just show you my settings. Right, so make sure you pause the video. This level right here, 0.705 level, that's what I like to enter on. There is no magic in the Fibonacci. Fibonacci is not moving price. The only thing that moves price is liquidity, right? It's really important. This just gives me an easy entry pattern, so I don't have to guess, which fair value gap, which order block do I take? Oh, this fair value gap's too big, my stop loss is too big. It's the same thing over and over again. And you can take the 0.7 level if you want, but for me, ever since I started using Fibonacci, this has just been my setting, so it's just stuck, right? So use, just copy me, right? Just copy me and just do what I do, right? So it's just easier. And yeah, what you're going to do is you're going to enter on the 0.705 level, like this. Your stop's going to be at this high here, and you're going to target a 3-to-1, or you can target this liquidity if you really want to, right, for 3.2. Doesn't really matter. Now, some people might be asking, hey, Atif, do I need a liquidity sweep? No, you do not. This is really important now. If you don't know what a liquidity sweep is, great, great, right? If you want to be a swing trader and you don't know what a liquidity sweep is, you're probably at an advantage, right? But if you do know what a liquidity sweep is, when you're in the higher time frames, there are liquidity sweeps, but there's a lot less liquidity sweeps than there are when you're day trading and scalping, which is another reason why I really like swing trading, because it's so easy. Because the reality is, this is a major market. All financial markets are major markets. Billions of dollars are being moved in. There isn't much time for price to mess around and take out stop loss orders and then go in the direction, right? Think the reality is, this is NZD/JPY, the New Zealand dollar against Japanese yen. There is real business that needs to be conducted here. There's central banks that need to do business deals between each other. New Zealand and Japan. They haven't got time to really fuck about with liquidity sweeps, messing around on the lower time frames. If price needs to move somewhere to the liquidity where the money's at, it's going to move, and it's going to move quickly. Now, on the lower time frames, will there be liquidity sweeps on the 1 minute, 5 minute? Yeah, but there's not going to be that many on the higher time frames. So if you've got the trend and you've got the liquidity, right, you know where the money's at, you know where the market wants to go for. You've got the trend, you've got your optimal trade entry. You can make money with that, right? And in fact, that's probably the highest probability setup. If if you're waiting for liquidity sweep, you're gonna be waiting for years. Yeah, you're gonna be waiting all day for it, right? And you're not gonna find any setup. So you don't need a liquidity sweep when you're on the 4-hour chart and above, right? Now, if you get a liquidity sweep, it's gonna add to probability, but you don't need it. You do not need it. But if you're day trading, if you're below the 4-hour chart, you need it, right? You need it to become profitable. So really important there. Yeah, so you're gonna set up your limit order. Enter here, stop loss at this high, take profit either at this liquidity low here, or a 3-to-1, or if you really want to, it can be all the way down here, right? But I'm just going to target, for me personally, I just target a 3-to-1, so let's just play price action, right? Like this, right? And then there we go, it takes out all these lows. So if you really wanted to, that could be your entry, and that could be your take profit. But and again, look, you'll notice, right, look, what does price do? It wicks up, hits the fair value gap, fills it, hits the order block, and then drops, right? So if you had your stop super tight at this high here, you would have got wicked out only to see price go off in the opposite direction, which would have been very, very, very frustrating. Okay, so for this strategy, we need 3 things. The first thing we need is a liquidity sweep or a stop run. Second thing we need is a fair value gap. And the third thing we need is we need to trade at a key time of day. Now, when you get on the charts, the easiest thing to do is just to have one session that you master, right? It really does not matter what session you use, because you'll get this model or this setup in every single session if you actually look at carefully, right? So you might need to get onto the 1 minute chart. In this case, we're going to be on the 5 minute chart. It really does not matter. You can replace the 5 minute with whatever time frame you like, right? But here we are on the 5 minute chart, on goal, during Asia, which is a key time of day. And for those who don't know, Gold moves really well in Asia, really well. I used to trade London, and I'd get onto the charts and I'd see gold had moved so much, and I'd missed the main move in Asia. But anyway, don't worry, right, if you trade Asia, because if you trade Asia, you can get some excellent moves in gold. And what we want to see, right, now that we've got our key time of day, is we want to see a stop run. Now, the most easiest way to see a stop run is to see some sort of large wick, right, some large wick that just pokes up randomly and then drops aggressively in the opposite direction. And then ideally leaves a fair value gap, right? That is the easiest way to spot a stop run. Now, if we look at gold, we've got highs here, here, right? Around this level here, lots of people are putting their stop loss orders, shorting gold, right? They want to ride gold down to probably these lows or 11, right? And even if, gold's bearish, I'm not going to determine how it's bearish, right? You can use daily bias. And to be honest, when you're scalping, you do not need to use bias at all, right? You just need to look for a liquidity sweep and a fair value gap. But can you see how this wick just aggressively, instantly goes all the way up, takes out anyone who had their stop loss orders, and then drops off massively, right? Look at this. Look at this wick here. This is the wick that's a liquidity sweep. Look at this. It goes instantly up, takes out all the stop loss orders around this high, drops aggressively, gives smart money that high probability retracement, high probability entry, and then drops off massively, right? You'll see this out every single day. It's insane. And if you don't believe me, go look in the comments, right? So many traders have become profitable using this. This is what I use literally to retire my mum, right? To retire my whole family on this exact setup here. Liquidity sweep, fair value gap, entry, right? And lots of people ask me like, hey Steve, how do I know it's really a liquidity sweep? The easiest way to understand if it's a liquidity sweep is obviously first wait for like some, large wick that takes out a stop loss, and then wait for a fair value gap to form in the opposite direction, right? Only once this fair value gap forms like this, like that, right? Let me just make this a bit more clear. Only once this forms do I know that it's a liquidity sweep, right? Or to be honest, only at that point is it a high probability liquidity sweep, right? You don't need a fair value gap, and with experience, you won't need it. But if you're a new trader or if you're unprofitable, make sure you wait for a fair value gap, because the fair value gap is essentially smart money telling you, screaming at you, saying, hey, look, this is a fake move. This is a fake move, because the only reason this fair value gap's here is just to allow smart money traders to get back into the move, right? So once you see that fair value gap, that is smart money telling you at a key time of day that was a liquidity sweep, that was a fake move, only designed to take out stop loss orders. They're literally telling you, hey, look, we're all going to enter here. Come join us. Come join us, right? So once this fair value gap forms, then and only then am I confident that this is a liquidity sweep, right? This is a fake move only designed to take out stop loss orders. Now, you might hear some people talk about turtle soup. Let me just explain that very quickly. Right? You might hear some people talk about turtle soup. And what that is you see how price comes up. At this point right here, when price is taking out these stop loss orders, price can continue all the way up. It could take out this high, and it can go up and up and up, right? Like, who knows what could happen? I don't know what could happen, right? So there are traders who are called turtle soup traders who will start to sell as soon as price takes out these highs here, hoping that price drops massively. If it does drop massively, they'll make a shit ton of money. If it doesn't, they'll get fucked, right? That's just the way it is, right? Their stop loss will get hit instantly, and it's very low probability, right? So when you wait for confirmation, right, this is our liquidity sweep, and then we've got the fair value gap, which is our confirmation, and then you enter on that confirmation. That is a really, really high probability setup. Okay, so how do we actually make money with this model, right? It's the only thing we care about. So we've got our liquidity sweep, which is just a stop run, so don't let the terminology confuse you. It's the logic that matters, right? And just look at this. Look how obvious this is. Look at this large wick, shoots up, and then instantly drops down, right? Clear, obvious liquidity sweep, and we've got our fair value gap. If you want to, you can get on the lower time frames and look for a better fair value gap. And by better, I mean a higher fair value gap. And just to answer a few questions, some people might ask me, hey, how come we're not entering on this fair value gap? This is something for your notes, right? So make sure you pay attention to this. When you're bearish, you always want to take the highest fair value gap. And when you're bullish, you always want to take the lowest fair value gap. So because we're bearish, we're only going to look for the highest fair value gap. We're not going to look for this one here. We're only going to look for this one here. And then for your entry, you can enter on that fair value gap. Stop loss is fixed at this high here. Super important, right? This is a liquidity sweep high. The only reason we waited for a liquidity sweep is so we can put our stop loss at a safe area, right? Because price came up, it took out all these stop loss orders, dropped massively. Very, very, very unlikely that price is going to come all the way up and take out your stop loss and then drop off again, because that's what price has already done right here. Right, that's what price has done right here. The only reason this came up, only reason price came up was just to take out stop loss orders. So very, very unlikely that's what's going to happen. What's more likely is that price is going to come up to this fair value gap, maybe touch the order block, and then drop off massively, right? That's what's likely to happen. So your stop is fixed at this high because it's the highest probability of your stop loss not getting hit. Now, I'm not going to get, onto the 1 minute chart or even the second chart. If you do, you could probably find like a little, you probably find like a little fair value gap here, right? Use your imagination. That's almost beautiful, that. But you might find a fair value gap on the 1 minute chart that you can enter on, right? The highest bearish fair value gap on the 1 minute chart, get a tight entry, but your stop loss is always fixed at this high, right? So if you want, a tight entry, tight stop loss, you're gonna have to get onto the 1 minute chart, and then find like another fair value gap, or even the order block if you really want to. But for this model, I'm just gonna use the 5 minute chart, and we're just gonna look at the 5 minute fair value gap. Stop loss fixed at the high. What you're gonna do is you're gonna target at least a 2 to 1, minimum 2 to 1, minimum 2 to 1, just because like you can get it so easily. Like, why would you ever aim for a 1 to 1? For me personally, for those who know, I target a 3 to 1, like a fixed 3 to 1. So like this. Now you can target these lows if you really wanted to. For me, 3 to 1 is what I love. And because we're in Asia, let me just make this a bit more clearer. Because we're in Asia, so here's our liquidity sweep. Let's make this a bit smaller. Here's your liquidity sweep. Right here, liquidity sweep in Asia. Drops, fair value gap, high probability entry, price drops massively. It almost takes out this low, and then it goes up just because it's London. And if you look really carefully, this is something for your notes actually, or something for your, your own independent study. You go really carefully here. See this high? Price just takes out this high here, right? And then drops off massively. Now, if you get onto the 1 minute chart, you'll see the same setup here, right? This wick will take out this high here. It will drop, then it'll give you a fair value gap. This exact same setup will be on the 1 minute chart here. And you can almost see that, right? Because there's like 2 or 3 candles on the 5 minute chart, which will be about 15 candles on the 1 minute chart. But anyway, doesn't really matter. Point is, you get your take profit hit early London, and you'll see this setup over and over and over again. And like I said, I'm not going to do it in this video because it'd be too long, but if you get on the 1 minute chart, you'll see the exact same setup on the 1 minute chart, and then you can ride price down, right? It'll probably look something like this, right? Something like this. You get your 3 to 1. And if you really want to, you can ride price down. Right? And if you look again in New York, this candlestick here, let me just delete this stuff here. This big candlestick here takes out London's high here, and then starts to drop. So if you get on the 1 minute chart again, you'll start to see a fair value gap form, bearish fair value gap, enter on the bearish fair value gap, ride price down, right? You'll see this setup over and over and over again. But if you're starting out 5 minute chart, you'll get, it's easy to see on the 5 minute chart, and with more experience, or if you want, a tight stop loss, you can get down onto the 1 minute chart. Okay, so the first step in this process is we identify liquidity on the higher time frames. Now, when I say higher time frame, I literally mean the daily or 4 hour chart. Now, you can use either, but in this example, I'm going to use a daily chart just because it makes it, it's so obvious where the actual liquidity pool is. Now, liquidity, for those who don't know, it's simply major highs and major lows where there would be stop loss orders, right? Because the only reason, and it's super important, the only reason these markets move is for stop loss orders, right? It only moves for where the money is at. And to be honest, if that's the only thing you take away from this video, you've literally changed your entire perception of trading, because it's not indicators, it's not VWAP, it's only for money, right? Those who have billions need to get in and out of their positions, and the only way they can do that is at major highs and major lows where there's lots of stop loss orders, right? Where there's billions of dollars worth of orders resting at these stop loss. Now, you'll see a million different ways of identifying liquidity, but the simplest and easiest way that I literally give my private students is to get on the charts, right? So let's imagine you're on the charts at this point here, and then you just ask yourself which major high or low is price likely to go for, right? Which major high or low here is price most likely to go for, right? So if you're on the charts at this point right here, and then you click, the daily chart, what high or low is price likely to go for? Is price more likely to do this, continue upwards and take out this high here, maybe even this high here, and then maybe push up to all-time highs? Or is price more likely, right? Is it more likely to come all the way down and take out these lows here, right? Which one's more likely? Now, hopefully it's pretty obvious, and it should be really fucking obvious, right? Because I've literally marked out the liquidity or stop loss orders, right? We're gonna go for this high, right? Price is literally right at this high. We've been bullish, and very, very unlikely that price can come all the way down and take out this low, right? Very, very unlikely. So What does this actually mean, right? What does this actually mean? Because we all hear about liquidity, liquidity, liquidity. It's like some buzzword that gets thrown around. What does this actually mean? If price is most likely, or it's very likely to come and take out this high here, what does that mean for us as traders? How do we actually make money from this? What it means, and this is something that you want to write down in your notes, it means that we are bullish and we only want to look for longs. Right? Super important. There's no point identifying liquidity here and then, going on the 5-minute chart and then, selling at some random fair value gap. There is no point in doing that. This tells us the direction of the market. We know the highest probability setups are going to be in the direction of the liquidity, right? And this right there, once you've got your liquidity, once you've got your direction, you are literally 95% of the way there. All you need now is a simple entry pattern, and then you can start making money right away. Okay, so for step 2, we want to look for something called a liquidity sweep, right? And this is simply just a stop run. All we want to see is a stop run before we can enter, because, and you've probably seen this so many times, right? The markets do not move, in straight lines like this. You can't just buy the dip randomly and then hope that price goes up, because you will see 9 times out of 10 what actually happens is this, right? What actually happens is price goes up, it comes down, it takes out your stop loss, and then goes straight to take profit. Now the reason this happened is because, like I said, right at the beginning of the video, these markets only move for stop loss orders, right? Super important that you understand that. These markets are highly, highly manipulated, and they're designed not for me and you to make money, right? We are literally completely irrelevant. Completely irrelevant. It's designed for those who have billions to get in and out of their positions, right? So their algorithms, which trade the lower time frames, are literally coded just to hunt stop loss orders, right? And where you'll find, major stop loss orders, or at least on the 5-minute chart, you will find it at lows and highs, right? Major lows and major highs. That's where you will find your stop loss. Where you'll find stop loss orders, right? Now, can you see anywhere in this bit of price action? I know it's a bit messy, but the reason why, it's actually the weekend for crypto. So crypto tends to be a bit, choppy during the weekends. But anyway, doesn't really matter. This concept here of liquidity works on every single financial market, right? Even the Indian stock market, for the guy who was asking, right? Even on that, it works on literally every stock market. If you see candlesticks like this, liquidity will work, right? If you're trading meme coins, whatever, liquidity will work. It's how all markets move, right? So here we go. Can you see anywhere in this bit of price action, can you see price coming down, taking out some sort of old low where there might be stop loss orders, and then going off, and then coming back down, let's say here, giving you a nice entry, and then shooting off? Like, can you see that anywhere in price action? Now, I'm saying this rhetorically, right? Because you should be able to see it unless you're blind. I'm literally showing it to you. Can you see how price comes down here, takes out this low here, where there would be stop loss orders? Notice this, right? This is how you know it's a liquidity sweep. Really important here, so make sure you pay attention. This is how you know it's actually a liquidity sweep. Can you see how the candlesticks just slightly go below this old low, just enough to take out stop loss orders, and then quickly and aggressively shoot off in the opposite direction, right? Can you see this? Look how price comes down just enough, just slightly below this low, where there would be stop loss orders, to take out anyone who had their stop loss orders here, because not everyone puts it exactly at this low. They put it around this level here. So price comes down just enough to take out stop loss orders, quickly and aggressively shoots off in the opposite direction. That right there is a liquidity sweep, and you will see that in any market, right? Whatever you like to trade, get on the 5-minute chart and you'll see this. And the key thing with liquidity sweeps is all the explosive moves will always occur once there's been a liquidity sweep. And the reason for that is because it allows smart money, big banks, whoever's got billions and stuff, to actually get into the position, right? Because the reality is these markets aren't going to move unless those in the know, those who have billions are actually in the market, right? They need to actually get into the market, and they can't just, they're not like me and you. They can't just, sell at this, fair value gap and actually get in, right? They're not using fucking TradingView, are they? Right? They're moving billions into the market, and the only way they're going to get in is by taking out stop loss orders. And it's nothing personal against you, right? People are like, oh my god, market makers are hunting me. They're not hunting you. They're just hunting whoever's got stop loss orders there, right? So to actually make money in trading, we need to wait for this liquidity sweep. We need to wait for a stop run, right? So once we've got our liquidity sweep, then and only then do we actually look for our entries. Super important there. If you don't have a liquidity sweep, you will not make money. And that was me for 4 years. 4 years of trading. I put so much time, so much effort in it, and I couldn't make any money because, I'd get the direction, right? I understood step 1. I understood step 3, which I'll tell you in, literally a few seconds, right? But I didn't understand step 2, right? What would happen to me is I'd get the direction, right? I knew liquidity was somewhere up here. Price would come down, it would hit my stop loss and shoot right off. And it was the most annoying, frustrating thing in the entire world. So once you've got your liquidity sweep and you've got your overall direction, which we just zoom out, this is our liquidity, right? You know, on the daily chart, which we talked about. We've got our direction, we've got our liquidity sweep, which gives you your edge, right? You don't have an edge unless you've actually got the sweep. Once you've got your sweep, you have your edge. All we need now is a simple entry pattern. Now, there are so many different entry patterns I can give you once we've got our sweep, but the key thing to realize when you've got a liquidity sweep is that your stop loss has to be at this low here. There is absolutely no point. Let's just imagine, right? This was an entry. Absolutely no point having this as your entry, right? Your stop all the way up here. Let's say at this fair value gap. There's absolutely no point of doing that, because the whole reason we wait for a liquidity sweep is so we know we can put our stop loss in the safest area possible, where it's highly, highly unlikely that it will get hit. Super important. So if you want to finesse your entry, by all means, you know, you can try and hit this little order block here or whatever, but your stop has to be fixed at this low here, right? So let's go for the fun part, right? Let's actually get some entries going. So right here is a fair value gap, and I always love to see this. So people ask me, you know, my private students mainly ask me this, you know, hey Atif, do I actually need a fair value gap to form for it to be a liquidity sweep? The answer is no, you don't need a fair value gap. But if you're starting out and you're not sure, I would say always wait for a fair value gap, because that, you know, once you've got a fair value gap and a liquidity sweep, it doesn't get higher probability than that, right? That is the highest probability thing that you can get in all of trading. Okay, so for your entry, there's really only 3 entries that I recommend to my private students that I teach them. You know, if you're interested in being a private student, you can check the link, you know, first link in the description. But what I teach them is to look for either a fair value gap, which we just discussed, an order block, which we'll discuss in a minute, or my personal entry, which is an optimal trade entry, simply a Fibonacci retracement. But for the first one, fair value gap, right? And these are the building blocks of every single trading strategy: fair value gaps, order blocks, and optimal trade entries. It does not get simpler than that. But for a fair value gap, what you're going to do is you're going to mark out this fair value gap here, and in the moment price hits it again, that's your entry, right? That is going to be your entry. Now, you know, some people might be like, hey Atif, you know, let me just mark this up. Hey Atif, you know, shouldn't a price like shouldn't it have hit it here? Like, you know, it has consolidated a bit. Is that okay? Yeah, it's completely fine, as long as the fair value gap is still fresh. Now what fresh actually means, as long as it's not being touched, right? As long as the fair value gap's not being hit, you are good to enter. You are good to enter, right? It's still valid. The only moment it's not valid is when it's being hit like this, right? We don't really want to see it come back down again, right? Not if we're bullish. So you can enter at this fair value gap like this. Stop. Remember, like I said before, always fixed at this low here, liquidity sweep low. And then for your take profit, you're going to target at least, I mean, you know, if you like a 2-to-1, by all means go for it. But come on, bro, let's go. Let's make some money, bro. Let's make 10K a month, right? We're not making, you know, 1K a month. Let's make 10K a month, boys. So here we go. Let's aim for at least a 3-to-1. If you want to, you can aim for, you know, look at this, almost triple highs here, right? Liquidity here, here, and here. But the key thing is we're trading in the overall direction. Now, I'm not going to say go target this liquidity, especially not as a day trader. But, you know, if you're a swing trader and for whatever reason, some swing traders, they like to do their analysis on the higher time frames and then enter on the lower time frames. If you want to, you know, you can do this, right? You can do this. But for me, and the most I would ever recommend is just a target liquidity here, which is literally a beautiful, perfect 5 risk to reward ratio like that, right? So let's just remove the fair value gap. For your next entry, we want to use the order block. Now, I'm not going to talk too much about order blocks here because there's videos on the channel discussing order blocks. But what an order block really is, it's the last down close candle before the up move. Now you've got this little doji candle here, but for me, I like the bodies, right? Because the body of the order block is literally where smart money has been trading. So let's mark out this candle here, and you can just merge the two together, right? It really does not matter. You're going to merge the two together like this, right? This is how you get some of your sniper entries, right? Look at that, minimal drawdown there, right? So what you would do, enter like this. Stop fixed at the low here, fixed at this low here, and then for your take profit, you're going to target at least, like I always say, at least a 3-to-1, or you can target these highs here, right? 5.3 risk to reward ratio. But lastly, last but not least, is my entry pattern, right? If you're like, you know, hey Atif, you know, what fair value gap do I take? There's a few of them. Which order block? You know, should this be an order block or that? I would strongly recommend just to use a Fibonacci retracement, right? Get your Fibonacci from the low to the swing high, which is this, or literally even this, but this is the highest a high, right, after the sweep, so we don't use this one. The name shouldn't confuse you, right? An optimal trade entry is simply a Fibonacci retracement. What you're going to do, though, is enter at the 0.705 level here. Let me just show you the fib settings, like this. Right, pause the video. This is the only one that matters, this level here. You're going to enter at this level, and then you're going to target either this high here for an easy bread and butter trade, or 3 to 1, like this, right? Nice and easy, nice and simple. Now, this, you might think, oh, you know, we get tagged in here and then it chops for a bit and it goes down and then goes out. And yeah, but the reason for this is because it's crypto during the weekend. And to be honest, like if you're a day trader like me, like who gives a shit? Like if you're in it, like if you're in the trade for like 4 or 5 hours and you make 3K profit per funded account, like who cares, right? Like to be honest, like who cares? If you want to finesse your entries, like I said, here's the fair value gap, here's the order block. So choose whichever one works for you, but personally for me, what I use is the optimal trade entry. Now, really important to remember, fair value gaps, order blocks, optimal trade entries, completely and utterly useless if you don't have liquidity and the liquidity sweep, right? They are completely useless. So make sure you've got liquidity first for your direction, make sure you have a liquidity sweep, and once you've got those two, you can look for your simple entry.
Okay, so for London session, what you want to do is you want to look between 2 a.m. Eastern all the way up until 5 a.m. Eastern, right? Always in Eastern New York time, always in this time. So 2 a.m. till 5 a.m. is London session. Now, London session will always do this. What it will do is it will accumulate around 2 a.m. It will consolidate a bit, gather stop loss orders. Then a fake move will happen, right? A fake move will happen, a liquidity sweep designed just to take out liquidity, designed just to take out lows. Then price will move in the real direction, give you lots of fair value gaps like this. Then it will retrace and then continue on, right? This is what London does consistently, day in, day out, right? So let me just do that again to make it super clear. So around 2 a.m. Eastern, so let me just mark it out around here. Price will start to consolidate like this, right? It will start to consolidate. The reason it does that is just to accumulate orders, right? Just to get people buying and selling, just to generate or engineer liquidity. Then what price will do is it will come down and it will take out all these lows here where liquidity was generated. It'll move off in the real direction. It will retrace down here. And then we want to enter on a fair value gap or even an order block, some sort of entry here. And then we want to ride price up, right? That is what London will do day in, day out. And if you don't believe me, go look at your charts. Go look at your charts. 9 times out of 10, you will see this. Accumulation, manipulation, distribution, whatever you want to call it. This is what happens, right? So to trade London session, what you're going to do is just honestly ignore like any price action before 2 a.m. I know, you know, it's going to be, you're going to miss some entries, but just ignore it. Like your time is much better off spent just looking at price action from 2 a.m. onwards and then wait for liquidity sweep on the 1 minute or 5 minute chart. You can do it on the 15-minute chart, but if you do use the 15-minute chart, you're going to get a lot less entry. But here we go. So run the 1 minute chart on gold and you can do this on any pair. And obviously GBP, USD, EURUSD and gold are probably going to be the best of London. And, you know, even Swiss franc too. What you're going to do, wait for the liquidity sweep that we have here, wait for price to quickly and aggressively move in the opposite direction, wait for fair value gaps to form, because the fair value gap, right, after the liquidity sweep, that tells us where price is actually going to go, right? That tells us that we have a liquidity sweep. Right here, I'm not buying price down here, because I have no idea where price is going to go. It could, you know, price could continue going all the way down here, right? But because price shoots off massively and aggressively, leaves fair value gaps, that tells me I'm on the right side of the market, right? That tells me that's just a fake move. Now, you'll see there's a fair value gap here. Let me just mark this out. There's a fair value gap here, but it's essentially filled already. Now, what I mean by that is, you see how the wicks come down, it's filled it, and it's instantly shot off massively, right? Very unlikely, especially if we're bullish, that price, after doing the liquidity sweep, is going to come all the way down here and give us like an insane risk to reward ratio, right? Very, very unlikely, because a real entry was here. Now, if you got the entry, you know, by, you know, fair play and stuff, but the real easiest entry, I would say, that we should all look for is this right here, right? Just take the easy fair value gap that forms here. So let me mark this out for you. Right here, the fair value gap that forms. And just look at this, right? You see this little gap here? Let me just zoom out to make this so clear. Look at like how obvious that is, right? Price just taps down just to take out these stop loss orders here, and it massively and aggressively moves on. Massive, big fair value gaps. That's telling us where smart money actually wants to move the market. Once we've got that, we're just looking for our entries, right? We're looking for our entries. And this is what I do. I was trading London for years. I'm in the UK, right? And this is what happens consistently. Now, for stop loss, it's so important. So important. Do not put your stop loss at the fair value gap here, right? Or, you know, at this low here. And I know, you know, this in this instance, you get away with it. But the whole point of London is you want to put your stop loss at the liquidity sweep, low or high, right? If it's bearish, you just flip on its head, right? But you always want to put your stop loss at the liquidity sweep low. Because I always say this, I'm gonna keep saying it till everyone's fucking profitable. It's very unlikely price gonna come all the way up, come all the way down, take out this low again, which was just a liquidity sweep. Very, very unlikely price gonna do that. Take out this low and then go all the way up like that. Very, very unlikely, right? Very. Now it can happen. I've seen it happen before. But, you know, very, very like unlikely that to happen. That's why we always put our stop loss at this liquidity sweep low. Very safe stop loss here. And then for take profit, I mean personally, I always target through risk to reward ratio, even when I was day trading and scalping, and just because I like it, right? It's a nice, easy risk to reward ratio. You can take a 2-to-1 if you want, right? Nice and easy, but especially if you're on the 1 minute chart, you can get some insane risk to reward ratios. But that is literally how you trade London. Wait, let me just show you again, right? Wait around 2 a.m. Expect to see some sort of accumulation. You might see this before 2 a.m. right? But some sort of accumulation like this. Expect price to do a fake move just to come out and take out some sort of stop loss orders, move off in the real direction, leave lots of fair value gaps, right? Leave lots of fair value gaps here, then enter on one of those fair value gaps, put your stop loss there, and then ride price up, right? That is how you trade London session. And yeah, let me show you how to trade New York session now. Okay, so we're in New York, and New York is 7 a.m. Eastern, all the way up until 10 a.m. Eastern. Now, in my experience, after years of trading, this is probably the easiest session because you don't need daily bias. And you don't need daily bias. The bias for New York is almost 9 times out of 10. It's the same bias as London, right? So if you just zoom out, London, it's obviously bullish, right? So for New York, all we're looking for is a continuation. Now, this is what London, this is what New York will always do, right? This is what it'll always do. So let's suppose this is London, right? London's moved up like this. It's bullish. Price will come down. It'll take out some sort of low. It doesn't have to be London's low, but it'll take out some sort of low, and it'll move off in the opposite direction. It will leave some sort of fair value gaps here, some sort of bullish fair value gap. We can enter on any of these entries and then ride price up, right? Notice how we don't have to wait for a market structure shift, right? And I'm a big believer in just ignoring market structure and focusing on liquidity. Now, a market structure shift would be if this, like, let's say this candlestick, the body closed above this high. That would be a bullish market structure shift. You can wait for that if you want, but you're going to miss so many good entries. So many good entries that, yeah, I'm telling you, if you just ditch market structure and focus on liquidity, your win rate will go up massively. But anyway, here we are on New York, right? So New York, any entry between 7 a.m. till 10 a.m. Is great. Even 11 a.m. really, 10 till 11 a.m. But at 7 till 10 a.m. is when you need to get the golden, I guess, meat of the move. Now, something you need to know, and you must know this for New York, is at 8:30 a.m. Eastern, there's almost always a news announcement. Now, sometimes the news announcements are insane, like CPI, which you avoid, because what you'll see, and you probably see this in your charts, right, is you just have like loads of little, little candlesticks like this, and then you'll see some massive candlestick where in like one candlestick it does that. That makes sense. And then it goes back to being normal. What that is, that's like a CPI where it's like a news event. And avoid those sort of things. But right here, we've got, I don't know what news it is. It really does not matter, by the way. Right? The news, like announcement, whatever it is, I do not care about it all. All we want to see is the price action, because the price action will tell you everything. So right here, and I hope this is really obvious, right, with this massive weight, this is just a liquidity, right? This is a fake move designed just to take out stop loss orders. The only reason price did that, right? I mean, just look at this way. Look how obvious this is. Price wicks down, quickly and aggressively moves off, right? I mean, if you really think about it, it quickly and aggressively moves off. There we want to enter on any sort of retracement. Ride price up, right? The same old thing that we always see. Liquidity sweep, massive movement in the opposite direction, and then enter on any sort of entry. Now, this is really important, right? Because right here, we've got, the safest stop loss is going to be around here, right? It's going to be around here. Now, that's a massive stop loss, especially if you're entering on a fair value gap. And you don't have to enter on a fair value gap. This is really important. You don't have to enter on a fair value gap. It's just for new traders, it's really easy to spot. And for me personally, for those who know how I trade, I take like an optimal trade entry. And when I was day trading, right? So I would literally enter at the 0.705 level, like this, right? Like that. Stop loss at the low. And then usually I target a free risk to reward ratio. Like that, right? That's my entry, right? Obviously, I need the liquidity sweep first, right? I don't have a liquidity sweep, I'm not trading. But once I got a liquidity sweep, I will take just an optimal trade entry, Fibonacci retracing. Because I'm confident in the bias. I've seen this so many times. I know this works. But you don't need a fair value gap, because right here, if you've got a fair value gap, you're going to have to put your stop loss here. Let me just show you what I mean, right? You enter here, you have to put your stop loss all the way down here, which is the massive stop loss. What you can do is you can enter on this order block here, right? And I've got a video on order blocks, lots of order block videos. Now, this is quite interesting. There's an order block here, here, and here. So it might be confusing to you about which order block to do. Is it this one? Is it this one? Is it this one? For me, personally, I like how these two red candles are almost together, like that, right? So let me just mark this out. This for me would be my order block, like this whole thing here. And just look at the bodies, man. Look how the bodies almost perfectly respect this. They wick into it and instantly shoot off. That right there For those who are asking, that right there is respect of an order block. Price taps the order block, quickly and aggressively moves off in the opposite direction. That's when, when people say price has respected the order block, it's respected the fair value gap. That's what that means, right? It's tapped it and it's instantly moved off. So right here, I would enter, let's just say if I didn't want to enter the fair value gap, I would enter on this order block here, like this, right? Like that. Now my stop loss would have to be at the liquidity sweep low. Yeah, right. Let me just mark this out right here. Has to be at this liquidity sweep low. Now you might be asking, like, what low did it sweep? Like, there's so many lows here that it's just trailed up, trailed up stop losses from. We zoom out, right? So many people are just trailing up their stop losses all the way up here. So any sort of lows that are taken, and that's our liquidity sweep. Now you don't have to be dead, rigid and with your liquidity sweep. It doesn't have to be, it has to be a perfect swing low. Which low does it have to take out? You just have to look at price action, right? Just look at price action. If you get on the charts, let's say at this point here, and you've seen this massive wick that's only come down to take out stop loss orders, it quickly and aggressively moves off in the opposite direction. And if you zoom out and you know that New York is almost always a continuation of London, right? And London's been massively bullish, it's a safe bet, right? It's a safe bet that any sort of retracement will do. So what you're going to do is, let's say you want to enter on the order block, stop loss at the liquidity sweep low always, and then you're going to target at least a 2-to-1, or what I always do is target a free risk reward ratio, like that, right? Like that. And remember, we're on the 1 minute chart here, so what time is this? It's about 9:37, and then when do we get take profit? So it's literally about 30 minutes in a trade. And if you're risking 1% on a 100k account like I do, that's like 3k per trade, per funded account. It's a lot of money, boys. A lot of money for half an hour. Yeah, that's my old monthly salary paid in half an hour. So, and you can do this exact same thing on the 5 minute chart too, right? So, price is fractal, and what that means is literally forget the time frame, just blur that out. This would be the exact same thing, even on the daily chart. It's the exact same thing over and over again. Price is the same thing. And yeah, so New York, almost always, 9 times out of 10, is a continuation of London. All we want to see is, let's say, London's bullish. We want to see a massive bullish movement on London. And then we want to see some sort of liquidity sweep, right? But it doesn't have to be London's low. It can be if you want to wait for it. But any sort of low will do, right? Any sort of, fake move, any sort of large wick that takes out stop loss orders. That's what we want to see. And then we want to see price massively move off in the opposite direction, leave fair value gaps, and then we want to enter on, let's say, a fair value gap, order block, an optimal trade entry, but we want to put our stop loss at the liquidity sweep low, right? A safe stop loss, and then we want to ride price up for a 3 risk reward ratio usually, or a 2 risk reward ratio. Yeah, you guys get the point, right? So for the last session, last but not least, I'm gonna show you how to trade Asia session, and I'm gonna do it all in gold because I like this pair and you guys like it too. So let's get to Asia session. Okay, so for the last session, we have Asia, which is 8 p.m. Eastern time, all the way until midnight, right? So you've got 4 hours for Asia. Now, Asia almost always does this. If we just zoom out, here's our liquidity sweep. What Asia tends to do is, let's suppose we're bullish on the higher time frames, right? So let's say this was London's move, like this. Let's say this was New York's move, where it's, let's say, retrace. It's taken out London's low, and it's gone off like that, right? So it's continued London's trend. What Asia tends to do is it tends to be a retracement on the higher time frame. So if you're bullish overall, like we are here, what you can expect Asia to do is have a little bearish retracement, right? Maybe something like that, right? And then for London, what London can do is London can continue, New York can sweep it, and then continue off, right? So on the higher time frames, Asia tends to be a little bit of a retracement because it's out of all the 3 sessions, London, New York, and Asia is always the quietest. And just the way it is. So Asia tends to be a little bit of a retracement on the higher time frame. But what that means is, let me just remove this. What that means is, let's say you've been bullish overall in London, New York, you can expect a bit of a retracement going, let's say, in Asia, right? And then for London, it will continue the trend overall. But what that means for us is we're going to look for our liquidity sweep. Now, if you just zoom out, and on the 5 minute chart, this will be a lot more obvious, but like I've just taught you guys on the 1 minute chart because it's just easier, isn't it? So here we go. And here's your liquidity sweep, right? Here's our liquidity sweep. And you can just tell, right? I mean, you can always tell by looking at price action when you get these little wicks like that, right? See these wicks here? You see how price just wicks up, takes out stop loss order, moves down, retracement up, and then like that, right? That's what we want to see. So what we have is we have our liquidity sweep like this. What we want to wait for, let's make this a lot, what we want to wait for is our fair value gap, right? We want to wait for our fair value gap to fall. Now, this is really important. This is really important. Let me make this even more bigger. Right. So right here is our fair value gap. Right. This is our fair value gap, like this. Now, price has filled part of the fair value gap. Right. It's filled part of the fair value gap like that. That means that this right here is the remaining fair value gap. I won't fill that in properly. This right here is the remaining fair value gap. Right. That's our remaining fair value gap that we can enter. Now, for loads of you who are very eagle-eyed, you might, and I don't want to talk about this, guy. I almost never talk about this. You guys might recognize this is an inversion fair value gap, right? This right here is an inversion fair value gap, which is a fair value gap that's been disrespected, and then it almost acts as the opposite direction. So this would have been a bullish fair value gap where price would have tapped it and moved off like that, right? That's what a bullish fair value gap would have done. But because price has broken the fair value gap, right? This fair value gap will almost become, this bullish one almost becomes a bearish one like that, right? Now, I don't want to talk about that because I've almost never talked about inversion fair value gap, just because I want to keep it very simple. If you could spot that, congratulations, you know a lot about trading. But that's why we have this, I guess, almost partial fill of the fair value gap. It's because there's an inversion fair value gap there. All you guys need to know, all you really do need to know, is that, let me just remove this. What you do need to know is that there's a decent amount of this fair value gap still left, right? So it's very likely that price is going to come and then fill it up, right? If you have, and this is what some people get confused about, if you have, like, let's say this was our little fair value gap, right? Let's say price had wicked all the way up here and there's a tiny little gap. Ignore it, right? Ignore it. Price isn't going to do that. But because the fair value gap is still fairly big, because it's still fairly wide, we want to enter on that fair value gap, like that, right? So that's what we're going to do for our entry. If you guys really wanted to forget fair value gap, and you could just take the order block, which would be the last up close candle before the down move. But for our entry, in this case, I'm just going to give you the fair value gap. And I hope it's really obvious that the entry pattern is the least important thing. Right? I hope that's very obvious. The entry pattern is the least important thing. Once you've got the liquidity, and once you've got the logic of each session, and even an indicator will do. As long as you've got liquidity sweep, even an indicator will do. So what you're going to do is zoom out there. What you're going to do is you're going to put your stop loss at the liquidity sweep high. You just zoom out. This is the liquidity sweep high. You put our stop loss there. We're going to target, let's say a minimum 2 risk to reward ratio or a 3 risk to reward ratio. Now, you can, especially in the 1 minute, you can target, a high risk to reward ratio. But I just honestly, if you can get a 3 risk to reward ratio at 50% of the time, you can become a millionaire. You can actually become a millionaire. So, and pass any prop firm and make all the money in the world. So complete, make 10K, 100K a month, whatever you want to make. So you don't need an insane win rate or an insane risk to reward ratio. You just need consistency, consistent bread and butter setup. But yeah, and let me just give you guys more examples, right? So because I know this fair value gap might confuse a lot of you. And don't be confused about the entry. I don't want you guys to understand everything in this video and then be like, oh, what's an inversion fair value gap? You really don't need to know it. I'm always in two minds about keeping that in the video just because, but I know some of you understand what that is. For me, personally, this is my entry after years of trading, of being like an ICT chart student. What I would do, and like I said before, Fibonacci, let me just make this clear. Licks the optimal trade entry, which is a Fibonacci retracement, the easiest entry pattern in all of trading, right? Like that. No guesswork. I don't have to guess what fair value gap am I taking. Hey, the fair value gap partially filled, and this order box got a doji candle. Should I put my entry on the body or the wicks? None of that, right? Every single time it's the exact same thing. Stop loss always at liquidity sweep high or low, and then my take profit always a 3 risk to reward ratio, like that, right? Well, you guys, there you go. Right, nice and easy. Set up my limit orders. Once I get tagged in, I'm more of a one and done sort of guy. I let you close the charts and move on with my life. I let price do its thing, right? More often than not, you'll be right. And if you're making 3 times your money, let's say you're making 1K, you're making 3K per trade, you'll make a stupid amount of money. You'll make a stupid amount of money. But that's my entry pattern. And let's say you don't want the fair value gap and you don't like the optimal trade entry, what you can do. And this, actually, let me explain this because so many people I say so many people, a few people were asking me, hey, for the optimal trade entry, what high or low do I look for? You want to look at the most obvious highs and lows in price. Right? What's the most obvious, clear highs and lows? So I'll just go through the charts right now because I don't really want to make a separate video on it because we have a niche topic. So right here is an obvious low, right? Let me just mark this out. This is an obvious low. This is an obvious high. See this high here, right? Obvious low, obvious high. Obvious low, obvious high. Obvious low, obvious high. Obvious low, obvious high, right? Obvious low, obvious high. Obvious low. And then this right here would be maybe sort of an, iffy, maybe obvious high. I wouldn't really consider this a low. This is a very obvious high like that, right? So that's what I would do. Now, let me just make this clear. Some people might think that, is this a high? Is this a low? Is this got liquidity at it? Honestly, if you just focus on the major highs and major lows, and when you're in doubt, let's say you're in doubt, let me just clear this off. You're like, is this a low? What about this? Or this here? If you're in doubt, just focus on the most obvious ones, the most obvious lows, the most obvious highs, right? Make it clear, make it obvious. If you're in doubt, do not trade it. Just ignore it. So I hope that helps, because I know a few people are messaging me about, hey, I'm struggling about what high and what low to put on. So for the optimal trade entry, you wouldn't put it on this high here, right? You'd put it on this obvious low and this obvious high, right? If you wanted this to be your optimal trade entry, which you shouldn't have, because you should have entered on the liquidity sweep, but your optimal trade entry would be at this high and at this low. It wouldn't be at this high and it'd be at this high and this low, right? I hope that makes sense. Okay, so for the last bit of this video, right, because I know some of you will get confused with the fair value gap, some of you will get confused with optimal trade entry. The last entry plan, which I would always recommend, is just take the order block, right? Now, the order block is the last up close candle before the down move when you're bearish. So there's videos on the channel about order blocks, so don't worry about that. What you're going to do, enter on the order block, put your stop loss at the liquidity sweep high, like that, right? Like that. And then, look, I mean, right here, right, you're going to target, minimum free risk to reward ratio, in my opinion. You can target this low, right? Literally equal lows here. You could do that. And like I said, I wouldn't target an insane risk to reward ratio like that, right? Especially not these lows. You don't need an 8 to 1. You really don't need an 8 risk to reward ratio to be a profitable trader. And all you really need is a 3 risk to reward ratio. But that right there could be your entry, right? If you don't like fair value gap, you're confused about what fair value gap to take, if you don't know what high or what low to put Fibonacci on, just take the order block, the last up close candle before the down move. And those 3 entry plans are the 3 easiest entry plans in all of trading. Optimal trade entry, which is a Fibonacci retracement, fair value gap, and order block. Now, each and every single one of them will make you money as long as you wait for a liquidity sweep and you get a direction of the market right. But if you listen to this video and you understand each session, you can make money. Now, what I would say on years of trading is just pick one session and master it. Right? For me, it was London. For you, it might be New York, it could be Asia, whatever session it is. Pick one and master it, right? Master it, understand it, know how it moves. You can have, 2 or 3 pairs. So let's say for gold in Asia, because Asia is fairly quiet, I would trade gold and let's say GBP/JPY and maybe dollar yen or AUD/USD. Right? One of those pairs be quite good, right? And you'll see this entry pattern at least in one currency every single day, right? So there'll be a currency that will have this entry pattern every single day in Asia, in New York, in London. All you're going to do is find it. That's all you need to do as a trader.
So if you want to fix your trading psychology, you're going to have to fix your mind, right? Now, your mind is going to be represented by this circle here, and it's divided into 2 parts, right? You've got the conscious part of your mind and the subconscious part of your mind. Now, the conscious part of your mind, this is the logical part of your mind, right? This does all the thinking. This stores all your knowledge about trading, liquidity, ICT, indicators, daily bias. All of that is within the conscious part of your mind, right? And then the second part of your mind is the subconscious mind, right? This is the emotional mind. This stores all your emotion, right? Your FOMO, fear, greed, discipline, all of that is within your subconscious mind, right? So your mind is divided into 2 parts. Now you might be wondering, why am I telling you this? And it's for this simple reason right here, which changed my life, right? 95% of your actions come from the subconscious mind, right? Comes from the subconscious mind, not the conscious mind. So what that means, and bear with me here because this is so important. 95% of your actions come from the subconscious mind. And if you remember, your subconscious mind is the emotional part of your mind. It doesn't have any of the logic. It doesn't have any of your knowledge of liquidity, of ICT, of indicators. It doesn't have any of that. All it has is emotion, right? So 95% of your actions come from the subconscious mind. So it doesn't matter how much you know about liquidity, daily bias, ICT. If you can't fix your subconscious mind, you're never going to make money. And this is what happened to me. Within 2 years of trading, I had mastered technical analysis. I knew everything about liquidity. I could predict price on almost any asset, and I couldn't make money. I could not make money for 2 years. I understood trading, and for 2 extra years, I didn't make a single penny from trading. In fact, I lost so much money, and it was so just demoralizing and humiliating because I knew so much and I couldn't make money. And I was a laughingstock, bro. I was a laughingstock from all my mates because I was the most wise, knowledgeable, broke guy you'd ever met. And I don't want that for you because it took 2 more years of me having a model that worked but not making money, all because of my subconscious mind, right? And your subconscious mind has all of your emotions, FOMO, fear, and greed. And whatever is the dominant thought in your mind, whatever's the most dominant thing in your mind, comes and gets expressed through your body, right? Now, what that means is, let's say, because 95% of your actions come from the subconscious mind, if your overall, mindset is, I'm afraid to get into trades, or, I'm greedy, I can't, whenever price comes to my take profit, I just have to move my take profit because, I'm not satisfied with enough, or you over leverage. That is the most dominant thought in your mind, right? And what happens there is that gets expressed in your body, and that will control your actions, right? And then that controls your results or P&L. So what that means is, let's say you're afraid, like I was, right? For years, I was afraid to lose. Like, for whatever reason, I could win trades fine, but whenever I lost, I just like, I was so scared to get into a trade. Like I was scared to get into a trade. As soon as I saw any sort of drawdown or, price reversing against me, I'd panic, I'd close my position, I'd move my stop to break even. And what was actually going on is deep within my subconscious mind was this fear. And I don't know, it could come from childhood, past trauma, it doesn't really matter. All we know is that it's there, right? This fear, right, was in deep with my subconscious mind. And if you remember, 95% of your actions come from the subconscious mind. So my body and my actions would always be someone afraid to lose, right? So I was afraid to even get into trade. I'd see my setup and I wouldn't even take it because I was so afraid. And then what that meant was I'd missed so many winning trades and, my results were I made no money.
Now, broadly in trading, broadly speaking, there are two things that will hold you back. The first is fear and the second is greed, right? And usually people fall into one of two categories. They're either very fearful, they're very hesitant, they don't want to get into trades, they hate losing, and when they go on a losing streak, they start panicking, they get anxiety, they want to change models, and that's exactly what I was like, right? That's exactly what I was like. I was such a fear-based trader, and I'd be scared to lose, and, as soon as I lost, I'd be like, oh, I've done something wrong. I need to change my model. And that held me back for years, really. It held me back for years. I was very fearful. I'd be hesitant to take trades. So let's say I lost a trade, right? And my trade usually was like a fair value gap here. So like I would enter. I mean, this isn't my model, but let's just say this is my model, right? And let's say I'd lost, let's say, 3 trades before. I'd had a 3 losing streak, and this is my model. I would not execute it. I'd be so scared. I'd be here and I'd be so scared thinking, oh, what if price like goes up and takes me out and then goes back down again? Like, what happens then? Like, that is how I used to be. And that is how fear-based traders are. They're very hesitant to get into trades. They hate losing. When they lose, they think they've done something wrong. They want to change things. They want to fix things. They usually, in my experience, they tend to be like perfectionists, right? They may have excelled at school, university, work, whatever they've done. And when they get to trading, they want to control everything and they want everything to be perfect. And that is what holds people back, in terms of fear, the hesitation and the anxiety that goes with it. And the second one, so if you don't really relate to fear, if you're not really like, anxious to get into trades, if losing isn't that big of an issue for you, you might fall into the second category, which is greed, right? A lot of traders fall into greed, which is they're greedy, they want to make money, they're not disciplined. They don't follow their trading plan, they over risk, they over leverage. So let me give you an example. I know a lot of people on Twitter, they ask me about this because they've got, FOMO, greed, that sort of stuff. Fear of missing out is an element of being greedy, right? It's an element of being greedy because you can't accept what your model gives you, right? Because if you follow your trading model, you've got your trading plan and you follow it every single trade without hesitation, there is zero thing as FOMO. You should have no FOMO because it's not your trading model. Right? Like, I'm a swing trader. I don't care what a scalper does on the 1 minute chart on gold. Like, I don't care. Even if that guy makes like 10k in a day, that means nothing to me because it's not my trading model. I have no FOMO. Whereas people who have greed, they think, even though they've won today, let's say they've won a trade, they think, oh, well, this guy made more money than me. They made more money than me. Let me get into a trade. And, they struggle. They lack discipline. They struggle to follow their plan. And the reality is they're just focused on making money. They're focused on making money too much. And they'll do anything they can to quickly make money. And when you try and quickly make money, you quickly lose money. So like an example of a greed-based trader would be, you see this fair value gap here, right? Let's make this a bit bigger. Let's say their entry was this fair value gap. And they're on the charts at this point, right? And they see price coming down, and there's no retracement. They see no retracement, right? So price has come down like this. It's come down like this. And they think price is not going to come up and give them a second chance, like it's done it. They don't think that's going to happen because for whatever reason, they're greedy. They think price is going to come all the way down. They think it's going to keep going down. It's going to keep dropping. It's going to take out, liquidity here. It's going to keep going down. And they don't even think about the possibility of losing because to them, it's all about making money. And what they'll do is, let's say price is here or it's like around here. Their entry really is supposed to be up here. That's what it says in the entry model. But they're like, oh, you know what? Screw it. I'm just going to enter here and I'm going to target all the way down here. And they target all the way down here. Price, slightly goes in their favor, quickly reverses. It stops them out. And then it goes to their entry. And then usually what happens is their entry is actually right. And it goes to take profit. And then they're angry. They start revenge trading. They start changing the model. This is what a lot of greed-based traders have. They have this sort of issue where they can't follow their model. They're chasing price. They don't have discipline. They can't wait for it. Maybe they follow their model for a week and then they give it all back, on one trade. you know, the next week after because they can't follow their model. And, you know, greed at its core, it's a lack of discipline. It's a lack of discipline. So for greed, the key thing is you have a lack of discipline in yourself. You can't follow your model. You can't follow your model because you have a lack of discipline. Whereas with fear, the key thing there is a lack of confidence, right? With fear, it's a lack of confidence. With discipline, with greed, it's a lack of discipline. Right? I hope that makes sense. I hope that makes sense because that's very, very important. Fear-based traders don't have confidence in themselves. They don't have confidence in their model, and they don't have confidence in the markets in general, right? And that was for me. I had, you know, a huge problem with like just not having confidence in my model. Like I'd lose like 2 trades in a row, and I'd be like, oh, you know, what if I lose again? What if I lose again? What if I lose the next 5 trades? Like this is what I would think, right? Because I didn't have confidence in myself, right? And it's very, very important as a trader you have confidence in yourself because, you know, eventually you're going to be putting real money on the line, and depending on how big your ambitions are, your stop loss could be $1,000, $5,000, $10,000, right? If you want to make 10K in a day and you've got a free risk to reward ratio, you know, you're going to be risking $3,000. $3,000 is a lot of money, and you need to be at a point where you're confident enough to risk that money and lose that money, right? If you lose a trade and it's $3,000 stop loss, that shouldn't bother you. Eventually, that will not bother you. So, you know, you've got to be at a point, if you're a fear-based trader, where you're confident in yourself and you're confident in your model. And if you're a greed-based trader, if you're greedy, you know, you like chasing price, you get FOMO, you need to develop discipline. Okay, so now we're getting into the meat of the video. This is absolutely gold dust. And, you know, if you watch this far, because so many people will just click off in the first minute, but if you watch this far, this is so important. This is what's actually going to change your life. We have something called a self-image, right? Your self-image, let's mark this out. Your self-image here is buried deep within your subconscious mind, your childhood, and even, you know, all your life experiences. You know, you would have heard stuff. And this is why most people don't make any money online, is because you would have heard money doesn't grow on trees, money's hard to get, you need I made a money, all that sort of stuff goes into your self-image. And your self-image, in this case, the money, that money's really hard to get, right? When it's not, right? It's actually really easy. It's really easy to get once you know what you're doing. Once you've got this in your mind. But your self-image is so important. Your results are all dictated by how you see yourself subconsciously. Not if me and you were in a room and I was like, hey, you know, what do you think of yourself? Oh, I'm a confident guy. I know how to trade. It's not what you would say to me. It's not what you want other people to, you know, think about you. It's not what you want, right? It's what you deeply believe in your subconscious mind, right? Without even thinking. How do you actually see yourself? Yeah? Because, you know, a lot of you see yourself, and even I was like this. I saw myself, you know, almost a bit of a pussy, right? I was afraid to lose. I was scared, you know, scared to get into trade. I was deep within my subconscious mind. Deep within my subconscious mind also was that money was really hard to make, and it was hard to get, and it was hard to keep. You know, all that sort of stuff held me back for ages, because within my self-image, I had all these negative traits. Now, this video is just about trading, and I wanna literally, and if you watch my videos, I'm all about no BS, practical solutions. Let's fix the problem. But I need to tell you guys what's holding me back, and then I need the solution, because the solution is very easy, very bizarre, but really easy. So here we go. Your self-image, and this was me for ages. I guarantee you're saying things like this. I want to be a profitable trader. Here we go. Do you know how it's want? Not I am. I want to be a profitable trader. I lack discipline. I'm afraid to lose. Yeah, I used to do this all the time, right? When I'm profitable, I will do this. You know, when I'm profitable, I'm gonna live in Dubai. I'm gonna get into property, like all that sort of stuff. This was me as well. One day when we're rich, you know, like how many times have you and your mates done that? One day when we're rich, we're gonna be here. You know, we're gonna do this. We're gonna do this. Right. When you keep saying this, what you're really saying to your subconscious mind is, I am not that person already. I am not a profitable trader. That's all we care about in this video, because we're talking about trading. All we care about is being a consistently profitable trader who makes money. That's all we care about in this video, right? I might give you a few gold nuggets about money and maybe even women right later on, but this video is purely about trading, right? For the most part. So here we go. All we care about is being a profitable trader. Now, your subconscious mind has no ability to think. It cannot think for itself. Your conscious mind does all the thinking for you. Right? That's where all your knowledge is. It's just all the thinking for you. The subconscious mind just accepts whatever goes into it. It accepts, and it turns into result. It manifests into result. Right? Key word there. It manifests into result. That's what manifestation really is. And most people have no idea what they're talking about with manifestation. Here we go. Right? When you say things like, "I want to be a profitable trader. I lack discipline. I'm afraid to lose. And when I'm profitable, not I am profitable, when I'm profitable, one day," all you're always telling your subconscious mind is, I am not a profitable trader. I'm not a profitable trader at all. Now, your subconscious mind cannot think. So it thinks, oh, well, Atif, right? Me, oh, he doesn't want to be a profitable trader. So What he wants is he wants me to be, he wants me to keep him as an unprofitable trader, right? For some reason, he likes studying, right? Yeah, that's what. Whenever my mates would ask me, and you probably have this too. Oh, what are you trying to, what are you doing? What are you doing? Oh, I want to be a profitable trader. I want to be a trader. I want to be a trader. Your subconscious mind is going to keep you as a guy who wants to be a trader, right? This is so. If you can really understand this, you can easily change it. Your subconscious mind is going to keep you as someone who wants to be a trader, right? Oh, this is his identity. Because that was my whole life for years. That I'm a guy trying to learn how to trade. Well, if you're a guy who's trying to learn how to trade, you're going to be forever a guy trying to learn how to trade. Because your self-image and your subconscious mind is going to see that. It's going to see that you get really emotionally involved, right? That you're really passionate about it. That, oh, this guy, for whatever reason, he really wants to be a guy who learns how to trade. He wants to be a guy who wants to be a profitable trader. He doesn't actually want to be a profitable trader. Your subconscious mind is going to think, oh, he enjoys watching YouTube videos. He enjoys reading books. He enjoys, learning about liquidity and all that. It might be interesting, but at the end of the day, we want the result. We want the P&L. We don't want blown account, right? But the only way we can do that is to not identify with any of this crap here. Like, I get so many people saying to me, I'm afraid to lose. Now, when you say I'm afraid to lose, your subconscious mind thinks, oh, I want to lose. Right? I want to lose. Let me keep making this guy lose, right? Let me keep making this guy lose. Here we go. I lack discipline. Let me this up. I've got 18,000 followers. I get hundreds of DMs from traders every single day. And I get this sort of stuff all the time, right? Where I say, I'm afraid to lose. I lack discipline. How many people say this? Oh, I'm good at trading. I just lack discipline. But when you say that, it goes straight into the subconscious mind. Straight into the subconscious mind. And your subconscious mind will dictate 95% of your results. So when you have that in your subconscious mind, you lack discipline and that you're afraid to lose, that one day you'll become a profitable trader. And when you keep saying stuff like that, when you say one day I'll become a profitable trader, well, that one day is never going to come because your subconscious mind is going to keep you as a guy who's waiting for that day to come, right? It's very stupid, your subconscious mind. It has no ability to think for itself. And I'm telling you, every single successful person that you know, anyone, Donald Trump, Elon Musk, anyone, they all are using the law of attraction. They're using the law of attraction because it's rooted in science. It's absolutely key because what's actually happening, and I guarantee this is what's holding you back, right? It's, let me just mark this out so it's clear. Your self-image, and this is such a key word, this is absolutely key. Your self-image will determine your results, right? And your self-image, let me just write this down, it's determined within your subconscious brain. Your self-image is in your subconscious brain. Do you remember how I said right at the beginning of the video, and it might have sounded weird, if someone asked me if I wanted to be a profitable trader, I would have said yeah, because logically, if I asked you, do you want to be a profitable trader? You'd be like, yeah, of course. Like, of course, I want to make money. Subconsciously, though, that's not the case. Your self-image is this. Your self-image is this. You see yourself as someone who wants to be a profitable trader, someone who's trying to learn how to trade. Right? Your subconscious brain, remember how it has no logic to it. It cannot understand. It thinks that you want to be someone who enjoys learning how to trade, right? You have to convince your subconscious brain that this is your self-image, right? Even if it's not a reality yet, right? Because remember, the results come after it's in your subconscious brain. If you want to be rich, you need to convince your subconscious brain that you are rich first. Then the money will come. You can't keep saying, oh, I'm a guy who's trying to be rich. I want to make money. I want to make money. You have to say, I am a guy who has money. And then by law, the law of attraction, it must come. The exact same way, if you want to be a profitable trader, you can't keep saying, oh, I want to learn how to trade. I want to learn how to trade. One day I'm going to be profitable. One day I'm going to be a millionaire. One day I'm going to be funded with FTMO. You have to say, I am a profitable trader. I am a profitable trader. And you have to say that so it's inside your subconscious brain. And then once it's in your subconscious brain, by the law of attraction, it must manifest. It must come true. And if you're wondering why this actually works, your subconscious brain, as it does 95% of your actions, it will force you to have the good habits of a profitable trader. Because you already know what they are. Following your model, A+ setup, risk management, all that sort of stuff. You know consciously, right? If I told you consciously, you know the habits of a profitable trader, right? It's no magic. You know it. You know what it is. But emotionally, on the subconscious part, you can't do it. All your FOMO, let's just mark this out. All your FOMO, all your greed, all that sort of fear as well, all that sort of stuff is in the subconscious brain, right? And greed too. All of that is in the subconscious brain. Because if I said to you, hey, do you enjoy having FOMO? You're going to be like, no. Do you enjoy being a greedy trader? No. Do you enjoy being a fear-based trader? No. Right? It's all rooted within your subconscious brain. And remember, 95% of your results and your actions are within the subconscious brain. Right? It's within your subconscious brain. It's all within there. And when people say, when they have a paradigm shift, when they say everything clicked for me, they're not talking about technicals. They didn't discover a holy grail. They discovered themselves. Right? I'm telling you, the moment I started saying, I am a profitable trader, within a month, I was on a winning streak. Now, I didn't know whether like I was gonna go on like a winning streak and then start losing again. Within 2 months of me starting to write this, I could easily say that I was a profitable trader. I could easily say I was a profitable trader, and my only goal was looking for capital at that point. Like I was just looking for money to manage, and you know, like I turned to this, right? I turned to this, probably my lowest moment in my life. Like I was absolutely broke. I spent a year and a half. I'd put my heart and soul into learning how to trade. I understood it on a conscious level. I knew, I knew all the technicals, all the analysis, all that sort of stuff. But on the subconscious level, I just couldn't do it, and the results weren't showing. Right, all my results were negative. The reason why they were negative is because inside my subconscious brain, it kept seeing me as a guy who wanted to learn how to trade. If you asked me, hey, what do you do? What do you do? Oh, I want to be a trader. I want to be a trader. I'm trying to learn how to trade. I'm trying to learn how to trade. I never said I am a profitable trader, right? And because I never said that, my subconscious brain, because it's determined by emotions here, because it's determined by emotions, there's so much emotion behind this. It just thinks that you want to be a guy who's learning how to trade. And we have to convince your subconscious brain that you are a profitable trader already, and then the results will show. So I'm going to show you how you can actually do that, how you can actually convince your subconscious brain that you are a profitable trader. I'm going to give you a solution, right? And this is the key solution. It's journaling. And I know people don't like to journal for whatever reason, but what a journal really is let's say we have the example, right? The trader who was supposed to enter at this fair value gap. He was supposed to enter this fair value gap, and for whatever reason, he sold price down here, chasing price because he couldn't wait for a retracement up. You would get your snipping tool up. Don't know if you guys can see this. Let's just type it in here, right? You'd get your snipping tool up. I'm not going to actually do it. You'd get like whatever screenshot software you want. You'd take a screenshot of this. You'd put it on a Google Docs, and you just type, here is a trade, which I did not wait for, right? I chased price, and price quickly reversed. It took me out, and I should have waited here. And you write that down in a journal, and you write down how you were feeling and why you did that, right? So you might write down like, oh, I got into the trade because I thought it wasn't going to come up. I thought it wasn't going to come up. And then what you'll see is, let's say you journal for a few weeks, you'll read it back and you're like, oh, it's just a lack of confidence. It's just a lack of, almost experience, right? Because if you think about this, if you see this enough times, you'll be like, oh, if I just wait for a retracement, then I'll be fine. So what you'll see is, in this instance, chasing price is just a lack of almost experience with your model. And the cure for that is backtesting. Backtesting is so important, because if you backtested this 100 times, you're going to realize, oh, well, every time I wait for retracement, I'm profitable over the long run. Where every time I chase price, I lose right away. All right, so that's where a journal comes in. And if you're a fear-based trader, and again, we're going to use the analogy that this is your entry, and usually what your model says is that your stop loss should be, let's say here, like that, and your take profit should be down here, right? Whatever, 6 to 1, whatever. Entry doesn't matter, but for whatever reason, you've lost 2 trades and you're afraid to get in. You're afraid to get into this trade because you think, for whatever reason, it's going to go up like that. And we're in live price action now, so I don't know what's actually going to happen. But let's just suppose it does this. Let's suppose it goes straight down to your take profit. You're going to journal this, and you're going to be like, due to the previous trades I had, I was nervous, I was fearful, I didn't have confidence in myself, and I was too scared to get into the trade, and now the trade's quickly gone off without me, and it's hit my take profit. Right? That's what you will journal, and then you'll realize over time, over reading your journal, that, oh, it's just a lack of experience, really. It's a lack of experience in my model. Because if you've seen this, again, we're going to go back to backtesting. If you backtest this 100 times, do you know more often than not, when price retraces to a fair value gap and you're bearish, you tend to make money, you're going to execute it. You're going to execute it. So the solution almost always tends to be more backtesting, get more and more confidence. And you don't just backtest once, right? The first initial backtesting is to get your data. So like when I first backtested my model, it was a 50% win rate, 3 risk to reward ratio. That's like the actual data that you have an edge. And then afterwards, you keep backtesting to get the experience, because the more and more you can train your eyes, the less likely you are to do emotional things like fear and greed. And yeah, backtesting and journaling are so key. I know people hate journaling. I know they hate backtesting. It is tedious, but I'm telling you, please, if you just take a screenshot of this and you just write like a sentence or two, that will help you out so much. Because I realized, like, I had no idea about any of this, but I read my journal. People told me to journal, so I journaled and I read it back, and I was like, man, every time I lose, I go into a tailspin. Like, I'm so afraid of losing. And what that is really at its core is a perfectionist, right? A perfectionist trying to, because I'll be honest, everything I've done in life, and not to sound arrogant, like I tend to succeed at it. I tend to be like almost the best. So for me, you know, being a trader and losing 50% of the time, but still making money, that for me is very hard. Because for me, my brain sees success as winning, right? High win rate, 80, 90%, 95%, let's say. Because if it's an exam, usually I'm getting, you know, high 80s, low 90s. So for me, 50% win rate, that doesn't really, you know, go well in my brain, because it's like I'm going to lose quite a lot. I don't like losing. So for me, you know, fear was such a huge issue because I was a perfectionist, and I had to let go of that. You know, I had to let go of that perfectionist. I had to accept, you know, humble myself really, that, you know what, I'm going to lose a lot. I'm going to lose a lot. And the real loser in trading, it's not price going against you, right? So let's remove this. The real loser in trading, and this is so important, because if you can get this, you can truly be profitable. The real loser in trading isn't, let's say this is your model, it isn't this. That's not a real loser. The real loser is two things. It's either you not getting in the trade because you're so afraid that price is going to go against you, or price literally going down like this, and you're too impatient, undisciplined to wait for retracement. So you're just going to enter as soon as possible. You're just going to enter here randomly, you know, buy it, just randomly sell and target all the way down there, and then price goes against you. That right there, those two scenarios, is a real loser in trading. That's a real loser in trading, right? But price, you know, you following your model and, you know, price actually doing that, that's not a loser. That's not a real loser, because that's exactly what you expect. Because if you truly understand what a win rate is, because let's go off the analogy, you've got a 50% win rate and a free risk to reward ratio like I have, right? That right there is enough to make you a millionaire. That's enough to make you a millionaire, you know, 10k a month, 100k a month, a million a month, or whatever you want. But let's just go off that analogy. You've got a 50% win rate. What that really means, what it truly means, is you have a 50% loss rate, right? No one talks about this. Everyone talks about win rate, but what's your loss rate? You're going to lose 50% of the time, right? You're going to lose 50% of the time. 50% of your trades are going to hit your stop loss, not your take profit. And you've got to accept that. You've got to actually accept that. If you don't accept that, you're never going to be profitable. You're never going to be profitable because, you know, even for me, like, I'd backtest it. I'd have a 50% win rate, 60% win rate. And then, you know, as soon as I lose like a trade or two, I'm like, oh, you know, I need to change something. Why? Why do you need to change something? Right? You got to trust your backtesting. You got to trust your edge. You got to trust your data, because you don't have data on your emotions. You don't have data on your emotions, but you have data on your trading.
Now, if you've watched my channel for a long time, you'll know I'm big into solutions. How do we actually fix this, right? What is the solution? Now, I'm going to save you 4 years of pain, and there's one simple solution that you can do. And it's an affirmation. Now, an affirmation is something that you say and that you write down repeatedly over time. Now, it might sound absolutely insane, this, but like I said, check out the comments. People are doing this and it actually works. This is what made me a profitable trader within 3 weeks. And what you're going to do is you're going to write this down. You're going to write this down. I am so happy and grateful now that I am a profitable trader. Let me spell this right. Now that I am a profitable trader. And you're going to do that, and you're going to do that repeatedly over and over and over again, right? And this isn't some woo-woo BS that I've made up. This is exactly what I do on a day-to-day basis. In fact, what my notepad right here, I don't know if you can see that, right here, full A4 notepad of just writing the same thing over and over and over again. And you might be asking, why do we do that? Why do we say the exact same thing and write the exact same thing over and over and over again? Now, the reason we do that is because the way you communicate to your subconscious mind is either two things. It's repetition and emotion, right? Repetition and emotion. Now, I'm not going to get, because I want this video to be short, because I know so many of you need help with trading psychology, but for whatever reason, you hate watching long videos on psychology. So I'm going to keep this really short. All you need to know is that in order to get something into your subconscious mind, which determines 95% of your actions, is we need repetition and emotion. So if you say this over and over and over and over again, over time, it gets into your subconscious mind. And once it's in your subconscious mind that you are a profitable trader, which is our desired result, the FOMO goes, the fear goes, the greed goes, because you can't have two ideas, thoughts in your subconscious mind that contradict each other, right? So if you're a profitable trader and you're afraid to lose, those two things don't make sense, right? They don't make sense. Now, eventually, the stronger one is always in control, right? So right now, or at least for me when I was unprofitable, me being afraid to lose was way stronger than me being a profitable trader. But I kept saying this over and over and over again. What happens is this idea of me becoming a profitable trader gets bigger and bigger and bigger. And this, idea of me being a losing trader gets smaller and smaller and smaller. Eventually, you being a profitable trader comes ahead of being a losing trader and then you being an unprofitable trader just goes. It literally just eliminates overnight. And that's when people say, oh, I was trading for 3 years and it clicked within 3 weeks. This is exactly what they're talking about, whether they understand it or not. This is exactly what they're talking about, because in your subconscious mind, you can't believe that you are unprofitable and keep saying this over and over again, right? Eventually, something's going to give. And before you know it, your actions are a profitable trader. And if you act like a profitable trader, you think like one, you feel like one, you will become one, and it will show in your P&L. That is how you fix your trading psychology. Use this affirmation. It's changed my life. It's changed thousands of people's lives. Now, like I said, I don't want to make this video too long. If you want like a more in-depth, I guess, like course about how to trade, how to fix your psychology, this sort of video, mindset, all that sort of stuff in way more depth, go check out this full free 2-hour trading course where I talk everything you need to know to become a profitable trader. And to be honest, if you write this out every single day on an A4 notepad, like I'm doing now, and you watch that 2-hour trading course, within, I don't want to guarantee anything, right? Don't start suing me. Some of you trying to sue me. Within a month, I guarantee you, or at least as much as anyone can guarantee you will almost certainly be a profitable trader. Right? I'm not BSing you. Try it out, try it for a month, and go check out that video. It will honestly change your life.